monetizing it. B of A writes 2024 could help establish Google as either an AI leader or at risk for further search erosion. On that note, Google's most advanced version of Gemini, that's its latest large language model, is expected to become available early this year, so we will be looking for any further details on the call. Also in focus, layoffs and cost controls. After rolling layoffs to start the year, Wall Street will want to know how it's impacting the bottom line and margins. Finally, pay attention to Google's cloud unit. Last earnings report, a miss in the cloud division overshadowed better than expected overall results. The bar's high for Alphabet just last week. It hit a fresh all-time high.
Good morning. Starbucks is set to report earnings for the first quarter after the closing bell today. The stock had a lackluster 2023, down over 3%. Analysts are expecting EPS of 93 cents on revenues of $9.58 billion for the quarter. Same-store sales will be the key metric to watch. Global same-store sales estimated to climb 7.2%. North America comps up 5.8%, and international comps estimated to climb 13.2%, according to FactSet. Analysts are warning about some potential softness in the company's sales trends for this quarter. First up, weather in the U.S. has been noted by analysts at Stifel and Piper Sandler. Stifel also projects a potential impact from consumer boycotts at some licensed stores in several Middle Eastern markets. Looking to China, Starbucks' second home market, as it calls it, Piper notes potential questions about the quarter and full year there. It says it believes investors are expecting a same-store sales miss against the consensus of up near 20%. Quote, at the end of the day, the bigger picture question here is what is going on with Starbucks' business in China, and is the unit growth story still intact over the long term? Unfortunately, we don't have the answer for that, Piper's Brian Mullen writes in his note. Much more to come after the bell. Frank, back over to you.
All right, outside of earnings, this week is all about the Fed as the central bank kicks off its latest policy meeting today, bringing it one decision closer to the start of its rate cut campaign. Ahead of that decision, interest rate traders only pricing in a 2% chance of a cut tomorrow, but those odds shoot up dramatically looking ahead to March and beyond. But for some, like Senator Elizabeth Warren and 3 other Democratic lawmakers, March is not coming soon enough, with the group urging the central bank to do more sooner, saying, quote, the direct effect of these astronomical rates has been a significant increase in the overall home purchasing cost to the average consumer. We urge you to consider the effects of your interest rate decisions. Joining me now is New York Times Federal Reserve and economy reporter Gina Smilek. Gina, good morning. It's great to have you here in the house.
Thanks for having me.
All right, I know you're heading down to D.C. later today. You're going to be in the room when they make that decision. Not much expected from the decision, honestly. Everybody's expecting no move at all, but a lot of anticipation when it comes to Jay Powell's press conference. What are you expecting?
Yeah, this is going to be a tough press conference for them because I think they are going to try and walk a very fine line between not ruling March out as a live meeting for a rate cut and not absolutely locking it in as a meeting for a rate cut. I think they're going to try and keep it live. I think they're going to try and keep their options open. You know, we've got a couple of really big data points between now and that meeting, and so they're not going to want to be too definitive.
All right, so you said the odds, we were talking off camera, odds are like 50-50. It could go either way in your mind. So I do want to talk to you about this week overall. Pretty big week. We have a Fed decision and obviously the Jay Powell news conference. And then on Friday, we have the jobs report. So we have a lot more economic data before we get to March. Give us a sense. The jobs report, other economic reports, how does that factor in? Because I think the consensus now is we've kind of reached that soft landing. Does the Fed see it the same way?
Yeah, I mean, I think the Fed is extremely hopeful that we've reached that soft landing, but I think they have to watch a couple of data points between now and that March meeting. The most important one is actually February 9th, which is when we get CPI revisions, and those are not usually a barn burner of a data report, but I think in this case, last year what we saw with these CPI revisions was a really big upward revision to the fourth quarter, and the takeaway there was that the inflation picture wasn't as positive as we thought it had been, and so if that were to happen again, it could really change the picture that the Fed is looking at, and so I think those February 9th revisions are just going to be incredibly crucial to how they're thinking going into the March meeting. And then we're going to have another CPI report. And so I think the sort of 1-2 punch of the actual CPI data in hand and the revisions from the end of last year are going to be the critical thing to watch.
So is CPI, PCE, are those really the deciding factors here? How does the jobs report play into all this?
Yeah, excellent question. And I think actually the most important question for Powell this week. He's going to get asked about this if no one else asks about this, I'm going to ask about this, which is how are they thinking about growth data versus inflation data right now? Because the growth data look really strong. It's a little weird for the Fed to be cutting interest rates in an environment where growth is above trend, unemployment's at 3.7%, job gains are still really solid. But at the same time, inflation's coming down faster than they expect, and maybe we'll even undershoot that 2% target if it keeps going at this rate. And so I think, how that balancing act plays out is something that he really needs to describe in a little bit more detail.
All right, so we know the question that you're going to ask during the news conference. What about what Senator Warren, those Democratic lawmakers, are asking to definitely cut in March? Does that factor at all into the Fed's decision? Does that factor into Jay Powell's thinking?
They would tell you absolutely not. They are very adamant that they do not take political considerations into account when they're thinking about policy. This is why they have that famous independence from from not just the presidency, but also they're fairly insulated against immediate change from Congress. And so I think that, they would say, no, it doesn't matter to them. Obviously, though, I do think they are conscious of the fact that people are really struggling under the sort of combined weight of high prices and high mortgage rates. And that is something that they're thinking about as they try and navigate this soft landing, try and make sure that we can set down without a big recession.
There's a lot of things going on in the world in general. There's geopolitical issues that are impacting just about everything, but including the oil market, which can have inflationary impacts. But at the same time, we've seen the supply chain ease. How do those different geopolitical factors, how do they factor into the Fed's decision when, again, their mandates are unemployment and inflation?
Yeah, I think if you talk to any economist right now who's watching sort of the global macroeconomy, this is the big thing that they're worried about. When you say what could derail the soft landing, it's geopolitics, because we've got these Red Sea disruptions, which are messing with supply chains through the Red Sea. We've got the potential of a bigger Middle East conflict, and both of those could matter a lot.
All right. Gina Smilek, it is always great to have you here and have your insight. I know you're heading down to D.C. You're going to be in the lockup. We already know your question. So we know the question that you're going to ask if nobody else asks. It's really great to see you. Thank you for being here.
Thank you.
All right, time now for a check on some of this morning's top corporate stories. Great to see our Silvana Hanel as well. Silvana, over to you.
Hey, Frank, good morning. Boeing says it is withdrawing a request for a safety exemption for its new 737 MAX 7 jet that would have allowed U.S. regulators to speed up its approval. The exemption, which was initially requested last year with the FAA, would have allowed the MAX 7 to be certified before making design changes. Boeing's withdrawal comes ahead of its fourth quarter results tomorrow. The DOJ and SEC announcing charges in relation to a nearly $2 billion crypto fraud. The DOJ says the three people charged falsely claimed that investors in Hyperfund, as the scheme was known, would receive substantial returns paid from crypto mining operations that didn't actually exist. And OpenAI announcing it's teaming up with the nonprofit Common Sense Media on a new push to help teens understand how to use artificial intelligence in a safe manner. Common Sense has been working to develop an AI ratings and review system for parents, kids, and educators to better understand AI's risks and benefits. OpenAI's apparent goodwill tour coming as it and primary backer Microsoft face off against a growing wave of legal headwinds over content use, including one from the New York Times, something Microsoft CEO Satya Nadella weighed in on during an NBC News exclusive with Lester Holt. Listen in.
I do want to ask you about the New York Times lawsuit against your partner, OpenAI, and yourself, about the idea of using their content, using New York Times content to train AI. I know it's a legal open case and you can only say so much about it, but it does kind of open up a thought about where this information comes from and who ultimately benefits.
Yeah, I mean, I think one of the things that is going to be very, very important is both what is the copyright protection as well as what is fair use in a world where there is transformative new technology. I think that that's really where the copyright laws have to essentially now be interpreted for what is a new transformation technology. We've done this in the past. I'm sure we'll come out with the right set of guidelines on what is used for training. That's one thing. That's the transformation side of it. And of course, it's clear that you can't just use copyrighted material and regurgitate anything. And so those are two very distinct issues. I think we'll, the courts will opine on it, and I'm sure will come out. And in fact, if you look at, what Japan is doing and other countries are also doing, which is how to think about copyright in an enlightened way so that this new technology can be developed, in fact, new competitors can be introduced, while at the same time protecting copyright.
And Frank, OpenAI CEO Sam Altman recently revealed his firm had been in talks with the Times on paying it for the publication's data before news of the lawsuit came out.
All right, Silvana, thank you very much. All right, coming up here on Worldwide Exchange, a bullish call on Spotify, sending shares higher ahead of the open. We have the details next. But first, we have some of your top trending stories. SiriusXM becoming a lot less smart, at least in name. The company reportedly signing a $100 million deal to move Will Arnett, Jason Bateman, and Sean Hayes' SmartList podcast and its platform. The multi-year agreement will provide exclusive content for subscribers, including early access to new episodes. You're also going to get your chance to mix coffee with olive oil. Ugh. Starbucks is launching its olive oil-infused drinks in all U.S. stores starting today. The Oleato beverages first debuted in Italy last February and were initially met with negative reviews. The CEO talked a lot about it actually during one earnings call. Pretty excited about it. I just don't know. Olive oil and coffee. And the old Taylor can finally come back to the phone. X restoring searches for Taylor Swift after temporarily blocking them due to a flood of explicit AI deepfakes. The social media platform says it will hire 100 content moderators to better police its safety rules. Stay with us. Much more Wex coming up.
Book now.
Welcome back to Worldwide Exchange. Quick market check on shares of Calix. The telecom tanking on the heels of weaker guidance for the current quarter, pulling attention away from a better than expected quarterly report, though still reporting a loss for the fourth quarter. Those shares down more than 20%. We're also watching shares of Arcus Biosciences. They're popping this morning, up almost 18%. Gilead Sciences raising its stake in the cancer-centric biotech company to 33% and expanding its presence on the company's board of directors. All right, time now for your morning call sheet. UBS upgrading Spotify's rating to a buy and raising its price target to $2.74 per share. It says the streaming giant's efficiency efforts have increased conviction on sustainable margin expansion and stronger bottom line trends. You can see shares of Spotify right now up just about 2%. Raymond James downgrading Advanced Micro Devices rating ahead of its earnings, moving it to outperform. It cites valuation and elevated AI revenue expectations for that move. Shares of AMD right now down just about 1%. And Oppenheimer downgrading its rating and price target on Five Below, moving it to perform in $200 a share. Oppenheimer saying it worries that Five Below's underlying growth dynamics are slowing down. Shares of Five Below right now unchanged in the pre-market, but down about 3% over the last year. All right, time now for your global briefing. The EU out with its latest read on GDP, avoiding an expected recession late last year. After stabilizing in the fourth quarter, the reading coming in flat, but better than expected than the slight pullback expected. This despite weakness within the EU's largest member, Germany. Over in China, BYD under pressure after issuing a profit forecast that was below expectations. The Berkshire Hathaway-backed company recently surpassed Tesla as the world's largest EV maker by sales volume, but still faces a price war with other Chinese automakers. And Saudi Arabia's Aramco is abandoning plans to boost its oil output capacity. The reversal will take out a major portion of the supply buffer originally expected for later this decade. It comes after Aramco said it plans to boost capacity to 13 million barrels a day by 2027, and they said those efforts were going, quote, very well. All right, coming up, we have the one word that every investor needs to know today, plus too much love for the Magnificent Seven. The members our next guest says have been overbought as the group prepares to roll out earnings. And if you haven't already, follow our podcast. If you miss Worldwide Exchange, check us out on Apple, Spotify, or other podcast apps. Much more WEX coming up after this. Welcome back to Worldwide Exchange. Time now for your WEX wrap-up. We start with F5 jumping after topping earnings expectations and issuing strong revenue guidance. The cyber company citing its product portfolio and innovation efforts for that beat. You can see those shares are up over 9%. SoFi giving back some gains this morning after posting its best day since August of 2022 yesterday. This on upbeat earnings and the expansion of some investment options that are available to customers. Netflix co-founder Reed Hastings donating over 2 million shares of the streaming giant to the Silicon Valley Community Foundation. Hastings still owns around 3 million shares, along with several million in stock options. Diageo under pressure on lower than expected sales and earnings. The UK distiller says sticky inflation and higher interest rates are causing sales to slump in the US, Latin America, and the Caribbean. Elon Musk's Neuralink implanting a brain chip in its first human patient, who Musk says is recovering well. Neuralink was approved by the FDA last year and is working towards enabling people to control a computer with their thoughts. And Whirlpool shares, they're falling this morning. The company forecasting sales and profit below estimates as it deals with pricing pressure, falling North American consumer demand, and higher expenses. Shares of Whirlpool down just about 5%. Here's what to watch today. We get several pieces of economic data, including the latest S&P Case-Shiller Home Price Index, JOLT survey, and consumer confidence figures. We also have another busy day of earnings with results from Microsoft, Alphabet, UPS, General Motors, Pfizer, and AMD, all of them set to report. And the Fed, it kicks off its latest two-day policy meeting today. Earnings with a big focus on big tech results set to be the key driver for the markets as they continue to notch fresh record highs. Taking a look at futures right now, we can see the NASDAQ has dipped just slightly back into negative. The Dow back to its lows of the morning, looking like it would open about 45 points lower. For much more, let's bring in Jay Woods, Chief Global Strategist at Freedom Capital Markets. Jay, good morning. It's great to have you here.
Good morning. Good to be here.
All right, so obviously a huge week for earnings this week. Big tech earnings, Magnificent Seven earnings. With that in mind, what's your WEX word of the day?
Well, when you're watching these earnings, watching these stocks, you have to respect the trend lines. Right now, what we saw out of the first of the mega caps report was Tesla. Tesla was in a downtrend, and that trend line held and broke down. Now we focus on the mega caps, how they're going to react. So if you're trading these stocks, if you're looking over the long term, the trend lines look great. But let's look at Apple first. Out of the 5 that report this week, this one has me a little concerned. The price action is slightly down. We made a lower high this time up. Watch the 200-day moving average. It's right on the uptrend as you go into it. And then you've got 3 of them that are overbought right now. That has me a little concerned. Not concerned because they could go down. But when you look at Microsoft, Meta, and Google, I know it's Alphabet. They should change the symbol to ABC. It's available. You know, AmerisourceBergen's gone. Conshohocken Company.
Listen, we're bringing here from markets, not branding.
All right, I apologize. But
let's get to the companies that you're looking at that are in overbought territory. By the way, you can go on the CNBC stock screener to look this up yourself. You are talking Alphabet, Meta, and Microsoft, all 3 with an RSI above 70. Why is that meaningful going into earnings?
It's meaningful because it's really going to take a big beat, a big guide for them to really take that next leg higher. Doesn't mean it can't happen. We've seen it. But given the run they've been on, you know, I expect them to do well, but it puts you in a position for an actionable pullback. And that's why the trend line comes into play. Because given the run they've up, Microsoft up 12% already year to date, if it pulls back, that gives someone an opportunity to get in. But if you're a long-term investor, you're not even looking at this. You're just putting them away, and these are great companies. The one I do like is Amazon. Amazon has done that full roundabout, but hasn't made all-time highs like we've seen in the other 4 stocks we've talked about. They have room to run. The trend line is slow and steady going higher, but to me, it's not overbought. And the AI story, I can't wait to hear about what they talk about on the call.
I think a lot of people are waiting for Amazon to talk more about AI. So again, Amazon's not overbought. The overbought stocks that you're worried about are Alphabet, Meta, and Microsoft, but high valuation. Amazon's valuation very elevated. The tech sector trading at about 26 times forward earnings. Amazon trading at about 48 times forward earnings. Are you concerned about that? If you're concerned about it being overbought, aren't you also concerned about earnings justifying that elevated valuation?
Well, I'm a technician first, and you know, historically Amazon has always had a high valuation, so this isn't anything that I'm concerned about. Right now, I look at momentum and where rotation goes into stocks, where it goes into sectors. And what we saw at the end of last year, the rotation was into the small caps, and some of these mega caps lagged, and then they took off to start this year. Now, what I think we're going to see is the mega caps pause, maybe go up a little bit more, but I don't think the momentum is there, and you're going to start to see it come back to the small caps, the Russell. Look at the financials within the Russell. Look at the industrials within the Russell. I think that's where the next rotation goes.
Okay, so your pick is Amazon, but you're saying if you see a pullback in those overbought names, is that a buy the dip opportunity, or is it a cause for concern going forward?
No, I think it's a buy the dip opportunity. I think these are great long-term companies that you buy, you put away, you don't worry about over time.
All right, Jay Woods, great to have you here. Thank you very much. One quick look at futures before we let you go. As we mentioned, the NASDAQ had just dipped back into negative territory. Still seeing it there. Looks like the Dow would open up 45 points lower. Squawk Box coming up next. Thanks for watching.
NBC.
Good morning. A busy earnings day ahead. We'll be hearing from UPS, GM, Pfizer, and JetBlue. That's all coming in the next hour. Plus, Alphabet and Microsoft after today's closing bell. Whirlpool sales are falling. The appliance maker warning that consumers are putting off upgrades and have gotten more price sensitive. And IBM's top brass sending work-from-home managers an ultimatum: move near an office or leave the company. It is Tuesday, January 30th, 2024, and Squawk Box begins right now. Good morning, everybody, and welcome to Squawk Box right here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick along with Mike Santoli. Joe and Andrew are both off today. Been watching the U.S. equity futures ahead of this earnings flood that we're really anticipating today. Big day, not only during the market, before the market, but after the market, too, with the tech names. Right now, it looks like the Dow is off by about 44 points. S&P futures down by about 4. The NASDAQ indicated off by 3. That comes after the Dow and the S&P 500 turned in their 6th record close of the year. The S&P actually closed about 4,900 for the first time. The NASDAQ gained more than 1% in yesterday's session ahead of this week's big tech earnings. We've got more on that in just a moment. In the meantime, though, take a look at what's been happening with Treasury yields. You'll see right now that the 10-year note is sitting at 4.06, the 2 years at 4.31.
Yeah, and in fact, the 10-year started yesterday around 4.14. So this is actually kind of a big part of yesterday's market action, where the S&P was up 0.75%. Yesterday's rally in stocks and bonds came after the Treasury Department reduced its estimate for federal borrowing for the current quarter. The move was unexpected. Treasury now estimates $760 billion in net borrowing in the first quarter. That's down from a previous prediction of $816 billion. The department said the smaller borrowing needed was a result of higher projected net fiscal flows and more cash on hand at the start of the quarter than expected. So when that news came out around 3 o'clock, Treasury yields did back off. It looks like they're kind of maybe breaking this little uptrend in yields we've had in the last month or so, and stocks just kind of levitated from there, which I have to say I was a little surprised that there was that much seemingly at stake with this announcement. There has been excess focus on how much Treasury is going to have to borrow. Also today we get the data on exactly what maturities they're going to borrow at. So this all came into real vivid relief last fall when everybody was looking at yields melting up and saying, is it just about pricing out a recession? Is it just about the Fed? Or is it about Treasury supply and people demanding more compensation?
You know, I was thinking the same thing watching oil prices, because with the tensions rising in the Middle East, we have not seen oil prices pick up. I think WTI today is just above $82 a barrel. Last I looked at it a little bit ago. And that's the same sort of story. Is this a story where people are ignoring the tensions in the Middle East, or is this a story where people are more focused on the potential decline in demand around the country, or around the globe? At the same time, you're talking about pretty high supply.
I think it's supply. The market's acting like it's very well supplied. In terms of the Treasury move, it's almost as if we felt like we were burned, or traders did, last fall by not paying attention to it. And then you had a couple of sloppy Treasury auctions, and now there's excess attention on it. And it was an excuse for a little bit of tension release with the market already acting pretty well. Let's be honest. I mean, it was not, you're not seeing a lot of selling pressure. People are, I think, aware that the big tech earnings could be, you know, go either way, of course, but you don't want to discount the possibility that they give you the boost after the market.
And it's happening with the backdrop of a Fed meeting this week, where the expectation is that, you know, Jay Powell and company are going to have to walk back some ideas about, at least say that the next move is probably likely down rather than up.
Oh, for sure. Yeah, you know, they're going to have to come in line with what their framework says they ought to be doing.
Right, just based on the data we've seen. All right, in the meantime, appliance maker Whirlpool out with a new warning about the consumer. The company, which owns the Maytag and KitchenAid brands, beat estimates for earnings and revenue in the prior quarter, but the guidance is weighing on the stock. That company is projecting 2024 sales below the street's expectations as consumers forego appliance upgrades. Either that, or they've already upgraded everything because they were home during the pandemic and bought all these things. Whirlpool says that it is already seeing a lower demand for appliances in North America, and consumers replacing broken appliances have been more price sensitive when they do go back into it. Take a look at that. That stock down right now by almost 5% for the 6 months, down by over 21%.
Yeah, not too far above its low from October. UPS meantime just reporting adjusted earnings of $2.47 per share. That beats estimates by a penny. Revenue of $24.9 billion came in lower than the $25.4 billion analysts had expected. That is a 7.8% decrease from a year ago. The full year revenue guidance came in lower than the street expected as well. You see the shares at the first reflex down almost 5% on that news.
Carol Tomei, the CEO, making some comments, just saying that 2023 was a unique and difficult year, and through it all, she says they remain focused on controlling what they could control. But yeah, acknowledging that it was a unique and difficult year for this.
Right, of course, all the labor issues and everything else, and a lot of the costs flowing through.
Their dividend that they're declaring is going to be $1.63, and I think that's up a penny from what it had been before, $1.62. And yeah, the outlook, they're saying they're planning for CapEx of about $4.5 billion to $5.4 billion, and the effective tax rate about 23.2%. Revenue $92 to $94.5 billion. Okay, American Airlines. Oh, you.
American Airlines is laying off more than 650 employees from the Customer Relations, Baggage Resolution, and Loyalty Program groups. The cuts are centered in Phoenix and Dallas-Fort Worth. Company says that those employees' duties, including helping customers with lost luggage and other travel problems, will be consolidated into other teams. A new, smaller customer success team will aid travelers with multiple problems at a time, instead of requiring passengers to contact multiple teams. For example, that single team can help customers with both a canceled flight and a lost bag. The laid-off employees will have to have the first opportunity to apply for the 135 spots that make up the new, smaller team.
And Elon Musk's Neuralink startup implanted its first device in a human for the first time on Sunday. In a post on X, Musk said that the patient is recovering well, and initial results show promising neuron spike detection. The company's developing a brain implant that aims to help patients with severe paralysis control external technologies using only neural signals. It hopes to one day help patients with degenerative diseases like ALS use the implant to communicate or access social media by moving cursors and typing with their minds. It's really cool stuff. The idea that this might happen, I think they're also going to be working for people who have spinal cord injuries and trying to make all of these things happen.
It's fascinating. I can't keep track of the developments, and Musk is keeping track of them by running all these different companies. So it's a little bit dizzying that this is all happening at once, and I don't know how it fits into existing research in this area or anything else.
For the criticism he receives, though, to be doing this, to be working on, to be pioneering EVs, to be you know, at the front of these rocket launches and everything with the communications with satellites they put up there. You got to give him credit for this stuff.
For catalyzing a lot of that stuff, sure. All right, the chairs of the two U.S. House committees have asked the Biden administration to investigate 4 Chinese companies that they say are involved in Ford's planned Michigan battery plant. According to a letter viewed by Reuters, the House members accused the 4 Chinese companies of having direct ties to the Chinese military, Chinese Communist Party, North Korean government, and alleged human rights abuses in China. Representatives Mike Gallagher and Kathy McMorris Rogers urged the Commerce Department to investigate and impose export restrictions. The Chinese companies were not named in the letter because of confidentiality rules.
And former President Trump acknowledging that the stock market is on the rise under President Biden, but claiming credit for those gains. In a post yesterday on Truth Social, he said, "This is the Trump stock market because my polls against Biden are so good that investors are projecting that I will win and that will drive the stock market up." He said, "Everything else is terrible and record-setting inflation has already taken its toll." You can kind of hear his voice.
You can. We remember the boasting about the market for sure. All right, coming up, the Fed kicking off a 2-day meeting, and it's another busy day for earnings. Your Squawk Planner is next. And later we'll bring you a fundraising update for the presidential race. Squawk Box will be right back.
Welcome back, everybody. OpenAI announcing that it is teaming up with the nonprofit Common Sense Media on a new push to help teens understand how to use artificial intelligence in a safe way. Common Sense has been working to develop an AI ratings and review system for parents, kids, and educators to better understand AI's risks and benefits. Sticking with OpenAI, Microsoft CEO speaking out about the New York Times lawsuit against the two companies as part of his recent exclusive interview with NBC News' Lester Holt.
I do want to ask you about the New York Times lawsuit against your partner, OpenAI, and yourself about the idea of using their content, using New York Times content to train AI. I know it's a legal open case and you can only say so much about it, but it does kind of open up a thought about where this information comes from and who ultimately benefits.
Yeah, I mean, I think one of the things that is going to be very, very important is both what is the copyright protection as well as what is fair use in a world where there is transformative new technology. I think that that's really where the copyright laws have to essentially now be interpreted for what is a new transformation technology. We've done this in the past. I'm sure we'll come out with the right set of guidelines on what is used for training. That's one thing. That's the transformation side of it. And of course, it's clear that you can't just use copyrighted material and regurgitate anything. And so those are two very distinct issues. I think the courts will opine on it, and I'm sure will come out. And in fact, if you look at what Japan is doing and other countries are also doing, which is how to think about copyright in an enlightened way so that this new technology can be developed, in fact, new competitors can be introduced, while at the same time protecting copyright.
Okay, an enlightened way of looking at copyrighted material, meaning it no longer applies because I have something I want to use it for?
If I'm interpreting it right, he's probably saying that copyright law means you can't republish something else or can't use it in a commercial way, but if you're using it to train
something that I'm then going to sell to someone.
And it's not going to be transparent, of course. And I do think that you have to.
I think there's a big distinction. It's one thing to be training it for altruistic purposes. It's another thing to turn around and then say, I'm training my AI on this, and then I'm going to charge you.
It all comes down to let's figure it out. You know what I mean?
Right.
Let's just figure out what the licensing is going to have to be.
And I think that comes back to OpenAI CEO Sam Altman recently revealing that his firm had been in talks with the Times for paying it for the publications of data before news of this lawsuit came out. So this is all a negotiating strategic sort of plan to see where they come down, how much you're going to pay for it.
Right, or at least an acknowledgement that this is part of the things you have to sort out.
Yeah, but I love this, the enlightened view of copyright law, one that no longer applies.
Right. Well, I'm sure that's lawyers have influenced how he's characterizing it at this point.
But the other way, by the way, the idea of OpenAI training kids and educators on how to use this. I mean, I think that's pretty important. Every kid I know, the reason they're using this is to write their papers.
Shortcuts,
right?
Absolutely.
And that's something that schools are going to have to figure out. It's like when calculators were invented.
Yep.
Are you allowed to use them for math or not? Do you get stupid if you don't learn to write yourself to do these things? So big questions.
Bring back the blue books where you write the exams.
Right. No calculators, no computers, no nothing.
Yeah. All right, well, on today's Squawk Planner, the Federal Reserve kicks off a two-day policy meeting. It's expected to keep interest rates unchanged, but could lay the groundwork for a rate cut as soon as March. On the earnings front, reports from GM, Pfizer, and JetBlue are due before the opening bell. After today's close, we'll hear from Google parent Alphabet. We have Microsoft, AMD, and Starbucks as well. All right, joining us now to sort through all that in advance, Carrie Firestone, Aureus Asset Management Executive Chairman and Co-Founder. She is also a CNBC contributor. Carrie, good morning. Interesting setup here to some of these the big tech earnings, Microsoft and Alphabet in particular. I was just checking how things have gone since the last earnings report for these companies, which was on October 24th. Microsoft up 24%. Earnings estimates for the fourth quarter basically flat. Over that period. Google's up 10%. Microsoft's from 29 to 33 times earnings. What does that tell you in terms of what the market's expecting and whether these companies can deliver?
Well, hi, Mike. Thanks very much for having me. And I'm sorry, in this age of high tech, we have no internet in our building in downtown Boston. But I would say the market has pretty high expectations for for these companies, higher than for anything else than perhaps the state of interest rates, because they have driven the market. I mean, Google is up at an all-time high, highest since 149 in November of 21. The same is true. Microsoft, it had peaked at the same level. It's now the highest valuation of all companies. And it's really about following through with last year. These stocks were up 58% roughly in 2023. And there is an enormous interest in AI and what is going to propel their revenues and their earnings forward. These are two of the leaders, Microsoft in particular. The Google number should be up. I think estimates are about 18 to 20% higher. Sales have started to improve. We know there was a slump in digital advertising. The search is the major part of Google's business, and it started to pick up. It's expected to have a decent quarter, and through the year, double-digit sales growth, and higher than that, sort of the 18+% on the earnings side. And that's true with Microsoft. If we look at where Microsoft has been trading, it's now the most valuable company in the world, and that's really due to belief in AI, but that's going to continue. We've got Copilot, $30 a month. They'll talk about how well it's selling and whether the users are sort of adding features, and it's extremely important to the, I would say, the sentiment about these companies and the market as a whole, because they represent, the two of them, 11% roughly of the S&P 500.
Yeah, and they also are two of the big drivers of overall earnings growth. That's something that sometimes gets missed too. These big companies, yeah, they've led the performance. They're also delivering a lot of the absolute dollar value of the profit growth. When it comes to Alphabet, you mentioned some of the kind of the good and the bad that might be expected here. Maybe a little softness in digital advertising, but then I think the market's kind of gone in every direction in thinking about Alphabet and its positioning around AI. On the one hand, its core search business is like the most profitable business in the history of man, so anything else it does outside of that seems dilutive. On the other hand, they need to have a convincing strategy, and the valuation is not kept up with some of the peers. So how are you thinking about the risk reward there?
Yeah, so you make a good point. So Alphabet trades at a slight premium to the market, 22.5 times 24 earnings. Now, that growth, we believe, is at least double that of the S&P 500, which sells for 20 times. Therefore, we think that the stock is still attractive. Of course, there is this risk that people will use AI for search and they won't use Google, and therefore advertisers won't give them all of the revenue. Revenue at Google is $306 billion for the year. Last year, the entire U.S. medical device industry is $200 billion. So we're talking about one of the largest enterprises in the world, and we expect to see, of course, some interest in whether they're going to lose market share. We don't think that that's going to happen now, and they've been on it. They've been on AI for a decade. Remember, they started making investments many, many years ago in artificial intelligence.
And I guess just quickly before we finish up, you mentioned the S&P 500 is now at 20 times earnings. It's up 20% exactly from the low in October. Does it feel as if that makes sense here, given what we know about the Fed and fundamentals, or are we ahead of ourselves?
Markets move with momentum, and they move ahead of themselves, and then they get behind, where they ought to be realistically. This has been a very solid market because everything's working. Lower interest rates and lower inflation, interest rates that are peaking, and we're seeing some pickup in GDP, correct? So we don't feel it out of line. Do we think that these companies have to perform? Yes, they do. They are leading. They are leading the charge. People are bringing their money back from money market funds into the stock market, but we have to see results, and earnings beginning today over the next few days are going to tell us whether that's warranted or not.
Yeah, this is when it really begins, actually. Carrie, thanks so much. Appreciate the time this morning.
Thank you, Mike. Take care.
When we come back, IBM's message to managers still working from home: move near an office or find a new job. We've got the details on that story next. And later, we will talk Middle East tensions and oil and gas prices with White House Energy Advisor Amos Hochstein. Squawk Box will be right back. Well, some serious moves to get workers back to the office. IBM sending a company-wide message to managers who are still working remotely. Move near an office or leave the company. That's according to a memo sent earlier this month that was viewed by Bloomberg. It said all managers must immediately report to an office or a client location at least 3 days a week, regardless of current work location status. And it said it's going to be using badge access data to take attendance. Those who don't live close enough to commute are required to relocate by the beginning of August. That memo said face-to-face interactions make workers more productive, innovative, and better able to serve clients. IBM said last week that it expects to cut an unspecified number of jobs this year, and maybe one of the most pointed parts of this is targeting managers. It's kind of hard to manage people if you yourself are not in the office, and even tougher for managers who work for home to try and get their employees to work in the office. If you're not in the office, good luck with that.
Yeah, I mean, if a company is on a big kind of efficiency push anyway, you can measure contributions the way you couldn't before. What's striking to me about IBM being the source of this is I remember 20 plus years ago, IBM was very early in, you know, that hoteling trend where you kind of didn't have a base office. You just kind of went where you had to go, clients or another IBM office. And also the kind of no set vacation days, no set sick days. They were trying to be very flexible in terms of workplace setup way before the pandemic.
Look, this is something I think we said for a long time, that all the work from home stuff would be great and would be allowed until you had a tighter labor market.
Exactly.
And if you were looking at layoffs, we've seen time
Or a
and time
softer
again.
labor market,
Or a softer, if you're looking at layoffs, those are going to be the first people you target because it's easier to lay somebody off who you don't see every day and have interactions with. And they're going to be the last ones to get promoted. This may take a long time to work its way out. And I'm not saying everybody's going to work from home for forever.
Right.
I think people who are highly sought after will still get to be able to bend the rules. And when you're, or if you're, let's say, a charitable foundation and you're not paying people as much. It's part of your compensation.
When I was here not long ago, didn't we have the CEO of Hain Celestial on talking about how they were making it their kind of competitive advantage in recruiting is allowing you to work from home. So some companies are going to go the other way and say, well, we're happy to have you do it.
Rather than a pay raise, I'll let you do these things, and we want to make sure we attract that talent. It's a good way to do it because people have gotten used to the flexibility, particularly if you have kids at home.
For sure.
But
IBM saying move in 6 months toward commuting distance, maybe bring some existing home sales back on the market. That's probably good. All right, coming up, earnings alert. We're awaiting results from GM, JetBlue, and Pfizer. The numbers and market reaction straight ahead. As we head to a break, a look at yesterday's S&P 500 winners and losers. General Motors reporting quarterly results. Let's get to Phil LeBeau with the numbers. Morning, Phil.
Good morning, Mike. This is a beat on the top and the bottom line in the fourth quarter for General Motors, earning $1.24 a share. The street was expecting $1.16. Revenue well above expectations, coming in at $42.98 billion. The street expecting $38.67 billion. Remember, in the fourth quarter, you had the UAW strike and a number of adjustments the companies made after it. So keep that in mind as we go through the fourth quarter numbers. Free cash flow, $1.3 billion versus the estimate of versus $4.4 billion a year before that. EBIT adjusted income, $1.75 billion versus $3.79 billion the previous year. The EBIT adjusted margin, 4.1%, down from 8.8% in the fourth quarter of 2022. North American EBIT adjusted margin of 5.7% versus 10.3% in the fourth quarter of 22. One important note regarding China, the company's China equity income in the fourth quarter, $93 million. And we'll talk about China and what GM is expecting in the first quarter as part of its guidance here. For 2024, the company's EPS guidance of $8.50 to $9.50 is well above what the street's at. The street's at $7.87 right now, with EBIT adjusted income expected to be $12 to $14 billion this year. Free cash flow for the auto division, $8 to $10 billion. The company is still saying that it expects to be EV profitable in the second half of this year. That's an important benchmark they're putting out there. Also, they are expecting a loss in the first quarter from their operations in China. That speaks to growing inventory and a market that is slowing down overall. Bottom line is this, guys. They are expecting lower pricing and pricing headwinds and higher costs, but General Motors in the fourth quarter beating the street on the top and the bottom line. Don't forget, we're going to be talking with GM CEO Mary Barra coming up on Squawk on the Street. We'll talk about not only the fourth quarter, and yes, there were a lot of puts and takes there with regard to coming out of the UAW strike, but it's the guidance for this year and the guidance with regard to certain things, China, cruise, the expectations for pricing, all of that we'll discuss on Squawk on the Street coming up a little after 10 o'clock this morning. Guys, back to you.
Yeah, Phil, we'll see if the street embraces the guidance for this year and feels like it's, it's plausible. It'll be an interesting conversation. Appreciate that.
Yeah.
Okay, JetBlue just out with its earnings as well, and they're reporting an adjusted loss per share of 19 cents. That is narrower than the 28 cents that the street had been expecting. Revenue a little better too, $2.33 billion versus the $2.28 billion the street had been looking for. Some comments on this where they're looking to 2024, and these are comments from Joanna Garrity, who is the president and COO, who's going to be the incoming CEO. She's kind of painting this next year as an important year of change, where they say they're taking aggressive action. They're going to be launching $300 million of revenue initiatives to try and return to profitability and deliver value. They talk about how for this outlook, they are first of all, just their balance sheet and liquidity. These are things you need to pay attention to here. They reached an agreement to defer $2.5 billion of planned aircraft capital expenditures from 2024 this year to 2027 and 2028. And so that's going to push off some of the costs, and they say allow annual aircraft deliveries through the end of the year. But really, they're talking about deferring the costs on this. They end the fourth quarter with $1.7 billion in unrestricted cash, cash equivalents, and short-term investments. For the outlook for 2024, she says we're seeing positive momentum in our revenue growth. Demand during peak periods remains strong, and they continue to manage their capacity during off-peak periods to reflect evolving demand trends. I don't see a single word in here about Spirit Airlines. Yeah. For anybody who was looking for some hints of what they might do next, that's been the big question. Phil was talking about this yesterday, where Spirit in its filing came through and said that they are very much going to fight and continue to believe that this merger is the right thing. JetBlue demurred on that, said, hey, we're basically studying our options on this, and there are some battles about what happens next after the judge's ruling on this. For the first quarter and full year 2024 outlook, they're talking about available seat miles down 6% to down 3%. Revenue year over year down 9% to down 5%. What else do we see here? Fuel price per gallon, they're looking at $2.87 to $3.02, and adjusted operating margin flat. Capital expenditures, we just talked about that, $250 million versus the $1.6 billion. But again, the key here, they're not tipping their hand on what they're doing with Spirit. Programming note for you, too, the incoming CEO of JetBlue will be on Power Lunch. That's coming up at 2:30 p.m. Eastern Time in a CNBC exclusive interview. Squawk Box will be right back. Welcome back to Squawk Box, everybody. The Biden administration weighing its options on how to respond to Sunday's drone attack by an Iranian-backed militia group that killed 3 U.S. troops in Jordan. Joining us right now with his thoughts on how to strike back at Iran is retired U.S. Navy Admiral James Stavridis, who is a former NATO Supreme Allied Commander. He's now Carlyle Group's Global Affairs Vice Chair and an NBC News Chief International Analyst. And Admiral, what do you think? What is the appropriate response?
I think what the administration is going to look for, if you will, Becky, is kind of a Goldilocks solution. In other words, what they've been doing, a series of tit for tat, very surgical, precision strikes, that's not working clearly. On the other hand, they don't want to broaden this thing into a major regional war. They're going to try and find something in the middle. So the word I would focus people on is campaign, meaning it's not going to be a one and done at this point. I think you're going to see a week or two of heavy attacks, but not in Iran itself, against Iranian proxies. Probably Iraq, Syria, and Yemen would be the 3 places you're going to see the administration lean in over the next week or two.
You say campaign, and automatically think of an extended war. What are the odds that this does? I mean, we've been talking about this since the very beginning with the Houthi attacks in the Red Sea. What are the odds at this point that this becomes a more protracted war that requires more American boots on the ground?
I think when we started this conversation before Christmas, Becky, we had it at about 30%. Following the big Houthi maritime operations that have now effectively closed off portions of the Red Sea, we were up about 40%. With this killing of American servicemen and women, I think we're probably just under 50-50. Here's the good news, such as it is. Neither side, certainly the Biden administration, but also the mullahs in Tehran, are not looking for a broader war here. As I've said before, they'll fight to the last Houthi. They'll fight to the last Iraqi. They don't want a big, broad regional war with the U.S., and certainly the Biden administration doesn't either. So look for a campaign over a couple of weeks, not a full-blown war campaign, but one that is a sustained series of attacks over the next week or two. And at that point, I think Iran will, in fact, cease and desist from the continuing attacks, and particularly those that target Americans.
If the mullahs in Tehran don't want this, then why haven't they stopped it? Do they have such little power over these groups that they are training and providing weapons for?
No, they have the power to do this. They have organized, trained, equipped, and effectively are directing these operations. The reason is they still see opportunity to do three things. Number one, demonstrate to the world that they are capable of taking on the superpower. Number two, in a time in which Israel is very much looking inwardly, they want to put pressure on Israel and pressure in support, if you will, of the Palestinians. And number three, and you're showing a lot of internal photography right now, they have a domestic audience. They've got problems inside Iran. They see this as a way to speak to their public about how they can rally and fight the Americans. So those three things have occurred. They haven't stopped yet because we haven't hit them hard enough, is the short answer.
Well, then the idea of not hitting them harder seems like it just tempts them to do more. And by the way, we always talk about how this is the government in Iran that's the problem, not the people. But some of those pictures point to a different thought.
Indeed, I think the mullahs are very effectively mobilizing public opinion here, and that's why I think it's unlikely we will strike inside Iran, at least in the short term. What I'm looking for is strikes against Iranian Guard outside of Iran that are supporting, training, organizing these proxy groups, as well as larger level of strikes against the proxy groups. So again, it's trying to find that middle path between the pinprick strikes we've been doing and going downtown Tehran. There's still trade space militarily where I think these operations are going to land.
I'd heard it posited that one potential solution might be to allow the Israelis to do what they've wanted to do for a long time, which is go strike directly in Iran. Wouldn't be us, but maybe we stop telling them to not do it.
Certainly all options are on the table. Working with allies in the region is on the table. Don't forget this recent strike landed in Jordan, one of our closest allies, very good intelligence services. And one other thing we haven't spoken about, Becky, U.S. and its allies could use cyber to go after Iran's economy, its oil and gas. So there are a lot of options on the table.
What about Saudi Arabia? How does it play in all of this?
The Crown Prince, who's effectively leading the kingdom, of course, wants this to die down. He is trying to terminate this war that Saudi Arabia has been involved in Yemen against the Houthis. He's looking for a solution that includes an Israeli ceasefire and at least some steps toward a Palestinian state, and that in turn unlocks the door for recognition of Israel. So to him, Iran is an annoyance off stage. Unfortunately, as Americans are killed, that's amping up. Ultimately, he will be a force for good in helping solve this over time.
Admiral Savitas, thank you. Again, 50-50, odds increasing that this does wound up in a more complicated situation. We hope that's not the case, but thank you for your time, sir.
Indeed.
Pfizer just reporting, looks like a 60-cent loss. That was anticipated as a 22-cent loss. Not sure if that's directly comparable, but that is where it came in. Those are radically revised down over the last 3 months or so. Revenues, $14.2 billion in the quarter, $14.4 billion was the forecast. Perhaps significant, company reaffirming full year 2024 guidance. That was provided December 13th of 2023, so it's a month and a half later. That's for revenues of $58.5 to $61.5 billion, adjusted diluted EPS of $2.05 to $2.25 altogether.
Apparently they are going with an adjusted earnings of 10 cents a share.
Yeah, sorry. So for the quarter just passed, 10 cents a share is the adjusted number. 60 cents includes a lot of those extra items.
What you brought up with the guidance for 2024, that's going to be what the street's really keying off. You can see that stock up by about 1% right here. They do say they're on track for at least $4 billion in annual cost savings by the end of 2024 from all these cost realignment programs that they're working with. So we'll continue to see how that trades, but right now up by about 1%.
Yeah, it's been considered essentially, there was just a lot of messy charges and everything over the course of last year for Pfizer as well as Merck.
With COVID vaccines not selling the way they expected, and that stock down 36% over the last year. When we come back, big technology reports due after today's closing bell. We'll get you ready for Alphabet and Microsoft's reports when we come back. Right now, as we head to that break, check out shares of UPS. That stock getting hit hard after the company earlier this morning reported a disappointing full-year revenue forecast. You can see it's off by about 7.25% right now. Squawk Box will be right back.
Hubble.com.
Google and Microsoft are the first big tech companies expected to report earnings after the bell this evening. Joining us now with what to expect is Barton Crockett, Rosenblatt Securities Senior Analyst. Barton, good morning.
Good morning.
Why don't we start with Microsoft, since everybody seems to sort of pretty much love the story. Seems like you give it a $3 trillion market cap and 33 times PE multiple, because you'd think Microsoft's going to figure it out. They're in the way of all the big trends that are positive, and they're going to be able to monetize it. What in particular, though, would you be looking for out of this quarter to figure out if they're on track?
Okay, and to be clear, I don't cover Microsoft. We have another analyst who does the software names, but I think Microsoft is obviously the table setter for cloud computing, and I think the defining kind of player in artificial intelligence. And I think what we're all really kind of curious about is what is the opportunity for anyone to kind of pick up share in cloud-based kind of artificial intelligence computing from Microsoft, which has been really dominant there. And obviously, all of the noise around OpenAI, just very recently, creates a backdrop where if you ever kind of pick up some share, if you're AWS, if you're Google Cloud, this is when we should see it. So, knock on wood, I think it would be a great backdrop for Alphabet, which reports tonight, if they can accelerate and do, gain a little bit of share relative to Microsoft, which has been tough for everyone to do.
Yeah, now Alphabet, which I know you do cover, do you actually expect that you're going to see net progress there? Because the market's been a little reserved in giving Google credit for being able to exploit all this.
Look, I think that Google's kind of figure it out eventually. I do think they're in a tough place right now where Microsoft has feature set leadership in large language model capabilities. And I think that filters down to people's, usage of the services for cloud computing. So the opportunity is there. I think the capabilities are there. They just need to put it on the field. The fourth quarter, I'm not sure we're going to see it, but I think we'll be looking really closely for some hopeful signs.
And I guess, we're just a couple days away, too, from the rest of these. So Meta right now really has had a journey in terms of, people thinking that they couldn't find their way to all the cost enhancements. And now it feels as if just the momentum, just on the fundamental side, and then stock momentum has taken over. How are they positioned into their numbers?
Well, look, I think we're going through a real seminal change right now in the ad market. Meta has been really powerful. I mean, they're going to put revenue growth up in the fourth quarter, we think, in the over 20% range, like they did in the third quarter. They've been benefiting from these China-based direct retailers, Temu, Shein, advertising, ramping their advertising dramatically. They've been benefiting from investment in AI capabilities that's actually been, we think, resonating, with marketers, help driving, their outsized performance. For Meta, I think the question is not about the fourth quarter, which we think will be great, but what's the sustainability of all these things as we go into next year? And the comparisons get tougher. Will the China direct retail spend continue? Is there a political angle that impacts all of that stuff? With Trump talking about tariffs. So the setup, we think, is great for the fourth quarter. The question mark is as we go into next year.
And if you look across the big ones that you cover, where right now does it seem as if the market is underappreciating any of these, if you see that at all? Because it feels as if we've been giving a lot of credit to these companies for basically being leaders.
Yeah, look, these companies, their stocks have generally done great. I think the market understands that these are strong companies. I still think you can continue to ride greatness. So I think that Alphabet tonight should have some acceleration in search, should have some acceleration in YouTube against easier compares. I think that Amazon coming up in a couple of days is kind of trend really well on e-commerce. I think has got, acceleration in cloud that we're not going to see at Google, but I think we will see it at AWS. So those are two players that I think definitely you want to have some exposure to in this earnings season.
All right. Barton, great to catch up. Thank you so much.
Great. Thank you.
When we return, we're going to talk about this week's Fed meeting with Mohamed El-Erian from Allianz. That is straight ahead. Plus, White House Energy Advisor Amos Hochstein will join us on the rising threat level in the Middle East and the impact on crude oil prices. Squawk Box will be right back. Good morning. Earnings and the Fed in focus for investors after the Dow and the S&P's 6 record closes of the year. Plus, Middle East tensions rising, a breakdown of what it could mean for energy markets with the top White House energy advisor, Amos Hochstein. And a big night in the Big Apple for Nikki Haley. Billionaire backers are throwing a fundraiser for her campaign as she looks to close the gap on former President Trump for the GOP nomination. It's going to be a long road for her. The second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC Live from the NASDAQ market site in Times Square. I'm Mike Santoli along with Becky Quick. Joe and Andrew are off this morning. Take a look at U.S. equity futures. They're coming off a strong session yesterday. S&P 500 was up about 0.75%. Dow up a couple hundred points, just slightly giving back a bit, although the NASDAQ is right around the flat line. The S&P is now up 20% from its intraday low 3 months ago, trading at 20 times earnings, embracing some of the soft landing evidence that we have out there. Take a look at Treasuries. Part of the story yesterday, too. 10-year Treasury yields backing off from, say, 4.14 down to 406 right now after the Treasury Department came out and said it would have to borrow less this quarter than had previously been anticipated. That has perhaps cheered the stock market a little bit as we sit here and the Fed starts its meeting today. Take a look at oil. Was unable to really rally yesterday on some further geopolitical tensions, and you see WTI just slightly softer, under $77 a barrel right now.
And the Fed kicking off its two-day meeting today before the central bank makes its decision on interest rates. Steve Leisman is here. He's going to give us the results of the latest CNBC Fed survey. Hey, Steve.
Good morning, Becky. Yeah, in contrast to the market's aggressive outlook for Fed rate cuts this year, respondents to the CNBC Fed survey see fewer cuts and starting later. Just 9% predict a March cut. That rises to even money for May. Only in June is there a majority of 70% looking for a rate cut, while futures markets have priced in almost 6 cuts. Respondents on average see just a bit more than 3. The Fed is expected to end quantitative tightening, that's the reduction of the balance sheet, by November. Meanwhile, the probability of recession remains elevated, but it's fallen to 39%. That's the lowest level since the spring of 2022. It looks like the 25 respondents on average are forecasting the Fed will cut rates at an every other meeting pace, and that would begin in June. You can see the up and down there, starting in June, then September, and then December. While respondents predict a cautious Fed, on balance, I think the Fed should be a little bit more aggressive. 56% say the bigger risk is that the Fed cuts too late, while 44% say the risk is going too early. Joel Naroff, president of Naroff Economics, says there's little reason to expect a major slowdown in the economy, so the Fed will likely not risk the gains that inflation has made by easing prematurely. Recession probabilities fell for the second month in a row. It fell 2 points to 39% from a high of 63 in November. The probability of a soft landing remains unchanged at 47%. Now, it's fairly typical for this group of Fed watchers, economists, and strategists to be more closely aligned with the Fed's own outlook than with the markets. The question remains, who has this right and how much it matters? By 2025, 2026, the market and the survey and the Fed all converge towards the same 3.3, 3.5% funds rate. But it looks like, guys, there's going to be some back and forth and maybe some tussling along the way. Becky?
Steve, you answered my question. Just who's right? Because I would assume that these economists listen more closely to the Fed than the market does. Which one's right? But I think your final point, just the idea that everybody converges in a year or so. Okay, so we're really just talking about a matter of months before everybody gets to the same place?
Yeah, I mean, look, it's not like it's inconsequential. There are some folks now with some companies out there with some debt that's probably coming due this year, looking at their clock and saying, when is the Fed going to cut? That's going to be significant to the outcome. There's also some hopes out there. There's a big bet in the market right now. And there you can see that convergence over time. By 2025, not much separates them. A bit more separates them this year. There's also, Becky, the lagged effects of monetary policy coming. And a lot of bets out there right now on a steepener. That is that the curve disinverts. So it's consequential near term for some companies and individuals. On a macro basis, I'm not sure it matters that much March, May, or June if the trajectory is in the right direction and the Fed ends up sticking this soft landing.
Here's kind of a wonky question, but how does the Fed think about quantitative tightening, just in terms of that being another tool? Like, the market just looks at this straight up as rate cuts. If the Fed were to look at quantitative tightening and say, okay, we can slow it down a bit, we can speed that up a bit, and does that take away some of the impetus for needing to cut rates, because that is pretty important for all these people who are counting for rate cuts to save them?
You know, Becky, I've reported a lot and thought a lot about QT and how much it matters. I think the Fed might be in a particularly good place here. And that's because, unlike in 2019, the Fed has this standing repo facility. And that means if the Fed cuts too much, there's a way for the market to get the reserves it needs on an emergency basis. So I think that protects it to the downside. And I think on the upside, it doesn't matter that much. I'm a little bit worried about my conclusion here, because it suggests there might be a free lunch for the Fed here, something that matters a lot when you're doing quantitative easing, but may not matter as much if you do quantitative tightening and do too much or too little I'm not sure how much that matters because the Fed
That
has
seems
this
to defy
safety valve
the
now.
laws of
and-
physics, right? Like for
Right.
every action, there must be an equal and opposite reaction.
Maybe Mohammed, I haven't talked to Mohammed about this, maybe he's got a thought on it. I know he's coming up, but the idea that they have this safety valve, I think could potentially change the game. It won't be non-disruptive, but it won't necessarily be like what happened in 2019. Keeping it too tight potentially keeping the balance sheet too big potentially risks some asset inflation, but it's very hard for me to draw a line from a balance sheet that's too big to inflation itself.
Right. Yes, it's been always very difficult to try and exactly track the flow there, Steve. And you know, my point of view on this is placebos work sometimes when you're sick. If you're not sick, the placebo doesn't matter. But that's maybe overstating, but that's how I've always thought about it. Steve, thanks very much. Let's bring in Mohammed El, Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Mohammed, I know you heard we were talking about there. I'd love, though, your take, bigger picture. I mean, as the Federal Reserve officials get together today, they have to be feeling pretty good in general. I mean, the economy's holding up better than they had anticipated. Inflation has come down even a bit faster than they projected. And even if we're talking about when they might start rate cuts, it's in the guise of normalization and it's not an emergency. So how are you thinking about their job this week?
So you're absolutely right. They're going to welcome the reduction in inflation. They're going to take a lot of comfort from the fact that it didn't come at the cost of growth. The U.S. economy has been exceptional, and the Eurozone data today reminded us of this U.S. exceptionalism. They're also going to say that their job is not done, and they're going to maintain optionality. And most importantly, I think they are not going to validate the notion that rates are coming down in March. They're going to keep their options wide open. That's where they're going to end up. That's the committee. What's interesting is what the chair is going to do during the press conference, because we've seen in the past, the chair does sometimes diverge from the committee. So it'd be really important to listen very carefully to what the chair says.
For sure, Mohammed. Although I do think that the market, I mean, to the degree to which we want to, make something out of this perceived gap between how the market is positioned about rate cuts and what the Fed has been saying. I mean, if you just stack up all the things we know about how the Fed has said it will respond, you have a 5 3/8 Fed funds rate right now. Inflation is way below that. They've talked about how that represents a restrictive policy, even if we're not really seeing it in the economy. We've had this 6-month average a lot of people are seizing on of core inflation being very close to target. And so all those things put together, and Powell has said, yeah, of course we're going to be cutting before we get to target. So I guess the question is just exactly how much work do you think he'll even try to do to talk the market in a different direction?
It's hard to tell. Predicting him even within the same press conference is tricky. So it's hard to tell. But you're absolutely right. They have the scope to cut rates. I don't think it's going to be as aggressive as the market thinks. Exactly where the consensus is in the survey that Steve shared with us. Why is that important? Yes, we all end up at the same destination in 2025. But remember, we've become a single issue market. Our focus on the Fed and our focus on the Fed loosening liquidity conditions has allowed us to sideline all sorts of other issues, including geopolitical risk. So where this comes in is can we continue to rely on our focus solely on the Fed to sideline all these other issues that are mounting on the sideline?
Are we really a single issue, though, in terms of the pacing of the Fed rate cuts? Because, we were at, close to 90% for a March rate cut right after the previous Powell press conference. We're down to a 50-50. Risk markets have done well since then. The economy hasn't missed a beat. In fact, if anything, we're getting the impression that the economy has been a lot more resistant to higher rates. I mean, look, investment grade yields, they've had their effect. They're above 5%. They were nothing a while ago. You would think this would start to bite, but it's not really doing it just yet.
Right, and there's this big debate, Mike, between flow versus stock. If you focus on the flow, then you would be incredibly optimistic about both the economy and the markets. Inflation is coming down, interest rates are coming down, affordability for consumers is going up, corporates can refinance much more easily, ample liquidity. The flow side is really encouraging. We just have to manage the stock. And the stock is first the lagged effect of the rate hikes. Second, the fact that you have certain asset classes that are slower moving in acknowledging their changed circumstances. Think of commercial real estate as one, but there's others. And then third, we have a maturity wall coming up on the corporate side. So what we're going to see this year is this tug of war between favorable flows and challenging stock. And that's how it's going to work out. Now, if you can bet on the Fed accommodating the situation, which is what the market is saying. The market is saying they're going to cut early, aggressively, so we're going to be able to deal with the stock. If you can bet on that, then your outlook becomes much more positive than otherwise.
Yeah. We will see exactly how they couch it. Mohammed, always good to talk to you. Thank you.
Thank you, Mike.
Still to come this morning, the conflict in the Middle East and the Biden administration's efforts to prevent a regional war. The president's top advisor on energy, Amos Hochstein, will be with us next to talk about energy prices and how they're likely to fare in all of this. Right now, though, as we head to a break, take a look at Bitcoin this morning. 43,685, up by just over $580. Squawk Box will be right back.
Thuma.
Now, for the latest on U.S. energy policy and geopolitical risk, we have Amos Hochstein. He is the senior advisor to the president for energy and investment. And Amos, thank you for joining us this morning. We've been talking this morning about how surprising it might be to see WTI at $76 a barrel, given all of the conflict around the globe, and particularly what's happening in the Middle East. How do you kind of survey all of this? What's the conclusion you come to as to why this is?
Well, good morning, Becky. It's good to be here. Look, I think that we have a number of conflicts, right? We have the Russia-Ukraine war that's been going on for a couple of years, and now the war in the wars in the Middle East. But I think at the end of the day, the fundamentals are that demand and supply are well balanced. There's been a huge increase in supply from the United States, from Brazil, Guyana, et cetera, and the demand is holding. So I think that the specific issues in the Red Sea are a logistics concern, a logistics cost, but there are alternatives. So first, not that significant amount of oil goes through that particular part of the world. And of that, some still continues to go through, and some is going around the other direction, which costs more, but not significantly enough to make it into a price per barrel on a global basis. And the availability of ships is what is really making the concern or marking the concern for most companies. So it's this logistics, both logistics cost and a bit of a headache of managing it, but there are alternatives, and we're working with the industry very closely to be able to mitigate the challenges that we're seeing, and I think that's why you're seeing that reflected in the price.
There have been lots of pieces written, lots of speculation about what this war could potentially mean in the Middle East. Is this a return to the 70s type of situation where if you were to choke off a fifth of the world's oil in this supply-demand curve, what that might mean for global prices, for the inflationary spiral? Again, looking back to the 1970s. So how do you game that out? What are the odds in that situation, and what are the scenarios that you plan if that were to happen, if something like that were to start?
Well, I think let's take that apart a little bit. The scenario that we're really looking at is what the United States is trying to do together with our allies in a coalition is to do a few things. One is to make sure that the conflict in Gaza does not expand to other conflicts within the borders of Israel. So not expanding to Lebanon and Syria and so on. There's great efforts to do that. We have made clear that we think there is a window for diplomacy here and to prevent that kind of an escalation.
Yeah, just on that point, Amos, we had former Admiral Stavridis on this morning. We've been talking with him since this began, back before Christmas, and he's been kind of weighing the odds of an extension and expansion of this. When it was just the Houthis attacking things in the Red Sea to begin with, he was saying maybe 30% chance this expands into a much bigger problem in the Middle East, something that's a little more intractable in the United States, winds up getting more dragged into. He said this morning that it's closer to a 50-50 situation based on the turn of events.
Well, I don't know how to put percentages, and I'm going to let the Admiral do the percentages. I think at the end of the day, we saw many people thought that this was going to expand further from the beginning and have impacts on markets. We're trying to make sure that the war, as I said, the conflict in Gaza stays in Gaza. Clearly, the Houthis are attacking the Red Sea, but let's be very clear. That is not an attack on Israel or an attack on the United States. That is an attack on global commerce, on the freedom of navigation, and commercial shipping. And that's why the response has not been an American response. It's an American-led response, but it is together with a growing coalition of many countries that are participating both in the sanctions and diplomacy, as well as in the military actions against the Houthis. And we will continue to do that in order to secure the Red Sea. And
the attack in Jordan was an attack on American troops, the first troops that we've lost in this. Not only 3 soldiers who were lost, but dozens more who were injured pretty severely.
No doubt. And all of us, yours and mine, and everyone, every American is feeling for the families of those who were killed, and as well as to the full recovery, hoping for the full recovery of those who were injured. And we will respond as we said yesterday, we will respond to that attack. But as far as your original question on the Red Sea affecting the commercial space, look, on Friday, a ship was attacked. It was aided by ships from the U.S., the French, and the Indian Navy. It was carrying Russian fuel. It was owned by a European company. And so this is not about Gaza or about the United States. This is the Houthis, a terrorist organization that is threatening global shipping. Now, the most important thing is that we take measures both militarily against the Houthis, which the United States is doing and has been doing and will continue to do if necessary, while at the same time making sure that there are alternatives to the shipping route and that it doesn't expand further in that region. And that's why what you're seeing, Becky, is that I don't see the price being reflected. I see the price reflection in the oil markets as accurate. It has not gone up all that much. It's gone up a couple of dollars a barrel since the beginning. And I think that's because while at the beginning there was a lot of concern about what this means for availability for crude and what this means for actual crude prices, I think we now know that that is entirely manageable, and it's just a matter of rerouting the cargoes and the tankers, but not really affecting oil prices or any of the other commodities and other cargo shipping.
Amos, you've said in the past pretty frequently that the lesson we should take away from the Russia situation is not to not rely on Russia for natural gas. It's to not rely on any single country, any single supply, to make sure that we are diversified. And if your point is that the reason prices haven't come up is because supply is so good, why would the administration push this order to halt LNG additional shipments or additional plants being built to ship out LNG? Because that seems like a way of cutting off a supply that has been a godsend to the LNG market and everywhere we're sending it.
So first, let's really clarify. One, we just became the largest exporter of LNG in the world.
Right. Which is a huge point of pride.
It is, and it is something that has supported our European allies and other allies around the world, and allowing for the economy to both diversify and to have lower cost. Second, within the next 3 to 4 years, Becky, we will double our exports from the United States. That is not in question. That is going to happen. It's already, these are plants that are under construction. So at a time when you're the leader and are about to double within 3 to 4 years, it is the right moment to take stock and say, I have to look at three things. I have to look at what are the economic implications? What is the market need growing further into beyond 2030, 2035? And I have to look at what are the environmental impacts that this kind of a massive expansion is going to have. Not to stop the doubling or the expansion that is already underway, but rather slow down the process for a while to do a study when we're already on marching in order to get to this doubling of our capacity, while Qatar is also expanding its capacity to export. So the market is going to be very well supplied. We're going to have to see if it's oversupplied or not. That's what the study is there to look at. We're going to have to see what those environmental impacts are, and we'll have to see what the impacts economically of the United States are. But I think that we're in good shape and not threatening the supply, neither to our allies nor to the rest of the world, and making sure that we remain a well-diversified gas market, and most importantly, a diversified energy market. And I'll say one last thing. Becky, we can do two things at the same time. We can accelerate our focus on energy transition, while at the same time we can make sure that the world and the United States are well supplied with affordable and available supplies.
Look, I'm sure the companies that have already gotten grandfathered with their plans are maybe grateful, even if they don't say it out loud, because it makes their facilities more valuable and will give them the potential to be able to raise prices down the road, too. Amos, this is a longer conversation, but I truly appreciate your time, and I hope we get to see you again soon. Amos,
yeah, and Becky, I'll say natural gas prices are down since the decision. So I think the market is for what it is.
Okay.
But be with you. Thank you, Becky.
Almost, thank you. We'll see you later. Bye-bye.
All right, still to come, a look at this morning's pre-market movers. We'll be right back.
Welcome back to Squawk Box. I'm Dominic Chu. Let's get caught up on some of the big earnings headliners of the morning so far. We'll start with UPS. Shares of the package delivery and transportation logistics giant are down right now 7% on nearly 100,000 shares of volume after it reported mixed results, profit topping estimates, revenues were a miss. Revenue declines were in year over year in each of UPS's key operating divisions, driven largely by lower average daily volumes. It also gave a full year forecast that fell short of expectations. UBS, though, did announce a modest increase to its quarterly dividend payment, so on balance, down 7% for UPS. Also on the transportation front, shares of JetBlue are just down roughly 1% or so, maybe 1.5% at this stage. The budget-friendly airline reported quarterly profits and revenues that both topped consensus estimates, thanks in part to what it sees as positive momentum in revenue growth, as well as stronger demand during peak travel periods. We will get more on that story later on today, when incoming JetBlue CEO Joanna Garrity joins Power Lunch for an exclusive interview. Must watch 2:30 p.m. today. Moving on to healthcare, Pfizer is up over 1% on nearly 500,000 shares of volume. The pharmaceutical giant, perhaps most known these days for its COVID vaccines and treatments, reporting mixed results. Profits a beat, but revenues narrowly missed the mark. The full year forecast was also below estimates, so those shares just up about 1%. And we'll end on General Motors, which is up over 8% on over 600,000 shares of volume. The automaker easily topping estimates for profits and revenues. Its forecast came in stronger than some analyst estimates as well. But China, its second largest market, remains a focus as results in that segment continue to see declines. We will get much more on that story when CEO Mary Barra joins the team on Squawk on the Street later on in the 10 a.m. hour this morning. Becky, a lot of CEOs, a lot of movers. I'll send things back over to you.
Okay, Dom, we'll see you in just a little bit. In the meantime, a big night in New York City for billionaire donors and Nikki Haley. We'll preview that event and talk about the GOP nomination race next. Squawk Box will be right back. Welcome back, everybody. Tonight, Wall Street billionaires from Stan Druckenmiller to Ken Langone are co-hosting a fundraiser for Nikki Haley's presidential campaign in New York City as part of her fundraising efforts leading up the primary in her home state of South Carolina. Joining us right now is Puck's Teddy Schleifer. And Teddy, this is a pretty long road. She may still be able to get some money from the billionaire class at this point, but her route, her path to getting to the nomination looks pretty difficult if she doesn't pull off some huge upstate in her home state.
Sure. I mean, all these fundraising events she has over the next 2 weeks, which are 17 events, which begin tonight, or began last night in New York, are all based on the premise that money is going to matter here, right? Which is obviously highly disputable, to say the least. But her belief is that she needs to raise a ton of money to do well in South Carolina, and then really to do extraordinarily well, or at least be extraordinarily competitive on Super Tuesday. And these are, a bunch of contests across the country right after South Carolina where money really could matter. Because Nikki Haley's going to need to go up on TV, she's not going to have time to campaign in, say, Texas or in other kind of expensive Super Tuesday states. So the relationship between the fundraising and her path, as you're pointing out, is tenuous, but it's sort of a necessary but not sufficient. She needs the money to compete, but obviously that's not all she needs.
Right. She was actually with us yesterday and said that if the former presidential candidate can't pull 50% or more, if he's losing 50% of the vote, that's not great for the top of the ticket. And that's certainly been something that the Koch network has pointed out too. Koch, K-O-C-H, not C-O-K-E. Yeah. But the Koch network looks like they are refocusing a lot of their money on the Senate races at this point. How important, how key is that?
The Koch network this past weekend near Southern California had hundreds of their donors out to their kind of semi-annual retreat, and they told them that basically the obvious, that it's an uphill climb for Nikki Haley. They said that they are focusing on preventing a Democratic trifecta. They don't want Democrats to take the White House, the House, and the Senate, and they believe in their internal polling that Trump is a loser, that Trump is likely to lose to Joe Biden in a rematch. Obviously, that internal polling that Koch is referring to is at somewhat of a discrepancy with public polling, which shows Trump to be pretty competitive. But their argument is, if Nikki Haley is not the nominee, then we need to prepare, the House and the Senate to make sure that they're not taken over by Democrats as well. So I don't necessarily think they're refocusing their money. I think they're just reading their own polls, seeing Trump as uncompetitive at the top of the ticket, and saying, hey, we don't want Democrats to run Washington entirely. How can we focus on achieving split government? But, look, no one that supports Nikki Haley at this point honestly thinks that she has a strong chance of being the nominee. That was just ludicrous at this point. But is it 10%, 20%, 30%? Reason people can disagree, but it's certainly not 51%, and that's why people have to prepare for down ballot.
You look at the situation this year where most voters say that they don't want either former President Trump or President Biden to be on the ballot this time around. And you'll have people from both sides saying, look, something could happen. One or both of these guys could get knocked out or decide to bow out one way or another. Is her staying in it through Super Tuesday kind of a Hail Mary pass, thinking if the lawsuits catch up with him, if the indictments catch up with him, if there's something weird that happens, maybe if she's still standing, she would be the nominee?
Sure. There's an element of unpredictability, obviously, with what's going to happen between, Trump, quote unquote, securing the nomination and Trump actually accepting the Republican nomination at the convention. But, I think at that point, I don't know if it's really going to matter who's technically the other candidate in the race. If there are any other candidates in the race to begin with. That would be such an unprecedented situation. I think, it's going to come down to who has support of kind of party leaders, who has support of President Trump. I don't necessarily think that the kind of the bank shot strategy here, that where you're hoping for kind of something crazy to happen, really necessarily means you stay in the race. I think at that point, anything would be on the table.
Former President Trump has said that he is going to shut out anybody who continues to support Nikki Haley at this point. And I just wonder, with these billionaires holding this fundraiser today, what the future for business is under either one of these administrations. There hasn't been a really tight relationship between most of the business community and the Oval Office for quite a while, it feels like. There's not a natural home in either of these parties. What does that mean?
Yeah, one of the hosts of tonight's event, Cliff Asness, who was on the screen a second ago, is a major Haley supporter. I believe has donated millions to her super PAC, and he saw the Truth Social post that Trump put up the other day, where he basically said these people are going to be quote unquote barred permanently from the MAGA movement and from the Oval Office. And Cliff said, on Twitter that. He was going to donate more money to Nikki Haley because he wanted to be barred permanently. Look, I mean, it's no surprise that, the billionaires of the Republican Party are not in touch with the base voter of the Republican Party. But what's clear, has been clear since 2016, since Trump sort of became a candidate, despite not having all that support from those wealthy Wall Street types, is that these people don't really matter as much as we think they do. I know that's, somewhat depressing for people who cover these people to say and to hear. But
no, I hear
Cliff Asness said he was doing this he was supporting Nikki Haley to save the country, and I'm sure he genuinely believes that. And he just actually interestingly described his bet on Haley as akin to venture capital, that had a high chance of waste, but a low chance, a non-zero chance of saving the country. That's what these people genuinely believe. The voters of Iowa and New Hampshire disagree, and they're ultimately who decides, not Wall Street.
Honestly, the billionaire class has never been very effective at picking the next winner. It's been a long time, at least, where their choices early on don't really make their way in. Maybe it's just proof that just because you're really good at one thing doesn't necessarily mean you're going to be a master of the universe in a different field.
This is not the era of Bush or Romney were sort of establishment favorites who, Romney, of course, kind of came from this economic stratosphere, and Trump has sort of showed these people's lack of power, and it's been humbling, I think, for lots of people that I cover.
Yeah, maybe we should call them masters of the universe, masters of one field, potentially. Teddy, thank you.
You bet.
All right, coming up, we break down Pfizer results and get an outlook for the sector, from possible mergers and acquisitions to innovative therapies, what investors need to know. As we head to a break, take a look at the pre-market winners and losers in the Dow. Microsoft leading the way ahead of its results after the close. Squawk Box will be right back.
Never boring.
A big Managed Funds Association conference is taking place in Miami this week. CNBC has obtained the details of a new short that a fund investor will present there this afternoon. Eamon Javers joins us with all the details. Morning, Eamon.
Yeah, good morning, Mike. Adtalem Global Education is a $2 billion for-profit education company, and now it's attracting the attention of noted short seller Fahmi Kadir and her firm Safket Capital Management. In a report that Kadir will release later today, she pronounces the company to be uninvestable. The report, obtained exclusively by CNBC, describes the education company's business model, which depends in part on receiving federal student loan dollars, as parasitic. Kadir tells CNBC she has a short position in the stock, meaning she's betting that the stock will decline.
And I feel that everyone should be angry that our money is being abused in such a careless kind of way. And what do the executives of these for-profit universities do? Well, they pay themselves very well, and they also buy back plenty of their stock.
Now, in a statement, a spokesman for Adtalem said Adtalem provides quality educational programs that aim to prepare our students for gainful employment and are a good return on investment for both our students and U.S. taxpayers. Kadir's criticisms are focused on several key areas of the company's financials. She says the company's Walden University unit has not disclosed it is the subject of a Department of Education investigation into its doctoral programs. She points out that the company's financial responsibility composite score was lowered in September to a rating of 0.2, which could affect the company's ability to receive federal student loan funds. She also notes that the Biden administration is reinstating the so-called gainful employment rule, which rates student outcomes. She predicts that many of the company's programs will fail that test. She also questions the company's accounting for assets of its Walden University unit, particularly that the school's student loan eligibility and accreditations are worth nearly $500 million as, quote, intangible assets. A spokesperson for Adtalem responded to each of her points, noting that the Education Department investigation does not accuse Walden of any wrongdoing, and Adtalem is fully cooperating with the department's request. The company expects the vast majority of its programs will pass the gainful employment rule, and the company says if a program is unable to meet the GE standards, we'll have an opportunity to make adjustments in order to maintain eligibility for federal student dollars. As for Walden's intangible assets, the company says, we are confident in the accuracy of this attribution, and as a publicly traded company, Adtalem is audited by PricewaterhouseCoopers. Now, a Department of Education spokesperson did not respond to our request for information about the department's policies. Fahmi Kadir, as you said, Mike, will be making her short position public in a speech in Miami later today at the conference organized by the Managed Funds Association. And don't miss Fahmi Kadir of Safkhet Capital Management today on Halftime Report at 12:30 in an exclusive interview. Back over to you, Mike.
Yeah, Eamon. Now, it's interesting because for-profit education, going back a bunch of years, has been a controversial area on Wall Street. A lot of people scrutinizing the business models, the dependence on student loan flows and things like that. There have been some blow-ups in that area. But I'm interested in if you could just lay out for some background on Kadir and why people listening to her. I mean, I think she's been short things like Wirecard, which turned out to be obviously, exposed as frauds.
Yeah, her biggest short that she's well known for was Valiant Pharmaceuticals. She earned the nickname in some quarters, the Assassin, for her short selling. She is somebody who is just 33 years old. She is an up-and-coming player in this space, really making a name for herself. She was featured in a Netflix documentary about the Valiant Pharmaceuticals situation. So she's gotten a lot of attention at a relatively young age. This is her next big play. She gave it to us exclusively. And what she's arguing here is that this particular university is facing sort of a funding crunch as it gets closer and closer to the razor wire of these Department of Education rules about access to federal student loan dollars. And if they aren't able to get over those hurdles over the next year or two, access to that funding could be severely restricted. They could have to go out to the market for new letters of credit. They could have to raise money, all those things that indicate that they might be in a real funding squeeze going forward. Of course, as you saw in our piece, the company denies all that and says that they're in solid position.
And just to point out for anybody who's listening on the radio, whether than watching this, Adtalem shares right now down by about 11% on this news after being up 38% over the last year.
And they've been on a real tear over the past year, and we'll see what happens today, right?
For sure.
Thanks, Eamon. When we come back, Pfizer reporting earlier this morning, we will run through the numbers and talk about that sector. The futures this morning are in the red. Shares of Pfizer up by about 1/3%, but the futures overall are looking for a slightly weaker open. Dow futures off by about 56 points, S&P futures down by 6.5, the NASDAQ down by about 15. Squawk Box will be right back.
Pfizer reported earnings this morning of an adjusted 10 cents a share. The street was expecting a loss of 22 cents. That was on revenues of $14.25 billion. That missed estimates. Pfizer also reaffirming its guidance for the full year. Joining us to break down the results is Jeff Meacham, Bank of America Securities Senior Pharmaceuticals Analyst. Jeff, it's great to have you on here. It seems as if, obviously, braced for kind of a messy quarter. The company had more or less indicated where things would come out. What you see in the numbers of some detailing of some expected cost savings, and the company did reaffirm 2024 guidance.
Thanks for having me, Mike. Yeah, so you're right. I mean, I would say Pfizer beat, what I would call sort of a lower bar. There were a couple main products that missed, for example, Prevnar, Ibrance. But overall, though, I think the story is still about, COVID contraction and whether that matters to investors going forward.
And what's your take on whether it should matter to investors going forward? It feels as if the market is not really valuing that business all that aggressively at this point, if at all. It's obviously the valuation's depressed. I mean, what do investors want to look ahead to in terms of trying to figure out what the earnings power of the company is going to be?
Yeah, great question. I would say for sure the new launch portfolio, there are a number of new products, including the RSV vaccine that I think are pretty exciting. Also, Pfizer just closed the Seagen deal, and I think going forward, that product, that portfolio, I suspect will lead to some pretty nice upside going forward. But I think for COVID, though, really it's about life cycle management. It's going to be a continued erosion, I suspect, but there are ways to help stabilize that business, just with respect to including a flu vaccine together with the COVID product portfolio. But really, it's all about new products and new launches.
And in terms of Pfizer's product portfolio right now and things that are in development, is there kind of enough to latch onto, or they're going to have to do more M&A? How would you assess it?
Yeah, I suspect there's going to be marginally more M&A going forward. They have some interesting product categories. They just rolled out an oncology segment, or sort of restated their business, and so that's going to be the main focus going forward. Products for blood cancers and solid tumors. I suspect that is going to be a main focus for investors. And then there are some assets that they acquired through various deals in inflammation. There are some exciting therapeutic categories to come, but really it's about commercial execution going forward.
Big Pharma obviously had a kind of a rough year last year outside of Lilly. I mean, outside of anything related to the weight loss drugs. How are things set up right now, based on what we've heard either from J&J, now Pfizer? What's your preferred play in the group?
Yeah, I would say nominally better backdrop for this year for major pharma in big cap biotech. The Inflation Reduction Act was really in the headlines a ton over the past couple of years, and this year there's not a lot of headwinds from that perspective. From a growth perspective, our favorites are Lilly and Merck in big pharma, and then Vertex and Gilead in biotech. Those are our favorites. We're kind of sticking with mostly the growthier names for this year, but in an election year, though, no one really loves the space, and so I think it's better to stick with kind of the faster growers that have their own fundamental story and not are solely dependent on kind of the macro.
Yeah, fair enough. Jeff, thanks for the time this morning. Jeff Meacham.
Thank you.
All right, still to come this morning, what investors need to watch as the Fed gets ready for a two-day meeting that begins today. We will talk rates and when the Fed may cut. And later, Ways and Means Committee Chair Jason Smith on the latest tax bill that's making its way through Congress. Squawk Box will be right back.
Good morning. Earnings alert. New reports flooding in from America's biggest companies. UPS, Pfizer, General Motors, and more. Highlights straight ahead. The Fed in focus. The U.S. Central Bank kicks off its latest policy meeting today. We'll talk investor expectations and what the market wants to hear from Jay Powell and company. And a milestone for another one of Elon Musk's companies. This one having to do with the human brain. We'll bring you the details on this news as the final hour of Squawk Box begins right now.
Good morning, everybody, and welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Mike Santoli. Joe and Andrew are out today. We've been watching what's happening with the markets, and there is a little bit of weakness this morning for those U.S. equity futures. Dow indicated down by about 55 points. S&P futures are down by about 7. You've got the NASDAQ indicated off by about 20. Also been keeping a close eye on Treasury yields. This has been a pretty interesting 24 hours, less than that. It was 3 o'clock yesterday afternoon. Mike was pointing out when we first got this news that the Treasury Department may need to sell fewer Treasuries than had been anticipated. You can see the 10-year right now yielding 4.07%, the 2-year at 4.32%. And then you've got crude oil prices that have continued to stay down. WTI is at 76.25. Brent's below $82 a barrel now. This is coming despite all of that tension in the Middle East and concerns about what happened next. We'll continue to watch it. It's also a big morning, though, for corporate earnings. And Don Chu has a look at some of the highlights. We had a lot of reports that came out at the 6 a.m. hour, Don.
Yes, ma'am, we have. So here are some of the big earnings highlights and headlines so far this morning, Becky, to that point. We'll start with the big gain in shares of General Motors, which are right now up over 7%, almost 7.5%, and that's off the pre-market highs. Over 700,000 shares of trading volume. The automaker reporting quarterly profits and revenues that both beat consensus estimates. It also gave a full-year outlook that pointed to continued strength in 2024 and generally came in better than forecast as well. The weakness in GM's second largest market, which is China, continues to be a focal point for management, so GM shares up 7.5%. Next up, on the drug side, we got Pfizer, which is hardly higher by just about 0.5% right now, over 500,000 shares of volume. The company, perhaps best known these days for its COVID vaccines and treatments, actually reported mixed results. Surprise profit per share on slightly worse than expected revenues, and its forecast came in below consensus estimates. But the positivity resulted in its COVID treatment business, which is still declining year over year, actually came in better than expectations, hence the marginal positivity up about nearly 0.5%. And we'll end with the big drop in shares of UPS, which are down at this point roughly 7%, just around 130,000 shares of volume. The package delivery and transportation logistics giant reporting mixed results as well, profits topping estimates while revenues were a miss. Revenues declined year over year in each one of UPS's key operating divisions, driven largely by lower average daily volumes. It also gave a full-year forecast that fell short of expectations. But on the positive side, UPS did announce a modest increase to its quarterly dividend payment, Becky, so those shares down 6.5% roughly. I'll send things back over to you.
Okay, Don, thank you. We'll see you a little later.
All right, among today's other top business stories, Elon Musk says his startup Neuralink implanted a device in a human for the first time this past weekend and that the patient is recovering well. Musk made that comment on X. Neuralink is developing a brain implant aimed at helping paralyzed patients use neural signals to control external technologies. It raises the possibility that people with severe degenerative diseases like ALS could someday communicate more effectively. Meantime, Boeing says it's withdrawing a request to the FAA for an exemption from a safety standard on its 737 MAX 7 plane. In a statement, Boeing said it was confident the exemption related to a de-icing system would have followed established FAA processes, but it said instead it will work on an engineering solution. Last week, Senator Tammy Duckworth, who chairs an aviation subcommittee in Congress, came out against Boeing's exemption request. And Netflix co-founder Reed Hastings giving away 2 million shares in the streaming giant, currently worth more than $1 billion. That's according to a regulatory filing. The gift was made to an undisclosed entity, though it is known that Hastings has several philanthropic ties. For example, in 2020, he announced he would donate $120 million to 2 historically black colleges and universities. and to the United Negro College Fund.
That's been his real focus, is turning to the
education,
philanthropy and turning to the
Oh, for
philanthropy
sure,
side
yeah.
of things. You know, this has been a big issue to hear the money that he's starting to give away. That's a big deal.
Harvesting, yeah.
Seven-time Super Bowl champion Tom Brady agreeing to merge his nutrition and apparel companies, TB12 and the Brady brand, with the training company No Bull. As part of that deal, Brady will become the #2 shareholder. No Bull is a fitness brand that was bought in July by former beverage giant Mike Riepoli. The new company will serve as a footwear, apparel, and wellness brand. Brady says that he plans to build on the No Bull brand with his own loyal fan base.
I was very fortunate in my own career to impact different communities of people in a way that was really authentic to me. And speaking with Mike and getting to know Mike over the years, we share so many similar beliefs and values, and I thought it was the best opportunity for myself and the brands that I've been a part of to make a huge difference.
Tom Brady speaking there. Obviously, it was Mike Riepoli on the other side of him. All right, let's get back to the markets and talk fixed income with the Fed kicking off its latest policy meeting today. Our next guest says that we're in a soft landing right now. She says she still sees about a 30% chance of a hard landing, but that the market thinks that situation is much less likely. Let's bring in Priya Misra, who is fixed income portfolio manager at JP Morgan Asset Management. Priya, let's just start with this idea that you think there's a larger shot of a hard landing than the market is really pricing in. Why is that?
It's because I would argue that Fed policy is fairly restrictive. I mean, if you look at 10-year real rates, we're getting close to 2%. The Fed is also letting the balance sheet run off. And there's big question about when do they start to cut, how much do they cut, and if they're a little bit slow. You know, when policy is restrictive, the lags are kicking in. I would argue recessions are always nonlinear. You know, every recession effectively starts looking like a soft landing. So we're in this, I would argue, very critical juncture. If the Fed is able to start to normalize quickly, and I would argue they can start in March, May, something in that time frame, start normalizing the balance sheet, start normalizing interest rates, maybe we can stay in the soft landing. If they're not that quick.
4% isn't normal? I mean, that sounds like we're locked into these next to nothing interest rates for forever.
Well, you know, I would say real rates close to 0 to 1% makes sense, but look at how much inflation's come down. So if inflation is running around 2%, I would say normal is closer to 2.5 to 3%. So there's still, you know, room for rates to go down. We're not going to zero.
Inflation has come down, but there are some pretty inflationary pressures that are out there on the global scene that people worry could come back in. A lot of that has to do with the Red Sea and the shutdowns that you're seeing, longer shipping times. You haven't really seen it show up in oil prices yet, but that could happen if things escalate from here. And the one thing the Fed has said when you talk to any of these FOMC members is the last thing they want to do is lower rates and then have to raise them again.
Agreed. So I think as they sort of think about the balance of risks here, it's a lot more balanced. But you know, you look at the labor market, even there we are seeing slowing. Wages have started to slow down. If you get a Red Sea related shipping disruption, that's actually more negative for the corporate sector, it's more negative for the household sector. So I think the Fed then can still continue to lower rates. They have to be vigilant, but as long as the labor market's slowing, I think they'll feel more comfortable that service inflation, which is still high. Most of the disinflation we've seen has been goods-related disinflation. I think that's largely run its course. But if service inflation starts to continue to come down, we're seeing housing disinflation, we're seeing wages, I think that'll give the Fed some comfort that they can start to normalize. We're only talking normalizing. We're not still talking about Fed easing policy.
Yeah, and the Fed certainly has centered itself on that message, that it would just be normalizing. This is not a rescue operation. But you do frame it as a bit of a race against time, right? That you have to make sure rates they fit with the current macro backdrop as opposed to passively just becoming more restrictive.
Exactly. I think it's a very tough message actually for Chair Powell tomorrow because, you know, at one level, the economy looks great. Inflation's back to normal. The unemployment rate is you know, below 4%. Why should the Fed even cut rates? So I think they have to give this normalizing message. they have to realize that monetary policy is restrictive. But I think where the race against time will come if those lags, those long-awaited lags, start to impact consumption, start to impact consumer as well as corporate confidence, that's when the Fed can actually speed it up. I think it's actually easier. The first 200 basis points of rate cuts is much easier for the Fed because it's still normalizing. When do they get into the easing? But I think that's really a 2025 story.
And I think this also really does get to this perceived, disagreement between the Fed funds futures market and, I mean, human beings, we have a plan, we have intentions, we have models, we have a framework, we can say what we expect, 3 to 4 rate cuts, maybe if conditions are right. The market realized things happen, and there's a momentum to inflection points in the economy. So the Fed funds futures encapsulates a what-if scenario if you get the hard landing.
A bit of risk management.
Exactly, yes. I would say the market, the Fed's always going to give you their modal outcome, so the most likely outcome. The market's always going to price in this variety of outcomes. And there is that hard landing scenario. I know we don't like to talk about it, but recessions do happen. There's been a reasonable amount of time. We don't have that much policy space on the fiscal as well as monetary side. So I think if things start to slow down, that's when it can actually spiral into a hard landing, and the market should absolutely have that probability.
I think a hard landing is something that would happen later this year, something that holds off to 2025?
Right now it feels like it's a 25 story, but if things can slow down faster, I think it could be a second half of this year story.
And what does that mean from an investment point of view? I mean, does it mean you think bonds still look good here because, the risks seem to be skewed toward more slowing? Or?
So I might be the only one saying this, but I think treasury bonds do make sense. So the hedging property of treasury bonds that has not been prevalent for the last many years as the Fed was taking rates higher, that hedging property is here. I would say owning risk assets makes sense. We're in a soft landing. Do your credit work, understand business models, understand balance sheets, but own those treasuries. If the Fed has to cut rates a lot more, those 5-year treasuries have a lot more room to decline. So I would say owning risk assets, owning some duration, 5-year treasuries, is a good way to sort of balance the fact that we're in this tenuous moment. It feels very soft landing, but you've got to keep an eye out for that hard landing risk.
We were also talking a little bit about the balance sheet. It seems that the Fed's gotten lucky. It hasn't hit a critical point. The market seems to be able to absorb what's going on right now. Is it just steady as she goes, or do you expect them to just essentially, have it find a level and plateau?
So I think the Fed is a lot more humble about quantitative tightening this time around. In 2019, we had that repo spike. They had to come in and start buying bonds. They're really trying to extend that soft landing. So I think they're already talking about tapering quantitative tightening.
Well,
I think that happens.
They did it last year during the mini banking crisis that took place in the spring, too.
Exactly. I think they eased policy significantly through that BTFP program. That's running off, but we've got the discount window. I think starting to taper quantitative tightening as those overnight reverse repo levels are coming out, it's very prudent. I would think it starts by March, April timeframe. They start to taper just because now they are finessing. When does quantitative tightening become a problem?
Right, and I just go back and forth. If you're in a situation of using either putting the brakes on quantitative tightening or cutting rates, my guess is they'd want to slow on the quantitative tightening first because the cutting rates is such a public proclamation of a tide, a shifting tide, and they don't, again, want to get caught in a situation where they have to change their minds. After you cut rates, if you have to raise them again, that's a problem.
Right, it's a fair point. Now the Fed's been saying that interest rates is their primary tool, so they've been saying they're likely to cut before they stop QT. But I would argue cutting from 5.5 to 5, or even 4.5 or 3, is still within the restrictive realm. They're just reducing the level of restrictiveness because inflation has come down. So as long as they can spin the normalizing, and that's actually consistent with getting at least sort of slowing down the balance sheet tightening as well.
Priya, thanks for coming in.
Thank you.
All right, coming up, much more on General Motors' fourth quarter results. The automaker beating analyst expectations on the top and bottom lines this morning. That was, and after a break, we're going to speak with a top analyst. But first, as we head to that break, here are a few more key companies that reported results this morning. JetBlue posting a smaller than expected loss and sales above estimates, but forecasting lower capacity. Meantime, homebuilder Pulte Group posting a mixed quarter, earnings above estimates, but light on sales. Stay tuned. You're watching Squawk Box on CNBC.
squawk.com/TV.
General Motors reporting fourth quarter results earlier this morning. The automaker topping profit and revenue estimates, and 2024 EPS guidance was well above street expectations. Here to help us break down the numbers, Garrett Nelson, senior analyst at CFRA. Garrett, good morning. I mean, this was a huge revenue beat in the trailing quarter. I'm not sure whether people got overzealous in terms of cutting those estimates after the company gave some guidance previously, but how does the overall picture shape up going into 2024 based on this morning's numbers?
Thanks for having me. No question, this was a very solid release from GM. They did a very good job navigating headwinds from the UAW strike last fall. Adjusted EPS came in 10 cents above consensus, mainly driven by the top line as revenue came in $3.5 billion above consensus at $43 billion. The guidance was also much better than expected. Adjusted EPS of $8.50 to $9.50 for 2024. Consensus is only at $7.76. However, if you take a closer look at the guidance, you'll see that it's mainly driven by the share repurchases that they announced in November following resolution of the UAW strike. That's $1.45 of the higher year-over-year EPS that they're expecting. So, on the surface, this looks like an incredible release, but you look a little bit closer, not quite as positive, because the higher EPS that they're expecting this year is not driven by fundamental earnings improvement.
I was wondering about that, although, the company did say it was a $10 billion accelerated repurchase plan. Was that not just fully in the estimates for per share earnings for 2024?
No, it doesn't appear that analyst estimates were updated for that. So that was the primary driver of the higher guidance.
What about trends in the underlying business? And then, of course, the company also saying that they're going to kind of move toward EV profitability or break even later this year.
We remain skeptical on the EV business. GM has been the most aggressive in investing in pure battery EVs, and a lot of those new models are coming to market in the next 12 months or so. The Chevy Blazer EV, the Silverado, the Equinox. What we found from our research is that these EVs, really most of the non-Tesla EVs, aren't selling particularly well. And so we remain skeptical of, and there's still a lot of uncertainty related to their pivot towards EVs. What consumers are saying is they want to see more hybrid models, not necessarily pure play battery EVs.
And that has been a big theme, and the I guess conventional wisdom is that GM in particular is kind of caught offside by the demand for hybrids, right? They don't necessarily have much in that way.
That's right. They've really made a big bet on the future of pure battery EVs, and so if you take a longer term view of the story. GM has been losing market share for several years in the U.S., which is where the vast majority of their profits come from. If you look at 2023, their market share in the U.S. was about 16%, but that's down from 22% in 2008 and 28% back in 2000. So while the stocks had a big move since the November lows when it bottomed around $26, we still think that investors should stay on the sidelines here.
How hard would it be to retool to try and go after the hybrid market? I mean, that seems like a pretty big deal, but those seem to have a little more favor with consumers right now.
And I think that's the big question, is how are they going to pivot from making this big bet on EVs into offering more hybrid models? We're hearing that dealerships are demanding that they produce more hybrid models because the EVs that they have out there just aren't selling particularly well. So, it's one of the big challenges that Mary Barra and her team face heading into the new year.
Yeah, I mean, you mentioned you think investors should stay on the sidelines and don't necessarily buy into the idea that they've got this sustainable earnings model at the 2024 levels, perhaps, but we are trading below 5 times the new 2024 guidance, right? I mean, I know these stocks tend to trade at very depressed multiples, but is there a chance that something goes right, even in the macro, that can make that a decent bet?
Sure, absolutely. But what we'd be looking for is more improvement in the underlying earnings of the company and not EPS growth being driven by share repurchases. So obviously that's not sustainable. They can't continue to buy back stock forever. So, until we see that, but what we've seen so far from Detroit 3 automakers and other traditional automakers is that EVs are money losers, and they're a significant drag on the overall earnings of the company. And there are very few companies who are making EVs profitably, Tesla being one of them, and that's our top pick.
Yeah, I guess the question is, can they move toward a place just because of volume growth or scale to where they can kind of outrun the losses in EVs, or become a little more agnostic about what types of vehicles customers want?
Yeah, we think they're on the pathway to doing that. But again, this is not a company who's been gaining market share, and we're not optimistic on their ability to recover market share that's been lost in past years. The auto industry is just too competitive. There's too many companies, and there's too many new EV models coming to market that GM's new models are going to be competing with. So the EV market is in a state of oversaturation, and we think it's going to remain so for at least the near term.
Yeah. All right, fair point. Garrett, appreciate the time this morning. Thank you.
Thank you.
And a programming note, don't miss a big interview today with GM CEO Mary Barra at 10 a.m. Eastern Time on Squawk on the Street.
When we return, we'll go inside the latest tax fight on Capitol Hill with Representative Jason Smith. He is the chairman of the House Ways and Means Committee. First, though, a reminder as we head to a break, you can get the best of Squawk Box in our daily podcast. Just follow Squawk Pod on your favorite podcast app, and you can listen anytime. We'll be right back.
Welcome back to Squawk Box. The futures right now are showing a little bit of weakness before the open. The S&P 500 indicated down about 10 points, giving back some of its 0.75% gain yesterday. NASDAQ just turned -2, indicated down 33.
IBM has a message for employees still clinging to that work-from-home lifestyle. That's according to a memo that was sent earlier this month and reviewed by Bloomberg. IBM's senior vice president is now telling all U.S. managers without exemptions that they have to immediately report to an office or a client location at least 3 days a week. They say that is regardless of current work location status, or their other alternative is to leave the company.
Appliance maker Whirlpool out with a new warning about the consumer. The company, which owns the Maytag and KitchenAid brands, beat estimates for earnings and revenue in the prior quarter, but the guidance is weighing on the stock. The company is projecting 2024 sales below Wall Street's expectations as consumers forego appliance upgrades. Whirlpool says it's already seeing lower demand for appliances in North America, and consumers replacing broken appliances have been more price sensitive. The stock has been on a downward trajectory for a while now, another 5% lower.
I think maybe the biggest news is the people who are replacing are very much looking at price. That's kind of the new part of all of this.
And you mentioned earlier, I mean, we don't know how much of this is, we had the pandemic effect, people had to pay up for home improvement products and new homes and things like that. But right now, there's no more scarcity, there's no more supply chain. You can be pretty careful on price. Coming up, new data on China's economy, plus what the slowdown in that country could mean for the global economy, and insights into China's troubled property market. And a programming note as we head to a break, don't miss an exclusive interview with Citadel CEO Ken Griffin in the 10 a.m. Eastern hour of Squawk on the Street. That's live from the MFA Network Miami Conference. Stay tuned, you're watching Squawk Box on CNBC.
I'll try.
Welcome back to Squawk Box, everybody. This is CNBC, and we are watching the futures this morning under some continuing pressure. Dow futures at this point down by over 70 points. NASDAQ indicated down by 30. You've got the S&P futures down by about 9. Treasuries, those yields, I believe, are continuing under pressure, too. Yeah, the 10-year is now at 4.06. 2-year still sitting at 4.31. Microsoft set to report fiscal second quarter earnings after the closing bell this afternoon. Ahead of that, CEO Satya Nadella sat down with Lester Holt from NBC Nightly News. AI, of course, one of the big topics that they talked about. Here's an exchange the two had on how the technology could impact this year's race for the White House.
We're marching down the road to the first AI election. Are you holding your breath as to see how AI can help and how it may be weaponized?
In fact, it goes back again. This is not the first election where we dealt with disinformation or propaganda campaigns by adversaries and election interference and all of those things. So therefore, I think what we have to go back again is, for example, I think we're doing all the work across the tech industry around watermarking, detecting deep fakes and content IDs. There's going to be enough and more technology, quite frankly, in order to be able to identify the issues around disinformation and misinformation. Then the question again comes back to how do we build consensus between parties, candidates, and the norms around what is acceptable, not acceptable.
That interview between Lester Holt and Satya Nadella will roll out tonight on NBC News. You can see right now, stock chart has been really good to that company over the last year, up 70%. But there are so many big questions around AI and what the future of regulation will be for that this is probably why a bigger audience is paying attention than it would normally be.
Absolutely. I mean, the market loves the idea that you can actually quantify. They're going to charge $35 or $30 per subscriber, per seat. You can do price times volume, and you're going to get that search or Copilot capability. But then what does that mean? What does it actually buy you, and how do they achieve the product that you're going to be buying the rights to? So yeah, it's interesting that he's willing to get out there. $3 trillion market cap.
Yeah.
You can't hide when you're that big.
You can't. I mean, we had Lena Khan on the program yesterday from the FTC, and her point was you have to look at these companies and see what they are doing. All of the things that happened a couple of months ago with Sam Altman on that crazy weekend when it looked like he might actually leave with the entire team and go to Microsoft. Microsoft, as a return, when things did go back to this, gets a couple of seats on the board there. It raises real questions about how companies are gaining control, whether it be through mergers and acquisitions or stealth mergers, gaining control over this new technology that is so important not only here but around the globe, and the race for all of this. And Lester did ask him, in a clip that we ran earlier, asked him about the implications, what this means for copyright protections on these things. And these are huge decisions that Washington is going to be playing a role in.
Yeah, it's unusual to some degree to have the very largest companies perceived to be on the absolute cutting edge of the disruption. Right? Usually they're the ones supposed to be disrupted. I know that's what part of what Colin was talking about yesterday, which is you want to preserve this idea that these huge companies can't just perpetually protect themselves.
But this in particular, the computing power that is required for AI is so expensive, and that's why the deep pockets are definitely in the pole position.
For sure.
Yeah.
All right, the slowing Chinese economy very much in focus since the start of the year. Hong Kong led losses in Asia-Pacific markets today as investors try to deal with the fallout from the liquidation order for property giant Evergrande. Our next guest has exclusive new data on China's economy. He says it's critical that authorities put a floor under the property market. Let's bring in China Beige Book CEO Leland Miller. Leland, it's great to have you. The Wall Street Journal today pointing out 20-year lows in Chinese 10-year government bonds. What does that tell us about the state of the economic growth story in China and what might have to happen from the authorities to try and restart it?
Well, the story is that there's just very little confidence in China right now. There's not confidence in corporates. There's not confidence with consumers. So the question is, how little can the Chinese government get away with in terms of policy support to keep people in the game, to avoid some sort of doom loop in the stock market and the property market in terms of consumption, but also not reverse course from the last 3 years of painful medicine they've served up in terms of property deleveraging. So I think what's disappointing markets is that things have been bad, but they haven't been bad enough for big stimulus, and that's a great frustration.
a lot of it is what we hear coming out of the country about stimulus efforts, even small around the edges type measures like, trying to clamp down on short selling and find an excuse for the Chinese stock market to catch a bid. It feels very familiar. It feels like a previous playbook. What do you think specifically ought to be done now, if anything? I mean, unless you just have to let the market kind of sort it out.
Well, I know I'm going to get a lot of tomatoes thrown at me for this, but I would say they're doing mostly the right thing. There's an expectation by people who are playing the market that they're going to get the Chinese government at their back, and then they're going to be able to hit the big bounce, and they're going to get big stimulus, and then things are going to go back, and everyone's going to be smiling. This is not what Xi Jinping wants to do with his economy. They moved away 3-4 years ago from the current economic growth model. They don't care about high levels of growth. They don't have the same stimulus playbook. What they like to do is set a floor on growth. They don't want a disaster to happen, but they also have their priorities set far away from the idea of just growing fast. What they want to do is make sure there's not a doom loop of confidence, just enough stimulus policy support in order to keep things going, keep things chugging forward, but not enough to juice investor returns, not enough to juice the stock market, not enough to send growth skyward.
And what about, those measures, if it's just enough, as you characterize it, should apply to the property market? I mean, how do you restart confidence when there's been a recognition that, the whole sector was sort of operating in a bit of a false economy for a long period of time, based on expectations of, being able to speculate in housing and based on a lot of government incentives, to essentially do so?
Well, the little secret that no one wants to say out loud is you can't. You cannot get confidence back in the Chinese property market because they don't really want to do that. They want to set a floor. They don't want a disaster to happen. But they've spent the last several years deleveraging the property sector. They want it to go from 25% of the economy and as a major growth driver to something far, far less and far, far reliant on endless streams of credit. As a result, what you have to do is you have to have your hands off. You have to let the weak firms fail. You have to allow for the market to slow down. You have to allow for prices to slow and sometimes contract. What does that do? That scares people a lot. So they don't want something bad to come of this, but they also don't want to restore confidence enough to return to the status quo ante. So this is a very difficult policy challenge because they're going to have to do just enough to make sure people aren't panicking, but not enough to really let the market recover because that's not what they want to happen.
It wasn't terribly long ago that the storyline was, this was an economy that was turning more toward domestic consumption, and it was more of a consumer-led and maybe income growth-led story. I mean, you obviously have population, declines in some respects, and aging of the population. So is that not the case anymore? That it's just going to kind of be a little more of a self-contained type economy?
Yeah, that was never the case. That was a bunch of nonsense that was being fed to us by people who had a vested interest in having flows directed into China. They were making money off this story, so they were telling the story. China's never been a consumption story, never been a domestic consumption story. There's never been the rise of the Chinese consumer because structurally speaking, the economy suppresses consumption. It suppresses household savings. So you're never going to have an explosion of consumption in China because structurally it won't allow it. So it was a great story, made a lot of people a lot of money. It was never true, and so now we have to be a little bit more realistic with our portfolios.
It's interesting, I do keep an eye on a lot of commentary among investors, domestic investors in the U.S. here, who would try to make the case that, wow, sentiment toward China, the Chinese market, the Chinese economy, seems like it's washed out. Nobody expects anything of it. They feel like they can safely ignore it if you have a global investment portfolio. And then you talk about how China itself doesn't really want overseas investment flows. So, how do you square those two things? Is it possible that it can be an undervalued market and underappreciated at the same time that the Chinese authorities aren't really doing much to try and make it a shiny growth story again?
It depends what kind of investor you are. If you're a sophisticated investor who trades on volatility and really knows what they're doing in terms of the China story, you can make money in China. It's not uninvestable from that perspective. But the old way of investing in China was to sink your money in, check it every 3-6 months, cash the dividends with the expectation that China had sort of drawn a moat around as tech champions, other national champions. You could just, cash your dividends and smile at the quarterly meetings. That story is over. It's not impossible to trade China right now, but you can't trade it like you used to because there's just too much going on. And too much of the sentiment is based around the idea that there's going to be some sort of, rocket ship of stimulus that's going to save everybody. That is not going to happen. And no matter how many times and how many years we tell people, they still try to trade on it.
No, you're right. It really is, the muscle memory is pretty strong in that regard. Leland, thank you very much.
Pleasure.
When we come back, the latest flare-up over taxes on Capitol Hill. Our next guest is trying to get a bipartisan plan through Congress, but that deal is reportedly dividing members of his own party. We will speak with the House Ways and Means Committee Chairman, GOP Representative Jason Smith. Stay tuned, you're watching Squawk Box, and this is CNBC.
Man, it's early. Good morning, retail traders. Pfizer did pop on earnings, but pulled back pretty hard. Good morning, retail traders.
Members of Congress fighting over a new bipartisan tax bill put together by our next guests. Particular sticking points include a child tax credit and the cap on state and local tax deductions. Last night, Axios reported on a heated exchange centering on the latter topic, between New York Republican Representative Mike Lawler and our next guest. Joining us right now is Missouri Congressman Jason Smith. He is the chairman of the Ways and Means Committee. And Mr. Chairman, thank you for being here. Why don't we start on the bill itself and the problems that it is trying to address? Big issues here concerning depreciation for businesses and the child tax credit. Those are big issues that without some sort of
I got screwed on that depreciation back during the Clinton years.
You know, this bill has pro-growth, pro-worker, pro-American
that really
tax
screwed
policies
me.
that support families and small businesses. It sharpens our competitive edge with China, and it boosts innovation right here in the United States. There's 3 very important business provisions that have expired from Trump's tax cuts of 2017. One is research and development. That allows immediate expensing. If we pass this provision, it will help invest more than $70 billion into the economy.
We don't want no more spending.
21 million jobs. When you look at the 100% expensing provision, it started to phase out. It was 80% last year, it's 60% this year. It'll go to 40% next year. We're making it at 100% once again. That will create more than $400 billion in investment and create 73,000 new jobs.
Let me just stop you there before we continue on this. I mean, part of the problem that's been pointed out is that something like $110 billion in the revenue cost of this is applied retroactively to deductions that were made for 2022 and 2023. That is not going to put more incentives to investing more because that's already come and passed.
I don't know where you get that number. The entire tax bill alone is $78 billion. Well, it's only $78 billion is the entire tax bill that covers. Well, I'm talking about what the bill does. And you can't go back 10 years. That's not, in fact, what it does. This bill provides for working families, small businesses, and
There's not
we have
anything
more
retroactive for tax investments that were already made in 22 and 23?
No, there's retroactive in regards to R&D.
Well, she's a little snooty
making it
today.
100% with expensing and the interest
Correct, but
deductibility provision.
why
because
is that
R&D
incentivizing additional business incentives? I understand your point, but let's cut through some of the big talking points and really get down to the issues here. I agree that R&D being fully expensed will help with future issues, but not retroactively. That's already been done and paid for.
There's a lot of discussion in regards to whether you should do retroactive activity or not. We're in a very divided government. Very divided government. Democrats control the Senate, Republicans control the House. Sometimes those are things that have to be within a bill to help get it passed. It passed out of the Ways and Means Committee 40-3. There has not been a bipartisan tax package passed Congress since my first year in the committee back in 2015. In order to make law in regards to tax policy, you have to make sure Republicans and Democrats will agree on it, and you're going to see a very high vote when this is taken to the floor.
So let me ask, the kind of sound and fury around this that's been reported on this are some GOP critics who said that they weren't consulted on the negotiations. One person was pretty vocal in what he said to Axios, saying, I don't know who the F he's dealing with. How does Jason Smith announce the deal before the speaker knows about it? He negotiated this with the Senate and the Dems. Is this more of the same of what we've seen with just the overall Speaker of the House having so many problems trying to keep things in line with a very thin majority?
Those are just distractors. This bill started from the field hearings that we had at the very beginning of the year in Appalachia, in Yukon, Oklahoma, and Peachtree City, Georgia, where we heard from real small businesses, working families. We developed that tax package in June, passed it out of the committee in June, and what was passed out of the committee in June is what we used to negotiate. We had 171 Republicans in our conference that asked for these provisions to be included into a bill. That's why we negotiate. We move forward. The Speaker's office was included in our negotiations for months. He was quite well aware of everything that was going on. That's just simply not true.
Okay, is this anything that will stall getting it through, and are you going to bring it to the floor this week?
Well, of course, it's up to the Speaker and the leader whenever it comes to the floor. I expect that it will be this week. I expect it will be in the next couple days, and whenever we have the votes, you're going to see a very large number of Republicans and Democrats that will be voting for this pro-family, pro-worker, pro-business, pro-growth tax policy.
There have been people who have complained about the child tax provisions. I mean, my understanding is that this brings it higher because of inflationary aspects. There have been some people who have claimed that this is going to be a giveaway to lots of people out there. What's your response to that?
My response is the Republicans started the tax credit in the 90s. We doubled it in Trump's tax cuts in 2017, and what we're doing here is enhancing it. We're indexing it for inflation for families who have been crushed. by the cost of goods going up. We're making sure that there's no longer a penalty for families who have multiple children. Things that are pro-family, pro-growth.
Yeah.
That's the policies that's within this bill.
I think part of the issue is the refundability.
Okay. I could sit here and debate this all day long. Starbucks. Becky was a tough chick this morning. It's just to stay away from the talking points. She had plenty of them. I don't think I'd want to be on her bad side. Let's see what the room got going on here. Save spike. Sure enough. Swings to narrow than expected revenue beats. Somewhat downbeat outlook.
Few days still ahead for the markets as investors brace for big tech earnings and the Fed's latest policy decision. Joining us right now is John Mowry, who is Executive Managing Director and CIO at NFJ Investment Group. John, what do you want to hear from the Fed? What do you want to hear from earnings? Which one is front and center for you this week?
Good to see you, Becky. So I think, when I look at earnings, I'm not as worried. I'm expecting those to be pretty sanguine. Valuations are stretched in big tech. I think what I'm really keying off is what is the Fed going to say? If you look at that spread between the 2-year bond yield and the Fed funds rate, that is very stretched. In fact, we're in the 13th month where the 2-year yield has been below the Fed funds rate. Why is that important? Because the 2-year bond yield is telling the Fed it's time to cut. And if you go back historically, we're in the second longest yield curve inversion. Those things typically can be problematic. So I'm looking for the Fed to use language that could give investors some relief there. And I think that that's going to be a potential real boom for real estate, banks, and some of the smaller and mid-cap stocks.
There he goes, pumping his eye.
If you don't get that,
IWM.
then what?
Well, if you don't get that, I think what's interesting, Becky, is that you've been paid to avoid some of the more defensive areas because of higher interest rates. So if you look at utilities, if you look at staples, if you look at healthcare, all of these higher yielding areas have been hollowed out because you've been paid to avoid them. Everyone's been chasing the Mag 7 and the AI trend, and then they're clipping coupons in fixed income. That's created a real opportunity in the more defensive areas. So should you get a bumpier period in the market, I think that you'll get paid to be in those other areas. So I like some of the more defensive areas. In fact, Becky, if you look at the spread between the cyclicals and semis and the more defensive areas, you have now surpassed where we were in 21 when those spreads got very stretched before a challenging year in 22. So I think investors would be wise to rebound out of some of these areas that have run and move into some of the areas where you've got much more attractive valuations, very healthy dividends, and dividend growth. No one talks about dividend growth, but that's a key way to ward off inflation.
Yeah, it's interesting, John. It seems like the market has decided that the biggest tech stocks are defense as well as being offense, and so the traditional defensive have not worked as well. I was looking at consumer staples in particular, very low valuations relative to their history, but do you need a story fundamentally for why things are going to work? People don't think there's pricing power, et cetera.
Well, I always start with valuation should shape investor expectations. I mean, the Mag 7 got just tremendously cheap, okay? NVIDIA was down 67%, Facebook or Meta was down 50. Those names got really attractive. So I think that you always should start with valuations. But I expect that as inflation begins to moderate, that's going to be a way that these staples have some alleviation on pricing power. In addition to that, if you look overseas, a lot of these staples
I don't see
have
no
exposure to
discount.
China, some of the European markets, those have been weaker. Should you see a bottoming there, I think that's also going to alleviate some of the pressure on the staples. So I think all those areas are places investors should be looking in. They're not as exciting. The hare won the race last year. It might be turtle time.
The hair.
Yes, tortoise time, yeah.
Hair. John, thank you. Great to see you.
Thank you.
All right, let's take a final check on the markets very quickly. You will see the futures continue to be under pressure. Dow futures off by close to 80 points now. NASDAQ down by 40. The S&P futures down by 10. Mike, thank you for being here today.
Thank you.
Yeah. We'll see you back here soon, too. Right now it's time for Squawk on the Street.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer at Post 9 at the New York Stock Exchange. David Faber is the morning off. Coming off the 6th record close of the year, futures a bit soft here as several industrials guide lower, including UPS. Market awaiting Microsoft, Google tonight, the Fed decision tomorrow. Our roadmap begins with record highs in this slew of corporate results today. GM, UPS, Pfizer, all crossing the tape, and big tech on deck tonight. Amazon, Alphabet, AMD after the bell. Plus, consumer concerns. Whirlpool warns of spending softness this year. And then there's Apple's Vision Pro, the first wave of non-curated reviews out just a couple of moments ago, and we will bring you the highlights. Let's begin, though, with UPS announcing plans to cut some 12,000 jobs, Jim, as they do guide lower for the year.
Yeah, it was a very disappointing quarter. Really awful, frankly, and trying to figure out exactly what happened because you got profits down gigantically. The 12,000 jobs, I think, is obviously necessary when you have revenues down very, very big. I think UPS is in disarray. Not quite sure how to fix the situation. I don't think it necessarily affects on FedEx. Wondering what the Amazon impact, but it's the type of thing where I'm not saying it bodes poorly for anyone other than UPS because I think UPS is in a tough run here. They had union problems. Yeah. Obviously, we're down to on behalf, really very, very positive for FedEx. I think FedEx is a buy. I think UPS, after they announced the job cuts, people are going to start liking it. There's a lot of people who want to own UPS and feel this was a clearing event. I'm not going to. I have to have more view that things could get better.
It is part of, they say, an effort to cut $1 billion in cost. Revenue was a miss, although they beat on the bottom line. Full year revenue, Jim, 92 to 94.5 billion. Streets at 95.6.
Yes, stop it.
CapEx also came in below at 4.5.
Wow. I mean, you know, look, there'll be people who say 12,000 jobs, first real impact of slowdown, of rates higher. I mean, a gut-wrenching decline, frankly, particularly for a unionized outfit. I look at this and I say, I want to know how much of it is lost business to FedEx, how much of it is what Amazon's doing. But I think what's most important is how much of it is just poorly run. I don't know.
Right. Operational challenges.
Operational challenges.
It does bring to mind the list of layoffs lately. I've been keeping one just recent. Levi, eBay, SAP, Salesforce, Macy's, Wayfair,
I don't believe a lot of
and then
numbers
a
they
couple
spit
Trinity
out.
at Alphabet and Microsoft. Jeffrey's
This
actually
economy's in the
looked
best
at-
shape.
We got about a fifth of the S&P 1500
I've never thought
have
that.
reported already. And of those, 13% have mentioned layoffs in some way, which is up from the prior 2 quarters.
Right, I mean, we do have these companies that are recognizing, I think you'll hear this from Amazon, from Alphabet, you know what, we made some decisions, we had a lot of initiatives, and we decided to close those initiatives. And I think that is prudent, and the numbers go higher. Then there are other companies, like a Macy's, which is under siege from these, I don't know, these activists, where they're trying to take some action. And then there's companies that are just saying things are softer. But I'm not seeing lots of companies doing the latter. It certainly would make sense if things continued this way, but I'm not ready to wave a red flag yet.
Right. Journal's got a piece today. Fewer workers quitting their jobs.
Isn't that interesting?
Glassdoor had a chart yesterday looking at employee confidence in their job security. Very low, right? Has really rolled over.
Is Bain number one on that? I think it was very, very interesting. Like, wow. I mean, are we like no more public companies that are at the top?
I guess the question is, are you going into Friday's print with maybe eyes a little wider open?
I am.
You are.
I am, because when those are stats that say there's not going to be any increase of wages, people are happy to keep their job. I think that this is one of the things that Nick Timmer's piece really from the Journal. He's very good. You know, yesterday was about there was a piece about disinflation. I think that we're now starting to see deflation. I think in Costco we had zero growth in pricing. I think we're going to start seeing deflation there. Things are going the Fed's way. The question is this a long enough window? I mean, if I'm Jay Powell, I say, you know, it's starting to go my way. Let's stick with it. It's working. But I think that Americans are worried. And this is the first time. Election year.
Yeah.
Now, we see some companies that are just doing so well. I mean, Nucor is a very good representative. But in the Nucor chart, there is, I mean, some rather amazing things. We're seeing, Nucor's talking about a decline in machinery, in tractors. I mean, to me, that's a decline in none other than Caterpillar, which was at an all-time high yesterday. I mean, you take a look at, they have a 224 domestic end market use. Higher interest rates coupled with declining profits, hurting demand forecasts for tractors, combines, earth-moving machinery, and rail cars. Well, there's the economy for you. I mean, there it is. And you do have modest growth for light vehicles expected in 2024. I mean, for all I know, that is exactly what's going on with Amazon. But manufacturing, retail, healthcare, data centers, and education expected to show strength. Now, Nucor has just put it's hitting out of the park, and they're just a great company. But I'm mindful that they typically have not had a line item that has worried me in a long time.
You're right about the steel companies. Other industrials, though, that got a bit lower today: Corning, Pentair, Johnson Controls.
This economy.
And then you add on top of that sort of what Dallas Fed and Empire have told us last couple of weeks.
Look, you're spot on, Carl. I mean, I when you see these cuts, like a JCI had already said that things were bad, and then I want to combine that with this note that a lot of people are buzzing about the .com period.
Oh yes.
I mean, you know,
The quants at JPM are back.
Right, the quants are back. We haven't heard from them in ages. Top 10 up 29% since the end of December. And then you say, well, come on, that can't continue. And yet last night, I had a company called Supermicro on SMCI. If you look at this thing, you say to yourself, is it really possible it went out at 495 and it's at 548? But the answer is that Charles Liang makes equipment that go with NVIDIA. And this is, you keep coming back to NVIDIA being the sun, and all these planets revolve around it. And I don't know whether this is Mercury or Venus, but I'll tell you, it ain't Pluto.
Well, you told us yesterday you were going to go into your show excited to hear from them.
I mean, excited. Look, I mean, when you pre-announce a couple weeks ago and then you put up these numbers, what you recognize is that the orders, like you wake up in the morning. I mean, you know, there are a few businesses we wake up in the morning, it's like, I'll get you back. You want 100 million? Let me get you right back. This guy wants 200 million. Could you like figure, you've got guys calling and asking for $100 million orders. I mean, most people are happy with an order that makes it so they can get a new suit.
It's actually worth listening to what the CEO told you last night on Mad Money. Take a listen.
Will create even bigger impact than industrial revolution, because AI revolution not just impact.
He's a hard one to understand.
Visible. For example, autonomous driving, for example, child GDP, industrial automation, and including our job, efficiency optimization, accuracy, more productive.
Maybe the layoffs we just talked about and the AI push he's talking about are part of the same thing.
I want to make that my point on tonight's Mad Money. That could be, I didn't put two and two together when he gave all those different verticals. Those verticals were verticals where people said, and CEOs said, you know what, I don't need all these people. Because remember he's talking about health vertical? I mean, he talked about verticals that I've not heard. You know, sure, Prurient interest, so maybe they're going to do something in medical. But this is big money being used, I think, to replace people. Now, Jensen Huang, CEO of NVIDIA, has always said, remember, this takes people from unproductive jobs and put them in productive jobs. But when you combine it with the layoffs, Carl, I think you could get your first industrial revolution, which was the term that you know, Charles is he is a man of great knowledge. Charles Lamb, the CEO of some Supermicro, he's talking about better, more important than the industrial revolution. Now, industrial revolution is often a code word for seamstresses being laid off because of the loom. And that's why I'm saying, like, I'm processing it right now. So, holy cow. Industrial revolution is not what Jensen Huang's talking about. Jensen's talking about the iPhone and how it could make things broader, or the cell phone, making the Wintel, making things broader. He's not talking about that at Supermicro. He's not. He's talking about industrial revolution, where we're going to have fewer jobs, more productivity. Different story.
So we're back to the Ed Yardeni golden age of productivity.
Yes.
Long-term thesis.
And isn't it interesting that Ed Yardeni's been the hottest of the analysts? Yes. By the way, also, just Intel, most humble, does not have an ounce of hubris in that man.
Right. By the way, I mean, more constructive, and to that point, Goldman yesterday, Q1 GDP tracker 2.8, and they're talking about real wage income growth, job gains for now, business investment being led by things like this.
This is Charles Liang versus Jensen Huang. Now, and then you have notes like, geez, Morgan Stanley goes out with guns blazing on the banks, and the price targets are absurd. I mean, like, I want to be in the banking business. I mean, it's the end of the layoffs because in Basel they're not tightening, and then the amount. I'm going to see the price. Citi going to sell to buy. I mean, are you kidding me? 46 price tag to 65. I mean, what is that? Lazarus, give me a call.
They take Goldman from 333.
Dang, I forgot about Mister. I was going to trade that the other day. I had it on my watch, forgot all about it. Yep. Good morning, retail traders. This is Washington. Good morning, retail traders. Good morning, Percy. UAL pulled back some. OBS already starting in. We got AMD earnings coming. Now where did I put that other one at? I know I put it. Oh. There it is. That run on AMD is something else. We got a 1, 2, 3. It opened. For AMD. Oh, market's open. Oh, we still got 15 minutes. That run on SPX yesterday really skunked me big time. That was irrational exuberance. Should have got a put today. Yesterday I should have got it for today. But I've never traded the SPX like that. Had the calls here. If I'd just kept them, God. 2,900 a piece times 5. That'd been almost $15,000. Got in them perfect right down there at the bottom. Then I got my puts here and it bling. McDonald's pulled back to the support level of the second deviation on the 1 hour. X is going private, huh? Tesla, the draw to the trend line across the bottom of the previous lows. Important thing for everyone to start drawing the trend lines and pivot points. That's right. Get to draw and learn how to draw them pivot points and trend lines. Boy, I used to have one guy I got into this one room one time, and this other guy was more or less a moderator, or I don't know what I call him, a discipliner guy. He got so mad about me telling people what a pivot point was. So I left the room and I got in another room, and he showed up. It's Mr. Pivot Point guy here. He held a grudge because I wouldn't stay in the room. He got mad at me. Got mad because I went to another room. That was when me and Morris and all them were together. I said, I can't take this. I gotta leave. I don't like fighting in a room, that's for sure. And arguing and egos. It ruins my whole day. Watching Bitcoin ETFs this morning, see what they're going to do. Where's that penny stock one I had? One above 10%. Pre-market movers. You like Rivian? On the weekly chart, you can easily see how we're coming off the strong double bottom area. 10 more minutes. That's definitely a pivot point. We got Microsoft today after the bell. You know what all the other ones have done? They're interested about the cloud. I've already had a good run. So support 409.03 if we get there. And almost a yin yang right here. So that'll be our first one, 360, 361. Tesla was a pretty good call off of my video. Seems like a little bit of bulls in here. We got a gain respect at 195.67. Had an inverse head and shoulders yesterday at open. It's ran up pretty good. Ford and General Motors expect EVs will stall for a while. Tesla and the work sport don't think that will be the case. You know why? Because they're frickin' high, man. Ford and General Motors. They got to pay them high-priced union workers. I don't think they're that bright enough to switch over to EV just like that, a snap of a finger. I mean, you have to start fresh. That means a brand new building, a brand new network of scientists. You can't be like the others. You got to do something different. They just listen to me and use the wheel as a generator, like they do an alternator. Spins around, creates electricity. I just think that'd be the best way, but I'm just a peon. Tesla has to break the 195.67, and we're definitely there. I forgot how I called this out. I think it was... Yeah, it's definitely off the support level. Double bottom. That's it. That's how I got it on the yearly, daily. Make sure you drink enough water. Have a good day.
Real terms is up 8% over 3 years. Not a very good record, right? 8%. It's well below the historical average. Under Trump, at this time in his presidency, the S&P 500 was up 30%. So do I think that Trump would be better for markets? Oh, hell yes, I do. I don't think there's any question having someone who's pro-business in the White House would have a very positive effect on the markets. And, you know, we would, if we take back power, we're going to keep...
He said, oh, hell yes.
We're going to get rid of a lot of the regulations. We're going to produce more American energy, which will bring energy costs down. So I think that for all those reasons, I think on balance, Trump would probably be better for markets. Now, whether
they're talking politics,
the market is
Schwab is.
And as President Trump was saying, I kind of doubt that. I mean, I think that because right now, look, this election that's coming up is a coin toss right now. It's really pretty much a 50-50 proposition.
It is not.
You think, to come back to
Unless we got a bunch of idiots in this country.
Pumping 13 million barrels a day. Think Trump administration could beat that? Biden's kind of been like the surprise energy hawk.
Yeah, we just did a study on this at the Committee to Unleash Prosperity. Given the reason that the energy production is up more than it was, it hit an all-time peak under Trump, and now it's up even higher than that. But there's a good reason for that. That's because the price is so much higher today. So, oil drilling is highly sensitive to the price. So we estimate that we'd be producing about 3 million more barrels a day if Trump were president and we didn't have these anti-fossil fuel policies. I mean, look, Biden can't have it both ways. He can't, on the one hand, say, I'm trying to destroy the oil and gas industry and we're going to go to net zero, and then say, oh, look, we're producing more oil than ever. We have the capacity to be producing at least 20 million barrels a day. We have so much oil. And by the way, the natural gas, look what's happened this week, this outrageous decision by Joe Biden to try to limit our LNG exports, which is, one of our major assets in the world. And also it will make, that will make European countries more dependent on Russia. So that doesn't make much sense from an economic or national security standpoint.
Fair enough. And one other point that relates the politics to the economy, it seems right now that one of the big takeaways from the Biden administration is it's
watch AMD this morning, right it open.
And mergers. I mean, every sector, so many things have been blocked. I've been very puzzled for the logic behind a lot of it. Do you think that has been related to this administration? Do you think that changes if there's a new administration? What is your take on that, Steve? We've got about 60 seconds.
Yeah, we have hyper-regulators in the Biden administration when it comes to antitrust. They are,
Make sure you got your platforms up. I didn't have mine up yesterday.
You know this, that the Magnificent Seven are responsible for over half the half the returns in the stock market over the last 18 months, those 7 companies. Well, guess what? 5 of those 7 companies, the Justice Department and the Federal Trade Commission have antitrust lawsuits against. I mean, since when is making building a better mousetrap and creating great companies illegal activity in the United States? So, we have to get Lena Khan is a crazy woman. She's a university professor who knows nothing about how to build a business or create a profit, and she's telling these great companies what they should and shouldn't be doing. So I think the antitrust, this is a
AMD, baby. $480. I'm going to try to break the 200 here. Mike alerted Rivian this morning. Spies breaking out. The QQQ hit the 200. IWM pulling back. Break the 200. There we go. Oh, shit. Don't stop on me. I gotta redo my password. 540. Okay, we're at 550. Any reasonable person on the scalp would probably take that. And any reasonable person wouldn't prosecute Hillary Clinton for deleting how many emails? 33,000. SMCI dip. I'd like to see the SPX get back to the 200, but I've got to have a different change of attitude. Yesterday kind of freaked me out. We got Google earnings coming out after hours. Apple had a solid support right there. They've been pumping Starbucks. We got 3 white soldiers on Starbucks off of 2 hammers. Real nice hammer right there. Buying at the bid. Yeah, it's real nice. I wish I could have caught that. Okay, I'm at 570. I get 580. I'm up $100 a contract on AMD. This could be a continuous runner today, maybe, but I don't know. I feel like I need to take profit here. I'm going to do it. SPY broke out. Come on, baby. Give it to me. That'd be nice to have a 1, 2, 3. Oh, there we go. I think we just hit resistance. So I'm going to get out of this. Pretty close to it. She's held up here for too long for me. I'm getting out of it. We had a double top, triple top off a wick. And I'll buy the dip. 178.89. There, Andy's here today. Oh shit, there it goes. Bam. Oh no. Set an alert above the 200 SMA for AMD, just in case it pulls back on us. That's on the 1 minute. Spies off the VWAP. Buffett figured he'd probably be getting rich off this oil, but it ain't working for him. Today's losers: UPS, Piton, China back down again on BYDDF. FDX pulled back $5. Baba's back down $1.40. Netflix. Watch Netflix. It's on the second deviation channel on the 1 minute. Watch Netflix. The weekly, the 580 strike for Netflix. Got an inverse head and shoulders, getting ready to squeeze. Shoo. We're going to find out any second here on Netflix. Orders ready. I'm going to grab a couple right here at 325. This might be a day trade. It's working. SPX held up. God dang. Good job. SMCI. You had puts? Fuck, how'd you get that? Oop, there's my Netflix going down a little bit here. Too late to grab one. We're getting ready to come to support on that. Where's my 30-minute? There it is. We're on the 50 on the 30-minute. There's Netflix at 365. Yeah, I'd watch SMCI here. 380. NFLX. Let's see if we can get it to the 200 today. Okay, 410. There we go. Now, if anybody took this trade with Bobo, learn to take profit. We just had 3 white soldiers. I'm not a financial advisor. I'm just here to educate. Oh, maybe I'm not up. Yeah, I am. So our target's the 200 SMA, and then we get out of the trade. If we even come close to it. It might take a couple candles, but better learn to take profit. IWM's at the 200. Now see, is that's we're squeezing. See, big candle, bit smaller, smaller, and then small. It's like spicy, hot, medium, and mild. Meta up $4. Goldman Sachs is up. TKO is up 83 cents. Ed McMahon is a Bill Clinton. He likes them young. Lily's down some. We got a 1, 2, 3 here on Lily. Symmetrical flag. It'll probably take a little time to squeeze. Merck. We got a double bottom on Merck. Double bottom on Merck. Snow's down 90 cents. Still Netflix here. Where's my Netflix? Anybody take Netflix with Bobo? You're up $100 a contract here. Come on, just a little bit more. Don't get greedy. Get ready. I'm getting ready to sell my Netflix. just a little bit more. Nah. I'm going to get out of it while I'm ahead here. Come on, give me a little bit more. So we got a snake with a 1 tubus freebie. We're pulling back to the trend line. So which one did you get, Rob? Or R? SMCI. God darn it. AMD's at what? Okay. February 2nd. God, these things aren't cheap. I'm taking it to 560s. The 560s for the weekly. Man, these things are good. It's a good action. Getting ready to squeeze. Boom, baby. You got the 9 and the 21. This is the 9 EMA and the 21 SMA. And y'all can tell it's getting ready to squeeze in there. So you got the snake and the initial breakout, and then they always pull back to that support line. And then we had 4 tweezers right here, pretty much. As long as the 9 stays above the 21, I'm still, or we still respect the 9. Whoop. Damn, it dropped fast. It's up $100. Should have grabbed one more down there, but I didn't. I don't like that action there. SPX had a knife. I'm going to set an alert above the 200 here. Dang, I missed it. That's a double bottom on the SPX. That would have been a good trade right there. Maybe. Exit idea is going to be, now this is the new chart I'm using. And I've got the 200 on here too. So I've got the 9 EMA, the 21 EMA, the 63 EMA, and the 200 SMA. Yesterday, the Tesla hit the 63 like I predicted. I'm getting ready to squeeze again here. It just seemed like it's took too long. We've got a 1, 2, 3. We've got a head and shoulders. We got a 1, 2, 3. We want that thing to break out past the 21. There we go. There, finally, got it. Now, when you get a spike like this and you're getting close to your target, now, 750. That's how you get it. Go away, little girl. Go away. So again, for anybody that's new out there on YouTube land, I've started a new strategy. I picked this up off of Schwab, their chartist artist. He has the 21 EMA and the 63 EMA, and I added the 9 EMA and the 200 SMA. And I'm going to use that 63 as a resistance level. And I'm going to use the 21 as a pivot point. Damn, 770. We got a 1, 2, 3 on the IWM. Man, look at that. Boom, baby. Nailed it. 815. Woo! Hit my target. And that's the 63 EMA. This is called the 1, 2, 3 step. If you can count to 3, you can trade with me. If you can count to 4, you might get more.
$70.7 billion all the way up to $85 billion when it comes to top line revenue. But the earnings estimate right now is sitting at around $1.60, which would be around a 52% increase on a year-over-year basis. Once again, how are they leveraging artificial intelligence on the back end to streamline their search operations, as well as improving the YouTube ad stream? I think that's going to be a very key area. And then you kind of talked about it. What are they going to do with Bard moving forward? What are they going to do with their Gemini product moving forward? It's kind of interesting that they have 2 or 3 different products that they currently are working on from the AI space. They probably want to hone that down into just one and be able to market that fairly strongly, and that'll probably get rid of some of this back and forth when it comes to investors and Google, because it's been a pretty communication structure.
Slash CEO had a nice little pop.
Tailwind for them overall. Once again, we are looking for an implied move of about 4.4% to the upside or downside. This could be a make or break quarter when it comes to Google. They are still lagging when you're looking at some of their competitors or some of their peers within this space, so there could be still some upside room to move. But once again, some of these expectations by analysts seem very aggressive, and these adjustments that we've seen over the last 10 days are very aggressive. I mean, we're talking about a $15 billion adjustment here when you're looking at the revenue estimate on top line. That's remarkable to say the least. That will have a dramatic impact on the adjusted earnings per share estimate as well.
Okay. So the expectations here going forward are going to center to a decent amount in the narrative around their AI, Bard, Gemini, but they also just need to show that the kind of post-COVID advertising malaise is past.
Yeah, definitely. I mean, when you're looking at advertising, it can comprise of around 60 to 70% of Google's overall revenue structure. So it's a huge area that not a lot of people really focus on. We kind of think about that as being the ace in the hole when it comes to the company. And then when we're looking at Google Cloud, that's kind of like that new shiny object that the market's really focusing on here. And I think Google Cloud will be a headline number that we will have to focus on. One thing to also note too, they did adjust a couple of quarters ago. They did adjust their structure for that business segment. So some of the comps on a month or a quarter-over-quarter basis, or even a year-over-year basis, are not going to truly reflect the new structure as they moved R&D out and moved that into a different segment of the business here. But what I would say is, once again, that commentary, making sure that the communication around their AI projects has to be crystal clear in their conference call. One thing I do also give credit to Google for, Alphabet, if you will. Their executive team is very straightforward, very transparent, and they usually have a very low bar when it comes to their conference call. They like to tell it how it is. They don't really like to sugarcoat. So sometimes we do see negative reactions post their earnings announcement because of their outlook moving forward, which I think is a healthy thing, to say the least here, but you don't really want to have that type of tone when you're talking about your AI projects, because there's a lot of other companies like Microsoft, NVIDIA, AMD that are doing a lot better job in trying to lay out the landscape, if you will, when it comes to future expectations for that product offering.
Okay. Double-digit growth, top line, going to be feasible?
Yep.
Yeah, I mean, at this point in time, even if you took a look at the low estimate, it would be around a 12% year-over-year growth on top line. So we are expecting that, and if you have, high double-digit growth, say 18, 19%, I think that's going to be a positive for the marketplace. We are seeing some call size skew when you're looking at the options pricing here. So the market is expecting a pretty decent number on top line and bottom line here, and they are expecting the stock to advance post-earnings.
Okay. All right, so expectations certainly high, but at least the market has not been super exorbitant in its Alphabet rally, compared to some of the others. It's been a little bit more contained. We're at records, yeah, but we just got there last week, so I guess maybe the bar light is extremely high, or the bar maybe. All right, thank you, Kevin Green. Appreciate the look here into Google Alphabet. Let's trade it with Tim Biggin, the option strategist at Delta Derivatives. Tim, what do you think for Google? I mean, we got the all-time highs, and we're just kind of hanging out there.
Yeah, absolutely. And this is a stock that is, better come out with, a earnings beat and a pretty solid one, in my opinion, simply because we are getting to overbought levels technically. By far the highest, levels we've seen over the past year here. RSI pushing well over 80. We're seeing Bollinger percent B over 1. MACD at extreme, trading at a huge premium to the 20-day moving average. So certainly getting a little extended technically. And on a valuation basis, price to sales now in the mid-6s. At the highest level also in the past year. PE ratio approaching 40 almost, so again the highest in the past year. So everything is priced for further upside. Kevin mentioned the call skew, so people rushing into calls. So I'm a little bit more cautious than most, simply because of the move in the stock and the way that everyone is anticipating things just continue without a pause here. So I'm positioning for kind of a pullback in Google here, at least of some magnitude. The expected market maker move range on the straddle is just under 5%. So I'm going out buying the traditional February 16th 147 puts, selling this week's 147 puts that have earnings in them, paying just around 60 cents for this. More importantly, selling over a 70 IV this week and paying a mid-30 IV next week. So love that term structure, about almost 2-to-1 advantage on the vol I'm receiving. So I have another week to hedge if need be with the February 9th expiration options. So kind of like it on all fronts here. I know I'm in the minority camp, expecting maybe some of these stocks to at least slow down a little bit. That's all it'll take in a pullback towards that former breakout point at 147 as well, the lower expected move range, I think maybe in the cards for Google post-earnings.
Seems like a trade that really only works when the options are pretty well bid, because you get yourself a pretty nice range. Essentially, you're aiming to profit from folks who are betting on an extreme outsized move in this.
Yeah, absolutely. This one, the lower implied volatility goes generally, and this is a low lever generally for Google and stocks overall. The bigger the comparative skew is on this, the term structure of Val, simply because they're able to buy such a cheap Val to hedge with, and the earnings week, the event Val is elevated. So I think going forward, this kind of trade structure is kind of what I favor here. We talked about last week in IBM. I lean a little more bullishly there. Both options are going to start worthless the week after a credit initially. This one I prefer more to be a little bit more bearish on Google here, just given the big ramp up it had over the past month or so.
Okay. All right, thanks, Tim. Like the trade. Good approach in Alphabet. Appreciate it. Thanks, Tim Bacon, lead option strategist at Delta Derivatives. Coming up, we're going to talk about living a stress-free financial life. That is the objective of the new book from Jared Dillon. Been here on the network with us a few times. Don't miss the conversation when we come back.
Netflix at a symmetrical flag. Getting ready to squeeze again. We're at support right now.
stress. So the question is, even if you had the ability to ride out the ups and downs, is that something that you really want to do? Do you want to go through a 40-year investing?
I want to drink your blood.
30% drawdowns, 30% drawdowns, 40% drawdowns, and experiencing all that stress when there is a better way.
And how much of that needs like a portfolio structure? Do you get into specifics on portfolio construction in the book?
Yes, absolutely. So I invented something called the Awesome Portfolio, which is 20% stocks, bonds, cash, gold, and real estate, and it's rebalanced annually. And this portfolio, you don't trade off much in the way of returns. It returns about 8.1% over the last 50 years versus 9% for the stock market. But your max drawdown over the last 15 years is 12%, and it has half the volatility of an 80-20 portfolio.
So that's the key, right, is that most people get stressed by the drawdowns and end up making decisions they regret later on.
Absolutely, absolutely.
Okay, so trying to minimize that, I like that. All right, on the debt side, I mean, what can people do? Not to give like the whole secret sauce away from the book here, but what can people do if they're already in? I feel like the debt situation a lot of times is already like sunk costs in a way. You know, people find themselves with student loan debt or whatever it may be.
Well, a lot of people have read this book, you know, and they're contemporaries of mine. They're in their 40s or 50s, and they say, gee, you know, I've already made a lot of mistakes with debt. How do I get out of it? And a lot of people, when they approach this, they try to undergo austerity. They try to cut expenses as much as they can. But there's a limited amount that you can do with that. So what a lot of personal finance books don't do is tell people to make more money. There's a lot of things you can do to make more money. You can get a raise, you can change careers, you can get another job, you can work a second job, you can start a business, you can do passive income. But the solution to getting out of debt usually isn't to cut expenses to the bone, it's to actually increase the revenue side, not the expense side, the revenue side, and make more money.
Love that. All right. A take control standpoint. The other thing that stands out to me in some of the notes from your book is that you talk about an abundance mindset, which in your book you aim to purge the urge to splurge. So that I like this. This almost sounds like you've got a therapy section in here.
The whole book is really a therapy session. So it's really, most personal finance books or personal finance experts will tell you that it's a million small decisions that determine if you have money. For example, when I drive to work every morning, I buy a coffee from Dunkin' Donuts. It costs $3.80, and they say, if you give up the coffee every day for a year, that's $900. If you do that for 40 years, that's $36,000. If you give up coffee for the rest of your life, you'll have $36,000. But
How dare you?
if I make one decision, if I get a house that's 500 square feet smaller than I would have, that will save me $120,000 in interest over the life of that mortgage. So people can give up large luxuries. They can live in a smaller house. They can drive a cheaper car, but they find it very hard to give up small luxuries. They can't give up the coffee in the morning. It's too hard.
I like that. All right. So there's more to fixing our financial situation and state of mind.
Well, I quit drinking Starbucks back in 2001 or 4, somewhere in that area. And it was across the street. So I was able to get out of work, go buy me a Starbucks, and then come back. And there's nothing special about Starbucks coffee. Nothing. So I got me a French press. And I started French pressing my coffee. I'd buy it in bulk. 5-pound bags of some of the best coffee you could buy. Sumatra. I paid up to $45 a bag for Blue Mountain Jamaica coffee. I think that's my favorite. Right now I've been drinking bean coffee ever since then, so it's been a long time. I just upgraded it. It's what I did. Instead of buying it fresh, I mean, freshly ground beans right there in your own home. Takes like 10 days for them to spoil once you break them open. Not spoil, but I mean lose a lot of that good earthy chocolate yummy taste. The Chart Master coming up next. JP Morgan hit the second deviation channel on the 1 minute. JP Morgan. We'll see if it pulls back from here. Well, they got that Bitcoin all wrong. Netflix pulling back to double bottom. The boy was pumping AMC this morning. Says we're going to break out this week. He doesn't know how to trade. He admits it. But he's still pumping it. Now, Boeing's pulled back to 200. Boeing reportedly withdraws the 737 MAX 7 safety exemption bid. And I don't know why they did that. Sounds like they're trying to cut corners again. China. Nile back down to support. Someone just bought 22,000 shares of it. We broke out of the snake yesterday, and then we pulled back to the support line. Hike. JP Morgan, boing. Well, I'm going to go get my lunch going.
They're kind of big event risk situations, so really kind of behaving as you might expect. But if we were to look at our standard deviation channels here, we take our blue line, our linear regression line, line of best fit, one standard deviation to the upside, comes in right around 447 or so. So that's, yeah, pretty close. That would be
he used the linear regression on the standard deviation.
We've got 21-day EMA in yellow near 432, our trend line. Then we've got that 425 level that I mentioned, those old highs and lows. Pretty close to our linear regression line. That can be a supportive area to watch.
All right, so support down below, which is encouraging. Rate of change, though, might be approaching kind of the limit of the speed based on the way the last year has gone, with the standard deviation pretty close to where we're at. Like that for MasterCard prep into earnings. Nice, pretty good looking chart for the most part. Starbucks things start to get a little bit more interesting, pretty choppy, pretty weak. What are we looking at here, Jenny?
So this name, what I find so interesting about Starbucks is I know that it has like a massive presence here in the U.S., but I think this is also a really good barometer for how things are still recovering in China, because last quarter we saw the U.S. was really their strength. They beat on sales. They pretty handily topped same-store sales expectations, also earnings. Well, this was all because of the domestic strength, though, not really international. So now it's time for their second largest market being down in China to start to recover a bit more. They have massive growth plans in the country. It plans to expand to around 55,000 stores in the nation by the end of this decade. So that is completely insane to me, but it just goes to show how massive of a market that is for Starbucks. And although this period will not include their infamous pumpkin spice latte and all those drinks that really do actually have an impact on foot traffic, they also have these seasonal winter drinks, which could provide some lift. So right now, they are dealing with the fact that innovation is something they need to continue to churn out. This is a market where the consumer has never been greedier than ever, and there's so many various like mom and pop coffee shops. There's Dunkin', there's McDonald's, and there's Starbucks. They're also fighting for that market share here. But again, I think this is a really good read on how the situation could perhaps be shaping up in China, just given their massive exposure overseas. And of course, the fact that people are still willing to pay, I mean, like really lofty prices for these drinks. Which Alex Coffey always says is, ironically, his name is like so perfect for this segment, but he always says that this is basically a consumer staple to those that know and love Starbucks.
We just heard from Jerry Dillon that even if you want to clean up your personal finances, you don't have to cut the latte out. Just downgrade your apartment, you know?
I so disagree with that. I am so upgrade an apartment, don't get Starbucks.
The kind of China rule here, it's like a China stock in disguise in a way because of the big growth expectations there. Also competition here, to your point. That's why the food is so important to Starbucks, because a lot of other places don't have that draw, and some of the big Starbucks flagship stores or, you know, roasteries, whatever they call them, they've got pretty great food.
Yeah, and they're like in premier locations.
They got great food at Starbucks. What are those stores called?
I think roastery.
Something like that? All right. So Rick, chart kind of desperately holding on to lows, it seems like.
Yeah, downtrending since we hit those 52-week highs. You can see our blue trend line here connecting with the recent highs that we saw after a big earnings gap to the upside. Now, this was notable because it was shortly after we hit our yearly lows near 89. Big gap upward here. Fizzled out very quickly though here. We can see we had a steep downward trend line here that gave way to a more gradually sloping falling wedge type shape here. We did have an upside breakout here, but kind of just moving sideways, just kind of meandering beyond our trend line boundary there. It was looking a little bit promising yesterday, I thought, because we closed above our yellow 21-day exponential moving average. It was looking like the slope of that line was starting to flatten out, which is better than sloping downward if you're bullish here. But today, smacked back down below that line once again here. It was also looking promising, I thought, because we invalidated our downward sloping trend line on the RSI, our measure of momentum. It was looking like we could potentially cross above that 50 midline as well. It was not to be. We are still in bearish momentum. We're below our moving averages. They're all sloping downward. Not the greatest situation here. So, support 91.86 represents where we had that gap form, and then some subsequent lows that form there. So we held the line at the gap at least. We didn't break below that point. A bit of stability here. If we do break below that level, the old lows, 89.21 is one place to watch. To the upside, we've got our 3 moving averages to follow here. But the ultimate point that really caught my eye, these old highs that we reached.
He's got it charted just like I do.
Because those are also roughly in line with our volume profile point of control, our area of heaviest trading there. I think that we would be kind of stuck unless we were to really push above that point.
Okay, so the Starbucks has got a lot of overhead pressure on the chart to contend with, though in the last 3 weeks on the margin, it's improved a little bit, so it is kind of stable. Seems like there's a chance then that maybe we kind of take this 92-ish level, use it as a base to lift to the lower lows maybe that we got the last year, and maybe some higher lows. It's kind of the hope for Starbucks that we bounce that 92-ish area, but it's going to be tough to get too far with all moving averages ahead of us, above us, resistance. All right, tough chart, but probably not as crazy and but recently negative as Boeing. Big run to Boeing, then the big sell-off, and I mean, this is a hard one because
I think we might squeeze and get a breakout on Starbucks on earnings.
And the investigations into 737s show up in this report?
So I think that is a really good question. I also think it helps that we've heard from now Alaska Air that they resumed the flying of the 737 MAX 9 jets. So that is something that doesn't impact the earnings. I mean, like, talk about the ultimate, to give it and to take it. And I feel like this has been going story for the last 4 years.
Right.
A lot less greed on the table now than there was.
Issues that are just like safety concerns, and of course the FAA is still regulating or sort of still probing some of their other aircrafts right now, or like right now doing widespread investigations. That's also not exactly what you want. Last
Where's
week,
Tesla?
United CEO Scott Kirby last week saying perhaps they're
Damn.
looking to partner with
Am I
Airbus.
losing
And I mean, I
frickin'
totally
tickers
blame
again?
them at this point with their exposure to these 737 Maxes. So I think that that's a concern. Right now, they haven't exactly pulled any of their orders, so nothing has changed. Just commentary around that from, of course, Scott Kirby isn't what you want heading into Boeing.
Commentary, right? Story that's going to move this, because the earnings are going to improve from a year ago, because even the planes that got grounded, they already sold them, so like they're already moved out. The report's going to show a pretty clear financial improvement from a quarter ago and a year ago.
Right, so that's what's also interesting is I feel like this earnings won't be indicative of all of some of the grounding.
going on.
Exactly, yeah. So that'll be interesting. It'll be mismatched. I'm sure the earnings
I'll be
will
right back.
strong, like you said, because I mean, just like relatively easier comps, they have ramped up their production, but I do think it almost feels a little bit like at this point it's all about PR, because I think Scott Kirby is going out and saying, we might partner with Airbus to basically say we're concerned about the safety of our passengers. I think you kind of have to do that at this point.
Yeah, you've got to diversify, if you can, especially just for your own good, from a utilitarian standpoint. Even looking beyond just, looking beyond the customers, just from a pure utilitarian standpoint, if your job is to fly, and if Boeing's going to have a higher risk of grounding, you should be diversifying your fleet with other plane makers. Rick, how do you look at this chart? I mean, where did it begin?
I would begin right here with our earnings event that we saw in July, because this is the start of the heightened volatility in this stock. You can see we made our way up a little bit, rapidly gave back all those gains, culminating with our yearly lows near 176. Then a sharp rise upward here. And you can see this area that I wanted to highlight was right here, where we had this gap that formed near 197, a push upward then, rose about 35% into those 52-week highs. Once again, quickly erased, almost completely gone since that point I mentioned, that gap up here. Notably, we did not fill the gap though. We came very close, but the gap was not filled, so that still remains a support point to watch, 197.26 here. Looking at momentum, we can see that we are making a little bit of progress to the upside here. A trend line based on 2 points, not the most significant thing here, but we are dipping below it here. That very short period of rising momentum seems to be getting validated today already as we make a low close beyond our previous low close 2 days ago here. we're below our moving averages. They're all trending downward. They're divergent. The faster moving averages are crossing below the slower. Not a great situation here. We also gave up, most crucially, our purple 250 two-day EMA and our volume profile point of control. So, as I said, support near 197, that could be an area to watch. Resistance here at this gap, near 217, that represents a gap downward plus some old highs. We're getting pretty close to having our 21-day EMA there as well.
Yeah, really interesting. They tried to rally it off that big sell-off, and then it gave it right back. So haven't made a lot of progress on the momentum, but it has sold out going into earnings. This too being kind of a market-wide sell-off in September, October last year. But we've got a lot to prove for sure. And one thing seems certain is that it has potential to be very volatile. Thanks, Rick, for looking at the technicals. Getting more on the fundamentals coming up. Got a little update on earnings. A winner from the recent report. It's going to be the index business, MSCI, rallying. We'll give you that update next ahead of our market meetup.
We're back down to the shoulder line on MSCI.
I remember when I first started flying.
She remembers. I don't want to push my luck. The 550s now. See if I can get in this trade. SMCI, scalping the weekly, looking at the 550 strike, one contract. Had 490. I should have grabbed it there. Damn it. There it is. Missed it.
Big rally here.
$100.
Almost or more than a 2-year high right
Man,
now. This is
620 now.
The revenue soared past estimates, achieving double-digit increases in subscription revenue, and also this stock is soaring past.
This is a big mover here.
When it comes to sentiment, because it was just a week ago that Ben Axler had been talking about shorting this stock right here on our shows. Here's what he said when we spoke to him last week.
Is now pivoting investors away from margins to adjusted EPS. And this just happens to come at a time where they're struggling to grow their cash flow. In addition, look at the dividend growth. It's fallen to an all-time low. What is that signaling? It's signaling that there's pressures ahead, okay? We dig deeper, obviously, into the numbers, and then to your point, we find some aggressive non-recurring revenue recognition there. On the cost side, they have wide latitudes.
You were wrong, buddy.
Costs among various segments. So we fail to understand how some of the segment margins are increasing in the face of client defections. And as a point overall, for the first quarter, total clients fell, and client retention challenges, particularly in the index business, have been down 4 quarters in a row.
saw the quarterly dividend increase, and we also saw subscription revenue rise during the quarter. But if we take a look at the numbers, we can see that adjusted earnings came in at $3.68. That was nearly 30% increase year over year, and it was well above that estimate of $3.29 a share. Operating revenue was $690.1 million, far above the estimate as well of $662.6 million, and
it's a lot of spending.
much higher the revenue a year ago at $76.2 million. That was more than 9 times
Wow.
the revenue of last year this time. And recurring subscriptions to its index segment rose about 11% to about $210 million in the fourth quarter. And ESG and climate units saw a 20.3% jump year over year in revenue to $74.8 million. But when we look at the total run rate, it was up about 16% year over year to $2.69 billion. And the company raised its quarterly dividend by 16% to $1.60 a share in the first quarter, which means it'll be about $6.40 for the full year. Now, looking ahead, MSCI is expecting to increase its expenses for the full year for 2024. Operating expenses will go up to between $1.3 billion and $1.34 billion. That was above the 2023 expenses of $1.14 billion. And then the company is expecting free cash flow to come in at $1.29 billion at the high end. That's up from $1.15 billion last year.
A lot of improvements, wow. And growth on the ESG side too. I know it's going to be frustrating to Axler's short cases. That was a big part of it. And his argument that was going to fizzle out and would be a bust. So big rally. Maybe some of the shorts that had followed that report getting squeezed here. Thanks for the heads up. MSCI big winner. All right, Renee Young from the newsroom here in studio. Got Dan Grant, senior specialist for retail trading, Charles Schwab, and Kevin Green's on the line with us again, senior markets correspondent for our market meetup, our discussion here. We got a little bit of bond sell-off today after these impressive consumer confidence and JOLTS data. And yesterday we had an even bigger bond rally, though, on the Treasury announcement. What do you think's going on?
Yeah, so I don't know as far as what the setup for Friday's numbers are going to be. I mean, the numbers are kind of already, the bets are already down for tomorrow's Fed hike.
Okay.
The rest of the year, the Fed hikes are still in play.
Cuts,
excuse me. And the Fed is still doing quantitative tightening, so I think it's really important to see what that balance sheet runoff, if there's any change to the language on what they're going to do.
A lot of people say they're gonna change that.
They're going to have to change it according to the money market funding rates.
Yeah.
But to say that we're going to see 4% Fed funds rate by the end of the year is kind of it's overdone, right? And then you look at the 3-month funding rates are all the way down to 3.3 at December 25. Those are based off the SR3 contracts.
So there still are a lot of expectations for the rest of the year. I mean, we're at 5.25% right now for Fed funds, and that means we get a lot of cuts coming. March at a coin flip, basically.
March at a coin flip. I think there's still a chance, right? I think it's like 10 basis points above there as far as price, and yeah. The hope for soft landing is increasingly plausible, right? So that's going to increase focus on this jobs number on Friday. And we're going into earnings season with stocks going up, making new 52-week highs. The Googles, the Microsoft, the Meta.
Yeah, we're looking at the numbers. Actually, they've dropped now about another 10 percentage points because bonds sold off after that data this morning. How do we think about these swings in the bond market, KG, when we get a big rally on a Treasury refunding announcement, give some of it back the next day on the data? I mean, it seems to me like the data should be more important if that's what's going to drive the Fed's decision-making process. What do you think?
Yeah, I agree with you. I think even though we are seeing a little bit of volatility when it comes to the yields, it is still in a tight range, right? Looking at that bottom range at around 3.9%, that upper range at around 4.25% at this point in time. So I think the market's just trying to find the equilibrium, and once it can do that, I think the equity market is going to be able to tolerate that, and that's why I could continue to see the movement to the upside here. I think yesterday too, just to kind of put a point on this, that refunding update, it's not on a lot of people's radar. So a lot of economic calendars did not have that particular announcement. They did see an adjustment down about what, $65 billion from the
First support, I got 4915.51 on the SPX. Now we got Fed tomorrow, FOMAC. We do have a wedge. And we are there. So we could bounce here. We could. See if we come back and retest it. It's a 1, 2, 3. 49.30 strike. 49.30. Damn it, missed it. See, it's very important we break out here. I'll tell you why. Because we have 1, 2, 3. We failed. Then we came back and hit it the fourth time right here. I'm using the bodies of these candlesticks. So we got 1, 2, 3. It has to go up here. If we come back down, I'm pretty sure we're going to knife. Not paying much anyway. $40 for that run. Open interest at 2.74K. Well, there's 60. I didn't take the trade. I missed it. Now watch it. If we break out, I have to break out here. It has to. And I'm going to be looking at a put. The 49.10 put right here. It has to break here. If it doesn't, then I'm going to log down. Not in it yet. Could change. There it goes. So I got to change call. This is called a falling wedge. Jesus. Stick with the banks. Ready, set, go, baby. There she goes. It has to break, Jimmy said. Yep, there it goes. Dropped right there on me. That's not good. Now we got to hold that support though. We broke out of it, so if we hold this, huh? Spies at the VWAP. Oh, what happened? Oh, that's what happened. I'm about ready to get stopped out here. We're still respecting that trend line. There. Now it's going to drop. Boom. And the SPX. Break it. Back to even. I should have added on down there, man. I had an opportunity to get it at $3. That would have really made a huge difference right there. Two of them at $3, that'd been $200 right there. I don't think I'm going to get much on this trade, so I'm going to get out of it. I'll be right back. Maybe a little break here. A lot of green's gone. I like to know where all these. Keep thinking I'm missing tickers here. Netflix is back at the bottom.
So good, off to a great start, technically looking very good. You know, they say so go January, so goes the year, and I might sound hyperbolic, and we might be saying this on financial news all the time, but this is a really monumental week for the markets. Now, I know we're not really expecting much out of the Fed, but that policy statement is going to be very important because right now, the market is 50-50 whether or not there's going to be a cut in March, and that's going to move the markets. I think we're going to have a much more decisive look at whether or not the Fed's going to cut this week. We also have, you know, the jobs data this week. So far, so good on that front with the JOLTS data this morning, and not to mention the huge monumental earnings we have this week. We have 5 of the largest 7 companies in the world reporting this week. It's a big week to say the least.
Okay, so that being said, first up, I think we have Apple. Tell me about that one.
Yeah, so Apple might look the weakest of this Mag 7 for me right now. It's up against 2 downgrades heading into this earnings. There's some question marks on how strong they are in China. You know, they pulled out of China. They've been putting some restrictions on them. So how strong are they in China?
We got a snake here on Apple.
Are they still continuing that growth, and are they able to supplement that elsewhere? There is a lot of talk about the watch and that contract dispute or that. But I think that's overblown. I don't think that's going to factor much into this earnings. That said, technically, it looks a little weak. I'm worried about the downside post earnings.
Damn.
I see. All right. I mean, the trend lines on some of these names have been a little, I guess, intimidating, I'll say, on some of the Mag 7. Rick, why don't you tell us? You're doing the charting on Apple. Your thoughts?
Definitely the weakest of the three that we're looking at today. And you can see, you know, you mentioned the trend lines here. We had a downward sloping trend line in blue here that gave way to an upward sloping trend line in white. Notably, we stopped our last advance very shortly above our previous highs that we hit there. So we couldn't quite crack the 200 level. We did carve out some new closing highs though. We also did not make our way that close to those highs during our most recent run upward here. And this stock was looking quite a bit better this morning. We're kind of falling off here quickly. We have fallen below our yellow 21-day exponential moving average. We've tested our orange 63-day exponential moving average. The 21-day EMA has started to shift its slope from upward to downward as well. That's an important sign of potential trend change. The slope of these moving averages kind of can be a warning sign when the trend is starting to roll over here. And we've had, you know, let's see, we're on pace for our 5th red day in a row here in the stock.
I love it.
We can also see, if we look at our RSI, momentum has been trending down for quite a while here. Today as well, we are slipping below that 50 midline here that separates bullish from bearish momentum. So there's another potentially bearish signal that we're generating here based on our falling price action here. So support, 63-day EMA in orange there, crucial point to hold near 188 as we head into the close. Obviously, resistance is our old highs here near like 199 or so, around 200. That level would be a key area to watch here. Also, this green line, 180, that was the highs that we formed after a gap down here. That was about where we topped out as well, around that point, then bottomed out twice near that point. So that could be another key line to hold to the downside if things really start to fall apart.
Right, understood. Yeah, Jay Woods was talking about, who's often on our air, was talking about a lot of these trend lines because the Magnificent Seven is what everybody loves. They loved it in 2023, and so the question they're asking about is 2024, what to do. Tell me your trade here, Joe, final thoughts on Apple.
Yeah, so historically after earnings, it's about a 4.3% move. The options are pricing at a 3.2% move. Makes sense for me to buy some protection, use some optionality. Really, if I don't even own Apple in my portfolio, I still own it. It's such a huge component of the major indexes, so it makes sense to protect my portfolio, buy some downside protection. I'm just looking at the March 190, 180 put spread, $10 put spread costs $3, with a 3-to-1 payout if we close below 180 in March.
Okay, next up, Meta. Your thoughts on Meta?
Yeah, it's just going straight up and it cannot be stopped. It's like the reverse of a falling knife. You know, it's come so far so fast in the falling knife scenario. You assume at some point it's going to stop falling and turn around. Same thing with Meta right here. At some point it's going to stop going up, but it is just so explosive. It's
It sure is, sir.
things I'd be happy to be out at this level. I'm going to look to buy right the name here, collect some premium with these higher premiums and earnings, and get a little extra cushion to the downside should there be a adjustment to the expectations for earnings for the rest of the year.
All right. We had Ted Weisberg on, and he was talking about buying that pullbacks. He's had it for so long. Tell me a little bit, Rick, about this chart here.
Well, I mean, I would echo Joe. It's just an absolute beast of a stock to the upside here. Yeah, the opposite of trying to catch a falling knife, maybe trying to pull down a rocket that's blasting off or something like that. Seems like it would be a pretty dangerous short to make right now. Although, you know, you never know. Earnings could disappoint. We could trend downward here. But looking at our chart here, we can see that we've had acceleration of trend. We have these two lines here in green, modestly trending upward, that gave way to a steeper purple trend line, then the steepest of all, this white trend line right here, and we've culminated in some new all-time highs today. Not making a lot of net movement since the open, almost a doji type candle that's forming here. There's still plenty of time left in the trading day though, so I wouldn't go jumping to conclusions about that just yet here. RSI, our measure of momentum, reflecting this acceleration of trend. We can see we had a blue trend line that gave way to a steeper green trend line. RSI about 80 right now. Remember, RSI only goes from 0 to 100, so a reading of 80 is quite elevated here, suggesting further bullishness here. The bearish signal would be when the RSI crosses below that 70 threshold.
He has a pretty simple way of reading charts. I kind of respect that. There we go. Yes. Nancy, would you please hit the, what? What are you doing? You're drinking vodka. How about hitting the steamer there? I have a shot of vodka. I didn't get out. I'll be right back. I think we've got some upside, but I'm not sure. Now, break it. This upward trend line to give me support. Yay, baby. There we go. Uncle Jimmy's going to take profit. Quack. Breaker 19. Long jack. Break it. Nope, that's it. Oh, you stupid. Now, what do I got the price line on this side for? This should never happen. People are a little bit skittish. I can feel it into tomorrow. My ding-a-ling went off. There it is, 440. Bam, got it. You don't mess around with me. Resistance number 3, Jimmy gets out of the trade. Jimmy's out. I think I made my point. I'll take it. So Jimmy charted up 3 different resistance levels. Zippity-doo-dah, zippity-day. Understand, I don't mess around. Big John. Big Bad John. Did you see that? Jimmy said we had to break here. We had no other choice. This was the last chance. Right when I got in down here, boom. Actually, I got in at a little higher spot at the breakout. But that's nice. That's just a great example. 1, 2, 3, 4. Then third time down here. If it would have went down one more time, I would have went putty. Head and shoulders on NVIDIA, 5-minute chart. Thank you. Percy.
Huge week for earnings, and these mega cap tech names certainly in focus. And how about we start with Alphabet, some of the street estimates, what people are saying?
Yeah, definitely. We're actually seeing a little bit of a wide estimate. We're looking at the revenue number here. We have seen an estimate between $70.7 billion and all the way up to $85 billion here. So there's a lot of expectations when it comes to the Google's cloud business.
Oh,
to
no.
say the least here, Nicole. So we might see some volatility
Oh, no.
after the initial print of these numbers after the market closes.
James.
The earnings per share estimate is at $1.60. It would be around a 52.4% increase on a year-over-year basis. And once again, we're looking at Google Cloud revenues. The street is actually estimating that that business could see growth around 23.6% when you look at the revenue number. And we also are going to get a little bit of an update here when it comes to their AI integrations. How are they integrating AI when it comes to their overall search product, as well as the YouTube product offering as well, because the majority of Google's revenue is still going to be generated from ads, and we are expecting to see actually ad spend increasing over the last quarter here. So overall, we are seeing around a 4.4% implied move from the options market. That could be to the upside or downside, but there is definitely a little bit more of a bullish sentiment when you're looking at the options trade right now rather than a bearish one. I'm really looking forward to seeing this company report earnings here after the close.
All right, we'll be talking about that later. And what about Microsoft?
Microsoft is going to be a little bit similar here. We're going to be focusing on the Azure platform, and we continue to see these rapid growth rates to the upside, especially with their AI offering. And that was one thing that they called out in the last earnings announcement. They did attribute some of the growth due to AI, as well as the Copilot product offering, as well as we are expecting revenue to come in at $61.03 billion. It would be around a 15.7%.
Oh, God, 520.
Year-over-year basis. And the adjusted earnings per share estimate right now is $2.76, would be around an 18.9% increase on a year-over-year basis. When we talk about Copilot and the
left another $50 on the table.
Business, we are also expecting to see around 11.4% increase on a year-over-year basis.
A contract.
It's all about the commentary in the conference call. They usually provide their guidance on the conference call, so we'll have to wait for that side. And they have been a little bit bearish when it comes to the U.S. economy, which has caused a little bit of a pullback post earnings. Let's see if that's going to continue or be a trend for this earnings announcement as well.
All right.
All right.
For all of those, see you later. Closing bell. Kevin Green, thank you so much. Great to see you. Markets correspondent. Big week for earnings, folks. In the meantime, also big week for economic news. January FOMC meeting.
You have a little bit of Mexican in you, honey?
Press conference is tomorrow afternoon. More on the rate environment, our economic conditions. Joining me right now, Brad Case, Chief Economist at Middleburg Communities. Thank you so much for being with us.
It's great to be with you.
So big week here. I had a guest on who said 6 rate cuts this year. Felt pretty confident on that. A lot of other folks are saying no way. I mean, how do you feel about the big picture?
Look, we keep on looking for signs that the rate hikes over the last few years have brought the economy more into balance, and we keep on not seeing convincing signs of that. So I think there's no chance of a rate cut at this meeting. There's a lot of questions in my mind as to when the rate cuts can start and how many there can be. It's not going to be aggressive.
Are you thinking more like 3 or 4 versus 6?
That seems, 3 or 4 seems most likely, but it may not be at the next meeting. We need to get data that shows us that the rate hikes really have done their trick. There's still too much inflation pressure.
So at this point, inflation's going in the right direction, but it's certainly still evident, right? Tell me.
I'll be right back.
People are still at the grocery store or wherever. They're still seeing inflation, aren't they?
Well, I would say, actual inflation has really gone away. What we're fighting now is not so much the actual inflation as the pressures that it might cause it to come back again. We just don't want this zombie to
Before I leave, YouTubers,
we want to see,
you see this picture right here?
survey evidence that people are
This is on a 1-minute time frame.
And we want
We
to see
had
balance
2
in labor markets, we want to see
huge
balance in consumption.
engulfing
Consumption's
candles.
Still been so strong. Income growth and wage growth have still
2
been so
huge
strong.
ones. I mean, these things
We
are
don't
big.
want a recession to kill inflation
I
off.
mean, they kind of stand
We
out,
just
right?
want balance in the markets and
To a double
the reports
bottom.
that we keep seeing say
It
show
stopped
us
right
getting
here.
closer to that situation.
And that's
but
called
we're
a
not there
double
yet.
bottom.
Right. I mean, for example, mortgage
2
rates
huge
have
big
come
candles.
down, but they're not back down to where they were.
Right, and I don't think anyone.
This is called a falling wedge.
Very, very
Yeah, tell me a little bit about housing. Can you expand on that?
falling wedge.
It's difficult to buy a house right now, partly because of mortgage interest rates. But
That's right.
historically speaking, these mortgage rates are not high. They're just high compared to where they were in the last few years. The main problem in the housing market right now is how much the houses cost. And we certainly don't want the prices in the housing market to come down, but that may happen. The main thing
Say
is
something
that,
else,
is that
AI.
people do have the incomes to support.
I want to see if I'm recording
to
you.
support housing if the prices were normal.
Go yabba
But
dabba
the
doo.
prices are are much higher than they really should be.
Isn't that inflationary?
I'm sorry?
Is that inflationary?
Speak when I'm talking to you.
So it's inflationary if people are struggling to make payments on a
Okay.
house. But what they're doing instead is saying, I'm not going to buy because it's a crazy
Somebody else
environment.
hearing something?
And that's likely to remain that way for a long time.
YouTube?
Tell me about the JOLTS number. I mean, for example, we did see the JOLTS come in, and we saw the rise in December, the highest level in 3
Hearing
months.
crickets.
Revision for November, also jobs
wonder
are
what that
evident.
is.
How are you feeling? Because there are not as many layoffs as maybe some people expected, not as many quits as maybe some people expected. Where do we stand in the labor market ahead of Friday's numbers? What are you going to be watching for trends?
Well, Friday's numbers are much more important because the JOLTS
Oh, they can hear her probably.
look for in JOLTS is the ratio of the number there are. And we've had
YouTube,
too
can
many
you hear
job
her talk?
openings relative to the number of unemployed people. The way that that's going to cure is more people
Can you hear
entering the
these
job
idiots
market,
talk?
so available to take the jobs that are already there. And as long as we have too many jobs relative to the
One way
people
to find
looking
out
for
is
work,
pull up my phone.
That's an inflationary pressure.
So for right now, you still think there's too many openings?
Yeah.
Well, that's good for somebody looking for a job, right?
It is good. You know, it's
Yeah.
not good if you're one of the ones who can't find one. But as for the economy as a whole, there
Heck
is
yeah,
too
you
much
can hear it.
wage pressure, and that may cause inflation to come back.
I see. Tell me about Friday. What are you going to be looking for there?
The most important thing that I look for is the employment to population ratio on people who are the first to lose their jobs when the labor markets start to weaken. I'm talking about black workers. I'm talking about
It's on
Hispanic
default.
workers. I'm talking about adults who never got a high school diploma. I'm talking about youth workers. When that starts to weaken, pressure.
So for right now, you still think there's too many openings?
Yeah.
Well, that's good for somebody looking.
I'm talking about black workers. I'm talking about Hispanic workers. I'm talking about adults who never got a high school diploma. I'm talking about youth workers. When that starts to weaken.
Okay, now I got it off.
So for right now, you still think there's too many openings?
Yeah.
That's good for somebody looking.
I'm talking about black workers. I'm talking about Hispanic workers. I'm talking about adults who never got a high school.
So for right now, you still think there's too many openings?
Yeah.
That's good for somebody looking.
I'm talking about black workers. I'm talking about Hispanic workers. I'm talking.
Okay. I gotta figure out how to do that right. Meta's pulling back to support. Meta. coffee smells good. Gosh, SPX 510. You sick. I think I get a lot more out of Schwab than I do out of Squawk Box, Ameritrade, CNBC is what I mean to say. A lot more educational. They pull the charts up. That's what gets me sold.
Well, I think, yeah, first, I mean, you look at the price action, there was a big boost from the earnings back in early November, and then you throw in Bitcoin going into the end of last year, and you throw in block, and there's also, I think, that element to what we're seeing price action-wise. So you're right, it did effectively go nearly double from about $41 to $80 to the end of the year in December of 23, but then it's pulled back a little bit, but it's starting to look a little constructive now. Based upon the earnings estimates on a forward basis for the company as a whole. And you look at a couple analysts today, there's some upgrades. BTIG, they actually moved their target of the stock to $85. While at the same time, Wedbush's analysts increased their target to 90 from 70. They actually moved their rating on the stock from neutral to buy. And if you go back to last quarter when they reported earnings early November, there was a huge boom to operating margins based upon some cost reductions in expense management, and this is essentially what Bush is looking at as
a lot of that green's gone
on a forward basis, considering there's a lot of integration capabilities between the merchant services, which is essentially about a third of the revenue for Square or Block of traditional merchant services, alongside the Cash App, which is very close to 60% of total sales. As well from a consumer standpoint. So they're actually looking at better operating metrics, which effectively will trickle down to net profit margins for the business if they can integrate some of their technologies going together. Now, also, if you look at the gross purchasing volume last quarter, it was higher by 17% year over year. Sales are actually growing respectively in the mid single digits, and the estimates for earnings, when I actually looked at it relative to last quarter, the full year 24's earnings were adjusted from about $2.43 to over $3. And that really puts the 24 multiple at around 22 times earnings. So one could consider the call is also based on valuation. And if they do increase coming up with earnings on the 22nd of the month of February by just a fraction or a small percentage, that could also boost the stock price from there.
Right. So with that, tell us about your thoughts on an example trade for this one.
Yeah, so we got to keep in mind that earnings are coming out for the stock on the 22nd, and there's quite a bit of volatility overall in the markets, Nicole. But I think at the end of the day, the pullback is a pretty nice position for long traders. Plus, like I said, the earnings estimates have been rising. So if they do have a slight beat, that could certainly push the stock higher. So what we're going to do is we're going to go and put on a long call diagonal. It's a bullish trade, but we're essentially going to sell the February weekly out of the money $74 option, and we're going to use the proceeds from that to buy a March monthly $65 in the money option. So the out of the money 74s will expire the week before earnings, and then of course they're helping that to finance the $65 March calls. And so altogether, this would cost a trader about $6 a share or $600 a contract. So essentially, the stock could trade up to about 74 in the next couple of weeks. And if that happens, then the premium we receive on those February calls would expire worthless, to which time it would be basically an open profitability potential, assuming the stock hits 71 or higher, because that's your break-even price by expiration in March, which is over 40 days.
All right, George Sills, thank you for that example trade there on block as well. Our disruptor today, really appreciate it. Thank you, George. Coming up next, our 360 round, we're focusing on Pfizer, the quarterly earnings. Our panel is ready, and what's the road ahead for Pfizer in a post-pandemic world? We will be right back.
I remember when I first started flying.
Dang. 5:30 now. Double top. Ladies and gentlemen, we have a double top. Magnificent. $60 left on the table. That was an easy trade. Why didn't I not stick with it? What? Oh my God. You see it? Again and again and again. Dadgummit. I'm gonna go outside and beat somebody up. First person I see. No. No, I'm not going to short it yet. It's 610. It went to 610. No. Dadgum. I just hate myself. So that's $140 left on the table.
go far.
I hate that. Might do it now, Johnny. But I don't know. Oh, well. La, 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 la. La 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 la. Falling wedger. Fallen wedgie. Fallen wedgie. I just had a fallen wedgie. That's not funny, and that's very unprofessional, James. Don't ever talk like that again. You will not be allowed to talk like that again. Off with your tongue. May I have a grade, please, Magnificent? And please do not...
And loving it.
Don't deduct. No deductions. I don't want to see no deductions. There, I'm going to get very mad. You don't want to see me mad. Okay. I think the trick, falsy wedge, if you have plenty of patience, that's the big difference right there. I mean, I've nailed it today, but oh, I got a copy. Dingbat. The Master of the Night Catcher. So YouTubers, that's called a falling wedge. G. James, you're not supposed to talk like that. You want to see what I do in my spare time? Besides watch Dun Dun.
Dear Sharp Curves, Toyota has more all-wheel drive sedans than any other brand.
Pizza, cook a pizza.
Hi, I'm Regina. Today I gotta make a pizza.
I gotta make a pizza.
Just a little bit.
I practice my Italian on my spare time. And that's Gina. She make a good pizza. She uses her own pizza sauce. What's the matter, you? You don't like my pizza? I'm very excited. I just now saw the grade. It's an excellent grade. It wasn't a triple plus because I didn't hold and I kind of scallywagged out of the $140 contract. So that's an excellent grade, an A plus. But man, look at that. That's perfect falling wedge. That's about the closest definition to one right there. But not exactly how I draw it. More like this right here. 1, 2, 3, boom. One, two, three, boom. It has to do it on that 3. I mean, it don't have to, but that's the best point of conviction right there. Yes, my name's James Howard. I would like to apply a job for Chartist Artists on Schwab. I think I can come close or maybe beat the guy you've got on there right now. And I'll take half his salary. Now, Johnny, this is the time where you got to think about your puts. We came up, we broke out, we pulled back, we retested with a lower high. Wait for that retest, just like we do down here at the bottom. There's your symmetrical flag right here. So if it doesn't hold that trend line, get your order ready, washboard. There it is over here. So I'll go to the put category at 49.20. 49.20. Get ready. I don't think these things are in sync. This could be an issue. 285. You don't like my pizza sauce? We use a mozzarella. I use the best mozzarella cheese money can buy to put into my pizza. I don't understand you. So here's your channel where we've got to take it to. It's hard to say. I'm going to put it right there. And if we break this trend line, the third time up here, I get out automatically. But we broke 1, 2, 3 here. We broke down. I think it's gonna, maybe. A 1, a 2, a 3. What's the matter, you? Don't break it. Get ready to set your stop if this thing breaks. We have a head and shoulders right here. We don't want that to break. Drop, I tell you. You know, I like to drink out of the Yeti. It reminds me back when I was a kid and we'd siphon water out of the well and you get that tin cup, ladle, and just tastes just pure as gold when it touches that metal, that not tin but aluminum. I guess it's tin, as long as it ain't copper. I don't look like I'm going to get my way here. There's the 3. Ah, fudge. Still in it. I don't. Oh boy.
So I don't know. That's not my area.
Full point right now.
Right now it's a little more actually. Yeah. Right. So maybe he wants it mildly restrictive, but not overly restrictive, because if he's trying to get a soft landing, you don't want it over restrictive. But the inflation numbers have to come down. They don't come down like wages, like CPI. I mean, you did get a good number in core PCE. You know, that's 2.9 now.
Right.
So it's interesting. It's going to be. Remember, we haven't heard from Joe Powell in a while, frankly.
Not till he was Mr. Dovish. And
I don't really want to hear from him either.
Now what? Right? How does he see the current state? So tomorrow afternoon is going to be. Not to mention we get earnings and dividends, but tomorrow afternoon is going to be pretty big.
Yeah, and he'll probably say some positive things about the economy. I mean, why not? Nathan, when you look at the IMF came out and they said they nudged up their global growth forecast earlier today, citing unexpected strength in the U.S. economy. So, I mean, all these good things are out there, but at the same time, do we start to stall as far as that trajectory of inflation going down, which might reignite at this point? We've got crude oil back above $77 a barrel at this point. So, you know, I think that's the fear is, hey, the economy's doing great. Everybody still expects, you know, 5 to 6, 25 basis point cuts in 2024. Who says we need to do any of it?
Right, and I think the reason that there's that expectation built in, I mean, we've mentioned it multiple times, it's because they've gotten conditioned to an accommodative Fed since the GFC, number one. And then number two, a lot of the pundits would just say, hey, look, we went in the most aggressive rate hiking cycle from 0 to 525 in history, basically, and so therefore it's too restrictive. But again, you're going to need that data to back it up. So let's say that we are, you know, resetting expectations around just how many cuts we're going to get. The whole reason the market is liking the idea of getting those cuts is that would translate potentially into, you know, more easier money out there, easier to borrow money, economic growth potential because of a more accommodative policy stance.
TNX.
But let's say that the economic data just hangs in there enough and remains robust, the consumer remains robust, that translates into corporate earnings, and we get the growth that we want. I think the bulls are going to be okay if, as long as the economic data hangs in there, as long as inflation data doesn't start to turn back up, that would be, you know, a monkey wrench, of course. But then I think that's enough to kind of continue with this melt-up that's happening. Now, if you look at the various sectors and where we're getting earnings growth, it's absolutely centered in technology. Is technology backing it up? Yeah, it does look that way. I mean, look at Supermicrocomputer and their guidance. They put up almost NVIDIA-like numbers basically last night in terms of their guidance, about 30% above their previous estimate. But I just think that, you know, are we going to need this to kind of broaden out more? We are hitting new all-time highs on the S&P 500. The RSI is not doing that, and the breadth is not doing that either. So we do still have some of that tendency to go back towards the fundamental strength and where the growth is coming from within the earnings picture, and that remains technology.
Technology bar is high. S&P 500 RSI 75 level. That's
How about this question?
Yeah.
Jerome Powell got a letter from congressmen. Did you see that? Telling them to lower rates.
Yeah.
Yeah. What does he do about that?
Well, it's an election year also.
Yes,
and
it
we
is.
don't talk politics on the show,
Nope.
but what's the influence
But
there?
when politics affect, you know, interest
Decisions.
rates, yeah.
Yeah. Let's hope they're not.
Jerome Powell's done a pretty good job so far of staying away from that and he doesn't go any. When they ask him a question that might feel partisan, he dodges it and he pivots.
Yeah.
So
There we go.
Break here when we come back. We talk our first name. That's going to be Google parent.
Exit idea.
Search giants at or near just below all-time highs that we hit yesterday. Into earnings after the close. Fast markets coming.
Gotcha. Do. I want a grade, please.
Trading at Schwab is now powered by
Come on.
Trade, unlocking the
Come
power of
on.
Thinkorswim, the award-winning trading platform. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique
I
needs
take it.
with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly.
Bingo.
With Schwab.
And I'm going to start balling again.
It's time to look forward.
Find the next trend.
From
It's time to look forward and find the next trend. Beautiful. I must say again. Magnificent. Woo! Ladies and gentlemen, I did it again. you don't mess around with the wash. Stuck. Tuck. Do 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 do. Do 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 do. Nailed it. Nailed it. Nailed it. This channel is on YouTube is an educational channel. It is not financial advice by any means. It's just a comprehensive way of trading. What'd you think about that, Mikey? Did you like that, Mikey? Two engulfing candles. We talked about them earlier. Got a rolling spinning top, long leg doji hammer, and a hammer, and a gravestone. That's a gravestone. Go get my water. Oh boy.
to 7-ish or whatever if you take that time decay into account. But if you say that implied move is roughly $8 or so, I was looking at buying the 148 put and then selling 2 of the 145 puts. When I looked at this earlier, the credit was about 39 cents. So if you get a sell on the news type event, and if it's around that implied move, you have the potential to make more. If the stock stays above 148, goes sideways, goes higher, or gaps up big, you have the potential to walk away here with at least some kind of a credit for putting that money aside because you're short an extra put at the 145 strike. So here, there's a lot of things that can go right. What could go wrong here? Well, since you're short that extra put at the 145 strike, it's like a cash secured equity put at 145. The break even, the good news on this type of a strategy isn't down until you get around 142-ish. So you do have some buffer here. You do have some room in the event that it drops. You just don't want it to fall out of bed unless you kind of convey to the market by putting on a strategy like this. I'm happy getting long Alphabet if it wants to go below 145 at expiration. My effective purchase price is going to be around 142.
Yeah, let's break this one down. February 2nd weekly cycle. So just 3 days to expiration on this short-term example earnings type of strategy. Buying 1 of the February 2nd weekly 148 strike puts, selling 2 of the 145 strike puts, $3 wide back ratio, collecting roughly about a 39-cent credit. It's probably about a dime higher than that right now, but if you collect the 39-cent credit, as Nathan mentioned, break even just below 142 to the downside. Get that little kicker here, Kevin. You do have a lot of risk, about $14,160 on this one, but that's if the stock were to somehow go to zero. But Kev, this is a 1x2 with that short naked put. You're going to be comfortable owning the shares if it goes below 145.
Couple interesting things, and your thought was the first really interesting thing. As long as you're okay owning the stock lower, then this is a way to trade Google Alphabet. Why? Because if it goes to that short strike, in this case the 145 strike, you have a chance for the peak, to hit the peak where the long put vertical goes to $3, and the short cash secured put goes to 0. Remember, this is a long put vertical and a cash secured put. Ooh. That's why the buying effect, the buying power effect is so big. Now, that being said, what this does, it dramatically lowers the entry price. If you do go long the stock, if it does violate the lower strike. So that's a good thing. And the other thing, because you do it for a credit, you have no upside risk.
Yep, and as Nathan mentioned, above 148, you just get to keep that credit that you collect on this one. But you made a good point here, Kev, because in essence, you have to break this down. If you were just to take away that extra short put, you are buying that $3 wide put vertical, which if this stock did fall below 145, that expands to $3, plus that 39 cents you're collecting. That's why the break even about 141.60 to the downside. That's why that break even gets moved down. This is outside of that 1 standard deviation. Nathan, when you look at something like this, somebody might go, hey, you're not profiting that much, but you are profiting anything above that just below 142 on a trade like this, but it gives you a bunch of protection where it gives you a better probability of success because you are, have that break even that's about $10 below the current share price.
Yeah, sure. And yeah, this is not a super sexy trade in terms of your potential kind of profit here. As Kevin mentioned, your short strike is where you'd love it to go ideally. Exactly at 145 on Friday would be ideal there. But again, it's taking into consideration the setup heading into the report. Putting on something like this rather than trying to get aggressive and put on something like an out-of-the-money bull call spread, which can go to 0 if you get a pullback. Here, you have some potential to actually walk away here with some money still in your pocket. And then again, that assignment risk. And then look, when you look at a strategy like this, when you're talking about spreads, when you're talking about a short strike, to our viewers out there, where do you think it's going to be on Friday? I selected 148, 145. I selected $3 width because I wanted to get a credit out of this in the event that the stock goes higher. But you can adjust those strikes. Ask yourself, where do I think Google's going to be by Friday, or you can go even lower and say, maybe I want to buy it at a lower price. There's going to be risk reward. There's going to be trade-off. This is with every adjustment of expiration or strike or any option strategy. There's always a trade-off, but you can see, given the setup that I provided in terms of going into this report, why I selected the strikes and the expiration.
Yeah, and you know, the fact that a lot of people with these stocks moving up so quickly, so fast, maybe there are people out there that says, hey, if it does go down, I want to buy it because it hasn't been down there for a while on this parabolic move, and I'm comfortable buying the shares there. Hey, and if it doesn't go down, I can still profit on this type of trade. All right, great look at that example trade there. Thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. We're coming up after the break. Kevin and I are going to be joined by Landon Schwab from Lifefolio for discussion on Starbucks and sentiment data on the stock move. Coffee giants underperformed over the last year. The expectations pretty muted going into this quarterly report after the close. Stick around.
No. Unbelievable.
Ameritrade is now part of Schwab.
God.
Bringing you an elevated experience tailor-made for trader minds.
Ugh.
Go deeper.
Can you believe that? $5.90 for them suckers. Oh no. Oh no. God, 610. Okay. Panic attack. Big time on this one. This is just Jim. Jim. God. Ugh. Why do I sell for peanuts? Shit. I mean, not out. Hit. That would have been 285 out at 610. I'd bought everybody a bubble gum. Stick of bubble gum. Dadgummit. Look at that. Ugh. A virtual bubblegum at that. Whew. You left a lot on the table too? Well, I surpassed my target, Mommy. Mommy. Can you imagine that? $1,500 left on the table. Or less. Do a calculator out. 6.10 minus 360. 6.10 minus 3.60 times 5. 1,250. Ooh. 710. 8. Okay. Okay. If this stops at my trend line, I'm going to get mad again and go out and beat somebody up. Calls, prepare ye in the name of the Lord. Calls. Damn it. The 49.25 strike. $3. Okay. Dadgummit. Why did you do that? $8.10. I got it. Do. Damn Uncle Sam. Wham bam. That was beautiful. They're pumping Starbucks today for earnings. Golly, it just eats me up. Nah, what's 8.10? $8.10 minus 360 equals 450 times 5. This is radio station KSCP live out of Springfield, Missouri. We just found out that Washboardjim made a put call at the very top, and it definitely had a good nosedive. He left $2,250 on the table. Let's all give him a shout. This is radio station KSCP out of Springfield, Missouri. Right now he's at $3.50. He could go ahead and sell it here like an idiot, like he did before at the very top, where he could have collected $2,250 he left on the table. This is radio station KSCP, Washboardjim. Well, I'll tell you what. He's in the SPX calls Lotto 4920 at $3. He had a chance to offer $60 right there, and he turned it down. He says, this ain't going to happen to me again. He's going to pull up the SPY and see where we are on the VWAP. Exit idea is if the SPY hits the VWAP. $2,250. He left it on the table. I don't know if you've been doing the math at all today, but I think it adds up to about almost $5,000 on the table. Now I'm gonna try to be logical this time, and I'm gonna do something different. So we're gonna copy and paste. I got to copy this so I can have it. Don't have to retype it in. We're at 370 right now. So if you're a virgin to trading, I think you know what to do. So we're going to use the SPY as a VWAP right around 490.87. I'm going to take Fibonacci. Let's do it the other way. And that price line is right there at 40, the 50% retracement. We got 492197 as a resistance level, or the 50%. I'd like to see it hold this shoulder line right here and not pull back anymore. Now, if this holds right here and be true to that left shoulder, can't go any more less than that. And then come back and move on up and break this next resistance. Golly, $8 frickin' dollars. $4,921.63. If you took the bottom with Bobo and you've not made profit and you don't know how to do it, you're up $60. What I'm thinking, I've got to hold this shoulder line. Can't go any lower than that. It's got to hold. If it goes below that blue line, I got to get out of the trade and take what I got. Or we could pull back to a double bottom. But for it to be bullish still, it has to hold that blue trend line. inverted hammer or a gravestone. You have nothing to say? Say something. Franchise? Make sure you tell your friends about Washboard Jim. He was a legend in his own mind. Break it. Today we watch a Washboardjim make a pizza and a scalp in the pizza. Let's get to 100. I don't think I'll be as lucky on this one as I would of that one. Now, if you're definitely a virgin, you could get out at 380 or 390. Man, that was a beautiful trade. La 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 la, retest. We created the shoulder line. We're back to the shoulder line. Thing's acting up. Come on, you piece of... Don't ever do that to me again, or I'll dance with your chicks. I think I might have shut this thing down real fast. Reboot it. They know I'm killing it, so they're trying to slow me down. Who's the mole? Left shoulder, right shoulder, boom. This has to break now after your second right shoulder has been introduced. This is called an inversed head and shoulders. Left shoulder, head, right shoulder, right. Breakout. It has to do it now. It cannot come back down and touch it one more time. I won't let it, and I won't allow it. Do I make myself perfectly clear? Damn, man.
And then buy one of the 430 strike calls. So buying this unbalanced call butterfly, you're paying
Microsoft Iron Butterfly.
Or 730 debit on there right now. It's trading closer to 680 right now. So you're getting it at a discount, as Kevin mentioned. The stock has come in. But the debit that you pay on this is going to be your risk. We let break even just above 412 up there. So you don't need like a massive move above the $407 price right now, Kevin. But this type of strategy lets you take a directional bias, Kevin, but then also offset some of the risks on this by selling, you're buying basically a $20 wide call vertical, selling a $5 wide one to reduce some of your risk.
Exactly. This is a long call vertical, 405.25, financed or lowering the net debit by selling the 425.43 call vertical. You've given yourself a little time. That's another key here.
What date?
You know, it's a
February
$6.75 or something.
16.
Yeah, it's a little bit lower than we got here, yeah.
That can go to $20, right? So it's a chance for a triple.
4:30 strike?
It's not a high probability trade,
Yeah.
but it's a trade that can, the low probability trade pay off exponential if you're right on them. So yeah, it's an upside that, remember, $20 call vertical, $5 call vertical. That's why that line, that flat line on the upside is above the zero line.
Yeah, and if you were just to buy the 405, 425 call vertical, that'll cost you $8 or more. So that's what we mean by reducing some of your risk and exposure, because that debit that you pay on that type of strategy is.
It costs you $217 to get the $215.
Be prepared. That's going to do it for Kevin and I today.
Sell,
Stick around though, right here on the Schwab
and the
Network.
410 buy. Derelict. Boom. Oh yeah. Oh yeah. Take it in, take it out.
Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So, what are all those for?
This lets me adjust the bait, or maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I advice, invest on my own, and trade on Thinkorswim.
You know, Carl is the only front man you need.
Okay, we're retesting for the third time. Jimmy doesn't like that. So if you'd have got out at 360, 370, then I'm going to go over some of my watch list here after I get done with this. See what these guys are up to. Yeah. Oh. Man, look at the 5-day on this thing. I don't look too good here. $49.10 and drop another $9. We got an expansion. There it is right there. Double bottom. $2.55 and $3. Yeah, I got something got problems here with this platform right now. It's important that we do hold this here. Oh boy, I'll be right back. So I got it at 3 and 255, the SPX calls, double bottom, booyah. Yeah, this is really acting strange. So I'm going to shut it down and reboot just the platform. It'll probably take forever to shut down. And here, can I cancel it? Yes, I want to do something first. Uh-oh. I might get out of here. Break it. Snake breakout, double bottom, boom. Jimmy's Green. We're at $3. I got $2.55 and $3. It's a snake breakout, pullback, double bottom, boom. It's taking forever to shut this thing down. There it goes. What the hell? All of a sudden you just went. So let's see if we can put this back up. We're at $3 now. I don't know what that is. Yeah, we're getting ready to squeeze any second. It says I'm at 320. What's going on? Say la di da. What? That's a 5-minute, you dumbass. Oh, that's a beautiful setup. Now that I see it. Support, 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 support. Oh yeah, 380. This Jimmy's made a business decision. $380 would be a good place to take profit, but we're just going to see if we can get this to the 200 SMA on the 1 minute time frame. Yeah, booyah. $420. There we go. Jimmy's out. 410 off the 200 SMA. That was the 425s. I don't know how I got the 20 in there. What the fudge? Yeah, that was 425. Blummis, Tubits, Freebie, Forbus, Fibus, Sixum, Sevenum, to the 200 SMA. On the 1 minute. Did you take it? Jim, you've posted an outstanding track record today. How do you do it? Well, you make sure that you have all your marbles together. You want to make sure that your shoes are off and that you have clean toenails. It's very important. You want to make sure you have all your juices out in front of you. Your coffee, your water, your tea, your mocha.
Has been somewhat on investors' minds a block for the last year or so. Now, as far as the price levels we do have about a month until earnings, like I said, what do you think you can trade off?
70-40 is the first obvious area to watch here because, as I said, it was a point of repeated highs after we had our gap downward. That was the high point after the gap. If we were to make our way back to the upside, right here, there's another gap to consider. That was the post-gap highs near 75.90. Also developed a volume node around that area, so that could be a resistance zone to keep an eye on. These volume nodes, they can help us identify support and resistance areas. They're areas of heavy trading, so that could be one area to keep an eye on as we go forward here. To the downside, we've got our three moving averages in fairly quick succession between about 64.50 to 67 or so, around that area. If we do fall lower, that would be important because closing below those moving averages would be bearish signals, and that would also most likely result in them starting to slope downwards. So that would be a sign of potential rollover. In our
GM popped on
we also
earnings.
got our volume profile point of control
How
coming in
disgusting.
just below 64, this thick red line. That's the area of heaviest trading. Then we've got these old lows near 62. That's where we bottomed out a few times here during our recent price action.
Absolutely. So really great breakdown.
I kind of figured that.
Operating in the tech space, but obviously performing quite differently. Rick, you had our chart master. So now trading this name, Alex, walk us through your thinking. Obviously not an earnings play on this name, but it is volatile, and it's volatile means lower today on what was some pretty good analyst names.
Yeah, BTIG upgrading to buy, so looking at a bullish strategy. There are so many things on the calendar, and of course you mentioned the volatility in the stock that already just exists on a day-to-day basis. There are plenty of things to move this stock one way or another, even ahead of earnings. So we have a strategy that's looking to stay ahead of its earnings, but it is still is looking for a little bit of movement, looking at buying a call vertical, the 67, 71 in the February monthly cycle. It's the 16th of February. Break even would be at $69. Risk 200, make 200. Pretty straightforward. Looking for a move higher above 71. So looking for a move towards that 70-40 level that Rick had talked about, and maybe a slight breakthrough. But even if it just got there and stopped, theoretically that's above the break-even price. So still could be profitable. Max profit above 71, max loss below 67.
Yeah, I think pretty straightforward when looking at this name. We will leave it there for this segment. Now coming up next, it's time for the earnings previews. We get alphabet after the closing bell today, one that will be on many investors' radars. We'll be breaking down what we can expect from the tech with the coming up next.
1, 2, 3, 1, 2, 3, 1, 2, 3.
My dad was a hard worker. He used to do side jobs installing windows.
His dad was a very hard worker. I think we're getting ready to do, well, it's already done it. Ding, here it goes. Back 450 again. I did it again. I did it again. Yep. Mama says it bees like that sometimes. They're at 450 now. So it makes left 70 on the table. 80, I mean. I'll be right back.
That's reporting like the vast ways that it's changing and shaping the AI landscape. It just seems like the sentiment from Alphabet wasn't necessarily as promising. I thought this was one of the most confusing days of selling this, and meta platforms were like, to me, they're trading on their own fiction right now. This is no reflection of the strength of the company. So I appreciate the fact that ever since that report, we've been in pretty much a straight uptrend. I mean, shares are pretty much right around their all-time highs. To your point, that's now the case for most of the Magnificent Seven, even Meta actually now, with the exception being, of course, Tesla. But as we go into this report, I think there's a lot that is going to excite investors that perhaps wasn't really as much on the radar last quarter. And of course, past price is not indicative of future performance, so we could see a completely different result. But all in all, we're expecting this advertising business from Alphabet to have remained pretty solid, with some hesitancy among the advertisers lessening every single quarter is what is at least expected. Search is part of their business that is expected to face this increased competition from, say, like the likes of
480.
which is Microsoft.
I'll be right back.
But all in all, analysts are still right now calling for the improved monetization of YouTube, as well as YouTube Shorts, which have actually helped drive more traffic to the site. And Alex, we both get very excited every single time we talk about YouTube, because I know we talk Netflix, I know we talk Paramount, Warner Brothers Discovery, Amazon Prime, Apple TV Plus. There is no better way to use sports than I think YouTube.
Well, yeah, I mean, I think you're alluding to the YouTube TV, Sunday NFL Ticket, and that's like they're competitive with, cable TV. But I actually just like regular YouTube, where you go to YouTube.com, you search videos, and it used to be, just funny videos, things like that, highlights of sports games. But it's become a place where you can get a lot of information, and there's tons of individual creators as well. YouTube ads expected, if they just hit the expectation for this quarter, around $9.1 billion worth of revenue. I mean, that is such an astronomical number. And if you were to find out that that's only about a little bit over 10% of its total revenue, you would be surprised with that as well, I think, because this is a company that just makes so much money. And it's from all the different areas, from Google Cloud, to Google search, and of course the advertising components that are combined with that.
I mean, absolutely. And I actually totally agree with you, where it's just like plain old YouTube is now something I've signed up, like I have on my TV. And so you can get down like fantastic rabbit holes where you're like, what am I even watching at this point? But I love that. I love that. It's almost like cable, but like new age cable, because you can just watch like mindlessly. And I appreciate that. But shares are off of their all-time high now by about 1%. They're off around 57% over the last year. And now the favorable impact is expected to come from the fact that they've reduced their headcount pretty substantially from 2023 through January of 2024 even, which is seen as a way they're operating more efficiently. Right now, every company is sort of fighting for a piece of the efficiency pie, and Alphabet has done a pretty good job of laying off a considerable amount of its workforce, but a lot of that was somewhat glut of the workforce that they had overhired during the pandemic. So this is one of these companies like Meta, for example, that really upped their hiring substantially in 2020 to 2021. So all things considered, they're prioritizing their investments in AI. I think that's no secret. There is their own version of like the ChatGPT AI. That is something that it's not necessarily like user friendly as ChatGPT from my own experiences, but this is such a massive company that it's like, how can you even say AI is like the whole story? I think data center growth and some of the ways they're continuing to expand AI will be welcome, but like there's so many aspects of this business. I mean, search for one. This is one of the most useful tools of my entire existence. Google, I Google and I use it as a verb. I have everything.
Yeah, and you're not alone. Honestly, I always used to joke, our parents' generation, like they might have learned more things in school, but like once I was armed with the computer and something like Google, and now you got the GPTs and the Bears of the world, like you can basically find out the answer to almost any question that you might have. It can be complex math, it could be something that happened in history, or anything in between. technology has changed the game when it comes to what individuals can do. What I find fascinating from a performance standpoint of what this company's fundamentals are basically pricing in right now, based off the estimates from analysts, every single segment from Google services, to advertising, to YouTube ads, to just keep going down the list, all of them double-digit percentage or better gains. You're looking at even the other best category, 30% gains. Google Cloud, 22%. YouTube ads, 15% year-over-year gains. I mean, if it keeps this pace, I mean, it's super, super impressive, and it explains why there's 12.5% revenue growth being priced in for the estimate.
And I think that right now it seems like the sentiment among analysts that cover the same very much echoes that. Of the 59 analysts that currently cover Alphabet, 43 rate it as a buy, 10 have it as a hold. Average price target actually is pretty modest at around 158, which is still above where we're currently trading and still would be a new all-time high. But analysts like this name. The conviction is either more neutral to bullish, and so finally we'll get these numbers, because this is like truly, I know the Super Bowl's in 2 weeks, this is the week of Super Bowl earnings. This is like the big tech behemoths that are capable of moving the overall needle. So with this in mind, Alex, how do you go about thinking about trading this name? Because I can imagine, based on its volume today alone, that there is definitely an outsized interest in trading this name, but also will be up to high volatility there.
Yeah, it might be, and I think there's a chance with a name like Alphabet, despite the FOMO feeling being to the upside, despite all these positive things that we have to say on it, all the analysts love, that you have seen a valuation that's swollen a little bit. You have seen a stock that's trading at all-time highs, that even good, perhaps even great, may not be good or great enough to maintain or send the stock higher. So I look at the strategy, it's still neutral to bullish, but maybe allows for this stock to kind of maintain its value less so than gain more. Looking at a kind of strategic put vertical sale below the market here. Looking at selling this Friday's expiration, the 148, 145 put vertical for $1. Creating a 2-to-1 risk reward, risk 200 to make 100. 147 is the break even, so that's about $5 lower. So even if this stock were to disappoint, even if it were to sell off in response, you have till Friday. You have the pre and post markets for buyers to even step in and maybe run some of that below to the downside if it were to happen. And as long as it stays above that 148 max profit, above 147, above break even. But even if it does break down, it is risk defined, as you can see there, $200 in risk to make 100, and then anything unchanged or higher, that's max profit territory.
Yeah, absolutely. But I think that this name is seeing this heightened interest, but actually this goes really well into our next name, which is also seeing this heightened interest in, of course, it's trading activity, but also just monitoring its price like activity on the day. That is also Microsoft, which also will report today after the closing bell. But Microsoft, with its own sort of news today, so here to tell us more on the story is meeting on Ford Network. This is really interesting. This was on our radar last week when we did Microsoft actually doing something about it, at least today, to walk us through the story.
Yes, so we know Taylor Swift got hit with some of the dangers of AI, and now Microsoft did as well, because those photos that circulated last week that were inappropriate photos that were generated by AI, they are now being traced back to Microsoft's AI photo generator. And now Microsoft says that it had to close a loophole that allowed it to happen, because people are not supposed to be able to generate fake AI photos of celebrities using their platforms. And now they've closed whatever permission made it happen before. And so this is Microsoft's really coming to the defense of itself and its own technology in this entire situation. Now, Microsoft said that it's continuing to investigate the situation and investigate the images, and that it strengthened the existing safety systems to further prevent their services from being misused to help generate images like what we saw, what people saw. Now, Swifties, of course, ran to her defense. They reported the photos, pledging their support and protection. And also last week, Microsoft CEO Satya Nadella defended Microsoft's ability to keep all of us safe from the power of AI. But he said in reports that he could do a lot better job. The law and technology can work together. He said it's about global societal convergence on certain norms, And we can do it, especially when you have the law and law enforcement and tech platforms that can come together. I think we can govern a lot more than we give ourselves credit for, he said recently in a report. And meanwhile, the timing of this is pretty unique because earnings come after the bell today, in which analysts expect the company to beat expectations and rise from last year. Analysts are looking for fourth quarter earnings to grow around 19% year over year to $2.76 a share. Revenue is expected to increase nearly 16% year over year to $61.3 billion. Analysts, they expect it to rise year over year, I should say. Very interesting story and interesting timing, Jenny.
It is, Rita, and I would say I have heard reports, and this is still like rumors, but I've heard reports that she and her people are going to sue, as they should. These pictures are awful. I've seen them. That's sort of what did sort of spark my attention last week when they were sort of leaked all over the place. But I think what it does, and I know that Microsoft earnings are like center stage and everything, but I think that this creates a really compelling conversation. It's where is the future of AI? What does that look like for people's protection and safety? And I agree with Microsoft's CEO that they could do better, right? I mean, like, it's also like, where does the control start and where does it stop? I think that this shows a broader implication, perhaps, that AI could have on people's safety and privacy.
Exactly, and we know that last year in October, the White House actually issued an executive order to try to govern some of these things that we're talking about right now. And naturally, they had a response to this situation as well, calling it alarming. But one thing we do know, Jenny, is this barely scratches the surface of what's possible when bad actors misuse technology like this.
I know, and that is exactly what I think everyone's sort of warned about. And I will say that some heads of companies did warn that this is technology that can not only be not really controlled, but it can continue to grow and evolve because it's so smart. And when you see, I mean, some of these photographs that you can understand, it's so eerily realistic that you're like, oh my gosh, where's the privacy to start and stop? That's very scary. But at least we have Microsoft earnings due out today after the closing bell, and appreciate all of the breakdown on the news and of course that earnings preview when you have senior markets correspondent for the network. Now coming up next, it's time to look at another name with earnings due out tomorrow morning. That is Boeing. As Boeing has been one of the most interesting and volatile names really to kick off this year. We'll discuss that more with Kevin Green coming up next.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom.
I think they need to change it up a little bit here. Felt like I was getting a little dizzy there. They're at 470, 480. There's a knife. What happened here? Tomorrow's Pow Pow Day. We already know what he's going to say. Everything's running wrong. The economy's just a little bit too strong still. They're using 1970 tactics. 1976, 77 tactics, and it just ain't going to work. We're in a new era. The economy's totally different. It's just can't be old school all the time. Fed's always been behind the curve. They're still behind the curve. They made the richer richer by far, and they made the poorer poorer and the middle class poorer. Unless you have money saved up in a 401 or something. But these guys made it like bandits.
Lackluster that haven't been, but Boeing's seen some problems this year. How much their defense aspect of their business sort of then perhaps aid some of the recent selling? And I know this earnings period is weird because it won't include any of the recent headwinds.
Yeah, so it's around 30% to 35%
Boeing.
of their total revenue, but they do provide pretty decent profit margins, as well as their backlog and orders continue to rise. So it's not only what they can do from dollars and cents in this particular quarter that they are reporting, but also that backlog that increases by demand from the U.S. government, especially also when you're looking at NASA. NASA has also done a fair amount of business when it comes to Boeing and their space products, if you will. So it won't be able to probably wipe out the whole adjusted earnings per share loss, to say the least here, but it could take 10 to 15 cents off that bottom line number, and also having that guidance moving forward is going to be key. I also have guidance for the commercial deliveries, but Jamie, once again, that number is going to be probably a little bit stale, because even though they have some decent deliveries for the quarter, their outlook moving forward, if they start seeing deliveries more out into 2025, 2026, or even 2027, that could actually be a little bit dismal for the stock here. So I'm not even going to go over those particular delivery numbers, but space and aviation and defense is going to be a key area that they're trying to use as a crush to try to shield themselves once again from some of the issues that they've been having on the commercial side.
Kevin, I just did the math. Since 2019, calendar years through now, if you include kind of the estimates for the final quarter of 2023, minus $53.22 in EPS over that stretch. I mean, if this company had any competitors outside of Airbus, I just don't know how it would still be in business. I mean, this just seems unacceptable to so many degrees, and these troubles and things that we're talking about, they're not done yet.
Yeah, that's the great thing about a duopoly if you are Boeing, right? There's not a lot of other competitors within this space. Now, actually, we are getting some commentary even today from Southwest and United and even Ryanair around their deliveries when it comes to Boeing. So, for the most part, every company outside of United has really stood by Boeing and said that they will continue to purchase their planes, even if the delivery cycle is going to be elongated here. Now, United is a little bit of a different story, but I think they're probably trying to potentially work on a deal here in the near term. It's not that easy to try to go from Boeing to an Airbus type of airplane here because of, one, the cost for parts. You're not going to have the universality. Universal parts, if you will, for these different aircraft. So it's a lot harder for airline companies to try to shift their purchasing habits here. And I think United is the only one that's put that in doubt when it comes to Boeing and the 737 MAX.
Yeah, CEO Scott Kirby with those comments last week, but I completely agree. That's the beauty of a duopoly, is you have names like Boeing that have like major nightmares, and they're still, all things considered, doing okay. So I think finally getting some numbers and clarity for all this is always welcome, but I think the beauty in which the market they operate is them or Airbus pretty much. But we will leave there later a breakdown on all things Boeing, what's been a turbulent start to this year, no pun intended, for Boeing shares. But coming up next, Another name that is no stranger to some of this turbulence is JetBlue, which is lower after its earnings were not too shabby, but outlook seemed to overshadow any signs of strength. Shows down about 4.5% here.
I was born on the south side of Chicago. It has been a long road, but now I'm working.
Man, would you get over the sorry commercials on here, please, Schwab? How about something a little bit more cheerfully?
Merger between them and Spirits, the acquisition. So that's something I think if you're an investor in either of these names, you have to be aware of and consider if it's going to work out or not. But I think if you just look at JetBlue from the standpoint of its organic numbers, irrespective of the failed acquisition or essentially declined acquisition, the numbers don't look very good. They actually came in ahead of estimates for earnings. The estimates were a loss of 27 cents. They actually beat it, but they still lost 19 cents per share. And that's about a 186% decrease compared to a profit on an adjusted basis of 22 cents last year for the same quarter. And if you look at sales, they actually came in a little higher than estimates. That's good. But nonetheless, it was down about 4% year over year. $2.4 billion last year versus the $2.33 billion that they reported. Now, I think the guidance also presents a challenge for investors because if you just look at the sales numbers, they were down 4% year over year. The company guided for the full year of 2024 with sales down more than the decline in the quarter that they just reported, between, they say, 5 and 9%, so let's look at the midpoint at 7%. Now, to offset that, they are, of course, talking about reducing capacity. Now, technically, when you see a company like an airline, for instance, based on inelastic demand for routes and airfares, cutting capacity is a good sign. They did, of course, declare that they're going to cut it to the low single digits. Now, last quarter, when they reported, they were expected to increase capacity by 7%. So what they're doing is they're reducing the increase to about 3 to 4% versus 7% last quarter. That typically shores up prices, while at the same time they're trying to address the balance sheet. They have a little bit of debt issue. They have $2.8 billion in debt. Equities around $1.83 billion. So what they're doing to offset that is they're reducing the capital expenditures, and they're giving guidance all the way through 2028 of a declining capex by $2.5 billion. So what I see here is to make up, I suggest, for the block acquisition, they're basically trying to be more nimble as a company. They're not going to grow as fast. They're not going to have as many routes. And I think, you know, by offering buyouts, that's one way they're doing it, because I think at the end of the day, I'm just going to use JetBlue and let's say Spirit. I think labor, which is the most expensive component to an airline, a lot of people think it's fuel, it's not. They just can't handle the increases in pilot pay and, of course, higher costs associated with flying routes, irrespective of fuel.
George, maybe I'm too logical. I know you're not a legal expert, so you can dance around this all you want. But kind of the reasoning, from what I've seen for the cliff notes of the block, was, hey, 6th and 7th largest airline in the U.S. combined. That means less competition. But what I see is a company in JetBlue that hasn't made money since 19. We know what's going on with Spirit. You might have 2 less airlines if it continues down this path. How does letting those combine to maybe survive and thrive not actually beneficial for the consumer, as opposed to losing both of them to bankruptcy or something else?
Well, I mean, that's a
God
question.
damn.
I think that both
You gotta be
airlines are
kidding
certainly,
me.
as part of their appeal, going to make the case that if you don't let us merge, we won't survive. Therefore, they could make the case that it will create an anti-competitive element to
No way.
consumers,
Round trip,
reducing
$1,700 bucks.
and increasing concentration amongst the larger airlines out there. Now, if you look at the market today, interesting enough, Southwest, symbol LUV, is actually
What the
higher today.
fuck?
I think the market is picking up on this. I think that the market is telling us, at least using Southwest as a proxy, that these two airlines,
That ain't gotta be right, man. It was just 600 just last
which I
week.
think is probably not going to change. I can't say if it will or not. Are in trouble, and so they're going to reduce capacity regardless, both of them. And I think that's also going to allow other airlines like Southwest to encroach on their territory. So, I'm not going to say what to do here. I'm going to say look at the charts on the 5-year charts. It's down. JetBlue is down about 75%. I know Southwest is down, but they don't have certainly a profitability issue like JetBlue does. So that's something to just keep in mind. I can't say what to do here, but a lot of times these things will drag out for quite some time.
Crap.
We don't know where while the company continues to hemorrhage money.
Yeah, and I think that's sort of the concern is like this near-term pain. Maybe we'll see some long-term gain, but it doesn't seem like that is their outlook anytime soon. So great breakdown though on all things JetBlue, trading around just $5 a share here. George Tillis, senior markets correspondent for the network. Appreciate the breakdown as always. And that'll do it for Next Gen Investing for this Tuesday. We have a ton of earnings out later today, of course. Catch market on close. But coming up next, we have the watch list with Nicole Pellegrini.
I remember when I first started flying, and we would
I can't believe that airfare on that. That ain't gotta be right.
our Charles Schwab chartist taking a close look at Ulta Beauty and Royal Caribbean. Then we will find out what consumer sentiment data may not line up with consumer spending patterns. And our panel previews Boeing ahead of its latest earnings report. In the meantime, taking a quick look here at markets, which have turned back into the green, at least the Dow has, because it's up 0.25%. Could be another record close here for the Dow. Right now, it's at 38,421. Now, the S&P, if it were to post a gain, would also have a record close, but right now, it's down 5 points. The Nasdaq down 0.75%, 17,465, and the Russell is down 0.8%. U.S. dollar 103.31, gold 20.51 a troy ounce, and we see crude oil at 77.91 a barrel. Both oil and gold higher, and Bitcoin higher as well, 43,770. For some of the biggest stories in the markets, we welcome in Kevin Hanks, senior equities contributor, of course. Federal Open Market Committee meeting is now underway. And so, we're waiting on that for tomorrow. We got in our JOLTS data. Tell us more, your thoughts.
Yeah, some interesting data about 10 o'clock Eastern time this morning, Nicole, where we got our first of 4 labor market data points, which is the JOLTS, the Job Opening and Labor Turnover Survey, Nicole. And that number came in a little higher than expected, north of 9 million, 9.026 million job openings right now. That's higher than the 8.79 million from last month. That number got revised up to 8.92. So higher numbers in the JOLTS means the labor market is higher. Remember, we're looking at wages coming out on Friday. The year-over-year wages is expected to be flat month over month at 4.1%. We also, Nicole, got the consumer confidence number at 9 a.m., which came in at a whopping 114.8. That's higher than the 110.7 last month. That number got revised up to 108. So really strong economic data at 10 o'clock Eastern, Nicole. But the 10-year note still in negative territory for the day in terms of the 10-year yield. So pretty interesting day, but I think the market is focusing on earnings, Nicole, because they shouldn't have ignored that strong economic data.
All right. Well, speaking of earnings and numbers, General Motors came out and gave a bit of a surprise. Your thoughts?
Kind of a surprising number out of GM. And it turns out maybe internal combustion engines are still in demand. They made $1.24 share. That's much higher than the $1.16 expected revenues. $42.98 billion versus $38.9 expected. So the full year they made $10.1 billion in profits. They've got strong free cash flow. CEO Mary Barr said, "We are well positioned in 2024 for strong financial performance building on the 2023 accomplishments." So it might be, Nicole, that the internal combustion engines or the hybrid is the sweet spot where the U.S. consumer may fall here. Not necessarily 100% EV, not all internal combustion engines. So it's going to be interesting to see how this plays out, but a really good day for General Motors.
Yeah, and it's amazing. We're changing our strategy, the lineup to include plug-in hybrid EVs. That came off yesterday's news. We had that discussion because they've gotten from these committees that advise them to push back with the hybrids and not just EVs.
Yeah,
not necessarily everybody's ready for an EV, right?
Right.
All right. Any final thought? Yeah. I know. So that's good news for General Motors. Thank you, Kevin Hayes. Let's get the big picture. Louise Gowdy Wilmering's with us, partner Crew Advisors. So, what are you thinking here? We have a huge week. Hard to know where to start. How about, since Kevin was talking about some of the economic data, how about with the Fed? Because right now, the Federal Open Market Committee is meeting. We'll hear from our Fed Chair, Jay Powell, tomorrow after they tell us their findings. Your thoughts?
Well, I think what we're coming into is a 2024 that's a little different than 2023. In 23, I think all we focused on was inflation and how the Fed was going to help curb the inflation through rate hikes. As we come into 2024, I also agree with the previous speaker. I think that the Fed has effectively telegraphed that they're done hiking rates, and now I think we're going to shift more. Certainly what the Fed says tomorrow will be very important, but I think the shift is going to focus more and more on earnings rather than on inflation and interest rates.
Interesting. I mean, they're mandated, you know, obviously they look to have full employment and keep price stability. So I'm sure we'll be hearing a lot about that. In the meantime, as we get earnings, we'll get some of the big names today after the bell, like Microsoft and Google, for example. What are you thinking about the earnings picture thus far?
Well, certainly the people that have disappointed have really been punished. And we're starting to see some soft areas and some surprise strong areas. I don't know that most people expected that General Motors would post the numbers that they posted today, for example. But certainly those big tech names, especially those largest capitalization stocks, need to put in good numbers in order to support the rally that I would argue really put in at the last quarter of 2023. So I think the market is waiting and wants to see that those numbers will look strong in order to support the pricing that we've seen so far.
Can we get into the Mag 7 a little bit? You know, do you have names? For example, I'll tell you that I've been hearing more about Amazon being a little more of a value play, some negative trend lines for some of these names. Can you name one or two or three of these names that you're watching closely or what you're looking for? And do you like the group? Would you tell people to invest in this group for the long term? This is a great chart showing the outperformance of the Mag 7, that's for sure.
Well, sure, that chart kind of shows what we experienced in 2023 was as soon as we started talking about technology and AI around April when AI became the whisper, those Mag 7 names really took off. So what I would say is I'm not saying that the Mag 7 is going away or that they're in danger of really poor performance. But what I think we've seen is in a year, on a year-over-year basis, you have those stocks as a group in the technology sector up almost 55–60% on a year-over-year basis. And some of those numbers have pulled forward. So while I think technology is going to continue to impact all areas of the economy, I think that what we need to see is that equal weighted or the other 493 stocks start really putting in some more solid numbers in order to make this market more stable and less dependent on just a few names.
And so are you watching the other sectors, which we're showing some of the sector returns here too? These are great charts, thank you for these. You know, do you have certain sectors that you prefer over others for investors?
Well, what I would say is many investors have gotten really top-heavy in technology and communication services with the Amazon and into consumer discretionary. So I think it makes sense to make sure that people are diversified. Anytime you have those big sectors really post huge numbers, you kind of get a little lopsided one way or the other. So it makes sense to pay attention to some of those more defensive names and take a little bit of those gains in some of the sectors that have done really well. And then certainly the areas that are really underperforming, such as utilities. I don't think anybody's not going to turn their lights on just because the economy slows down, if it does come down quickly. But certainly those have been names that have been underperforming. And I think a lot of that has to do with rotation. Now that bonds are actually yielding something, a lot of people who were hiding out in those higher dividend sectors maybe have moved to bonds and out of those names. So some of those areas that have been neglected are areas that are worth taking a look at to lock in gains so accounts don't get too lopsided toward technology or communication services.
Right, understood. What kind of year do you think we're going to have? Flat, up, down?
Well, the crystal ball. I would say that we will not have a year like we had last year. But I do think we should be able to post some decent numbers. So I think we'll be up, but I don't think we're going to be up 22% on the S&P. Because I simply don't think those largest capitalization stocks can carry the whole market and post the year that they had last year.
Louise Gowdy, Wilmering, thank you so much. Great to see you. Appreciate it. Of Crew Advisors. Thanks. Up next, Kevin Horner is standing by. He has a technical breakdown for the S&P 500, which has been at highs, Ulta Beauty, and Royal Caribbean. He'll explain much more. We'll be right back here on Schwab Network.
AMD's knifing. In the Apple, AMD's got a snake here. Yeah, we gotta wait for the 200. Should drop another $4. Here's a cup and handle. Let me see here. I'm gonna put that price line on that. I'd almost want to get a put, but I ain't going to take that risk. I still think we're in a huge bubble, but because I've never seen anything like this. Last time I saw this, I seen the COVID bubble.
Welcome back to the watch list. Friends of Nicole Pedalese, live on the floor of the New York Stock Exchange. We're looking at more market movers for you right now. Super Microcomputer is higher today after its second quarter earnings beat expectations. The company significantly raised full-year revenue guidance. Multiple analysts raised their price targets on the stock this morning. Shares hit an all-time high earlier today of over $550. They've fallen off since then, but still in the green at this moment. UPS shares, well, those plunged after the fourth quarter revenue estimates and the company's 2024 guidance disappointed. UPS announcing a billion-dollar cost-cutting push, including laying off 12,000 employees, exploring strategic alternatives as well for its Coyote truckload delivery business. Cleveland Cliffs is up despite missing fourth quarter earnings expectations yesterday in the post-market. Cleveland saying that it will focus on aggressive share buybacks after its failed bid for U.S. Steel. Also expects to cut costs by about $30 per ton of steel this year. Activist investor Nelson Peltz will reportedly lay out a streaming profitability plan for Disney that would include bundling ESPN Plus with another outside streaming service such as Netflix. TELUS is seeking to lead on Disney's board. Netflix is currently making a push into sports streaming with its recent deal for WWE Raw. And here's a look at the latest move in Bitcoin. 43,750 is up 2.2 today. Okay, it's Technical Tuesday. It's time to welcome in Kevin Horner, Senior Manager, Trading Services and Education of Charles Schwab. Thank you so much, Kevin, for being with us. So tell me a little bit about the
I think I just had an alert hit on Mark.
We've had it, 6 days in a row of record closes. So everybody's now, they have hats for S&P 5000, but it's a superstition. You're not allowed to take them out of the box until you pick the number. But I know that.
Yeah, that's right. I mean, I'm sure there are many traders targeting that $5,000 level. That 5,000 level has been talked about a number of times. We're a mere 70 points away. We've had a really good run the last few weeks here, at more than 3% just year to date. And yesterday's close at 49.29, and a new high today at 49.30. A pause up here, obviously by no means problematic. I did make note that we've had 9 days in a row above a 5-day moving average zone to pull. Now, I don't have that on my charts because that's such a short-term moving average. It's so fast, but we are above it, and it remains an area that very short-term traders might continue to monitor, because if you're a trader who wants to sell on weakness, the first thing you might do is wait for the fastest moving average to break down or get trades beneath it on a closing basis. Well, I guess that could happen with the 5-day at some point. But
5-day
for some traders, perhaps the 20-day for others, if you're looking to be a seller on weakness. Ultimately, it's really hard to find levels to be sellers at on the upside because there is just blue sky above. And traders find that a little difficult. So it can be a challenge to work to exit winning trades, even though you're reaching into levels you've not previously seen.
Okay, so we will watch for all of that, especially the nearer term levels that you're talking about. In the meantime, what about a name like Ulta Beauty? Why does it jump out at you today?
Well, Ulta, what popped out to me on the chart specifically was the move we had in the sideways consolidation. We've gone sideways for 2 months here, really, after a fantastic rally. So they rallied really strong at the end of the month of November on the earnings announcement. And this is, as our viewers I'm sure know, when you get technical moves to the upside like this, big pops like this can result in a need to digest that action. And that's ultimately what we're looking at here, excuse me. We've got it designated as a 30-point range, 465 to 495. Yesterday's candle
It's a bull flag.
gives the impression, at least initially, that we have perhaps broken out, and there's been very limited give back today. So if nothing else, you've got traders looking at the potential to take maybe a 30-point move to the upside above that 495 level if the 495 level maintains as short-run support. Now we see the right beneath us 52-week high at 556. That is notable because even though the measured move target is about 30 points, the trader who is believing in the trend that's been working really all the way back to mid-October of last year could easily be targeting those highs at 555, 556 as well. So, there needs to be a process, as I often say, Nicole. Know how you want to attack the trade, build a plan out for that trade, and then trade that plan as much to the letter as you can. It's that process, it's that consistency that frequently will reward the traders. So it's a great breakout of late. Bulls want to see 495 hold here to validate things breaking higher even still.
Look, I mean, these beauty stocks are doing incredibly well. For example, I saw not that long ago, in early December, Argus had a 545 target on Ulta, and as you noted, the big move that we've been seeing, and I got to pull up ELF just to tell folks how it's doing. 1 year ELF, eyes, lips, face, right? That name is up 182% in 1 year. Okay, let's get to those cruise lines. We're going to take a look at Royal Caribbean today. So tell us a little bit about Royal Caribbean.
Only after reminding you, you're absolutely right on Alpha, and they've added just a 70-point move just since November. So great call out on Alpha. Just had to make that point. Okay, so Royal Caribbean, RCL, also in a bit of a consolidation, except we might be ahead of the game here, where we saw Alta had already potentially broken out, Royal Caribbean in the process of still consolidating. So we had a fantastically strong move here. The numbers, when I did the numbers on this, Nicole, it was staggering. So they were at $80 to the 52-week high up to 131 in mid-December. So that is a 6-week rally, 62%.
God damn.
An unbelievable return there. And then, of course, after a gigantic move, you need time to consolidate. So traders can expect the stock to take that breather. That's kind of what we're looking at here. And if you're new to
Spy just keeps giving me alerts.
early to the breakout, because if you're
There's no
early to the
reason
breakout,
for
it leaves you with too much risk to the downside. We wouldn't really think that there's a breakdown here unless we traded below. There's a bit of a candle back here in January, right on the 3rd, that we could eyeball as our short-term low. That low comes in somewhere in the neighborhood of about 116 or so. And so if you were to buy it at this point, you're risking 10 points. So the trader who wants to be bullish has to decide, can I give up 10 plus points to the downside and stay in the position for the potential of a breakout? Do I prefer to wait for the breakout and only buy after that occurs, where you have the more confident belief that there is in fact more upside? Or does the trader simply sit on their hands and see if you can get entry nearer that 50-day moving average, which would really fix the risk-reward opportunity on the trade? So there's a multitude of options available to the trader here. Even if you're just strictly bullish, you've got at least 3 different ways to think about it. So by no means a clear chart definitively by any stretch, Nicole, but there are intriguing opportunities that lie ahead based on price action we could see play out over the coming week to 2 weeks.
All right, Kevin Horner, thank you so much for these. We appreciate it. Technical Tuesday every week. Kevin Horner, thank you. Coming up next, a fresh look at how consumers spend their money in today's economy. So let's dive into that. The stresses, the strategies, what impacts your daily purchases and spending. The watch list, we will be right back.
Come on.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning...
Spy breaking out. Same with the SPX. I've heard this ding, ding, ding all day. Get me some more water. Try to relax. I could trade all day today and made a ton of money. Oh, I do have water. Okay, I'll be right back. I'm doing my laundry. I'll wait a few more minutes. Yeah, man.
That consumer stress.
So how do you use all of this for takeaways there, or looking at the economy, or making some projections or thoughts or big picture trends that you're seeing? Could you give us some of those that you're watching?
Absolutely. So again, this year, in the U.S. in particular, we're definitely tracking stress levels as it relates to geopolitics and government. And in past times, for instance, in election years, sometimes you see a little bit lighter of retail spend. Another area related to that we talk about with clients is brand boycotts. So when you think of global conflict in Israel and Palestine, what does some of this information mean around how brands should think about boycotts and challenges there? And then it applies even to more tactical issues. So at one point, Nicole, you asked me about Ozempic and GLP-1s. So that'll hit a couple different areas here. Potentially the wallet, also consumers' physical and mental health, their healthcare costs. And so just really trying to provide that connectivity and connecting the dots to better understand how consumers are responding to stress and ultimately making purchase decisions.
Not very good today.
A better economy will bring...
It's incredible how these things are dinging today.
What do you foresee when you think about some of the elements? We're in an election year. We have a market that's at highs. What are some of the things that you're watching? I mean, obviously the geopolitical tensions are evident. The polarization of politics is evident. What else are our takeaways here? I mean, it's nice to know that consumer sentiment is seeing some good news. Do you think that consumers will continue to spend, for example?
I think yes, for now you will, because what you're seeing reflected in these latest consumer confidence numbers is really visible metrics to the consumer. So we talk about inflation and interest rates and these bigger topics, but to the consumer, it's often very tactical things they're responding to. Gas prices have gone down. You're just talking about the stock market. People's 401ks are looking healthier. Even normal things like egg prices at the grocery store. So that's really what they're responding to. That's making them feel a little bit healthier about the economy looking forward. But as we go throughout the year, I think we're going to see this increasing stress around the upcoming election, where it won't be some massive pullback, but we're really looking at how consumers are thinking about their upcoming purchases and what that sometimes just that sort of feeling of generalized anxiety is actually a drawback in consumer spend, despite how they may feel about the economy.
Katie, it's great to see you. Katie Thomas of Carney Consumer Institute. Thank you. We'll look forward to the next prints in the future months. Still ahead in the second half of our show, we'll talk all about artificial intelligence in the hiring process and big tech layoffs that we've been seeing. And we'll preview Boeing ahead of its earnings. Coming up here on the watch list, as we head to break, take a look at winners and losers in the S&P 500.
There it goes. SPY, double bottom. Nailed it. Exit idea. SPY hit the top of the VWAP.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Time for puts. Practically too easy today. Chart patterns, man, I'm telling you, that's where it's at. All you have to do is study chart patterns and have your top stocks. Have a great watch list. Ford, Head and Shoulders. We're at the shoulder line right now. Resistance is the 200 SMA. And I use the body of the candle. I don't care about the wicks right now. I'm getting a headache listening to the ding, ding, ding all frickin' day.
Right? I mean, till very recently, you needed developers to develop code. Well, and do exactly what you said, Nicole, it's nearing perfection. Now, if the machine can write code with perfection, why would you need developers? Similarly, in terms of other parts of software, including quality assurance, etc., as the machine takes over and artificial intelligence reaches general artificial intelligence, you are going to require fewer people to do more work. You're going to see a definite increase in productivity, definite improvement in the bottom line, but unfortunately a reduction in force as the plans move forward.
Yeah. You know, when they invented the tractor, the farmers were upset because now, right, it elevated and evolved into the business. AI is the kind of thing that can upset folks because it might take their job, but then it could mean other jobs, right? What kind of jobs could appear? Because maybe a lot of people are really concerned that a lot of people will lose jobs.
Yeah, so there is this way that you actually ask a question of artificial intelligence called prompting, right? So if you are somebody that is completing a function that has a great deal of expertise that is going to be now taken over by AI, now your job becomes how do you question the AI to do your function? You become the supervisor of the AI and cause the AI to do the work that you used to do. So you have to find a way, Nicole, to elevate yourself, to get the AI to do the work you are doing, but maybe you're getting the AI to do the work of about 20 of you as opposed to just yourself. So it's an interesting time, it's an inflection moment in our entire industrial way of working, that you have to find a way to be better than AI to a point where you get the AI to do more work than it would do by itself. itself. And that's not an easy thing for people to grasp, not easy to get your head around it, but that's what people need to be doing, retraining themselves in this new AI economy.
Right, understood. At this point now, you said CTO jobs, maybe the legacy jobs. Tell me about the trends of jobs, and maybe not just in tech or AI, but just some big picture thoughts.
If I was a young one,
picture for 2024.
I mean, I already know what I'd be doing if I was young. Younger.
Obviously, more unemployment, right? We'll see those numbers go up, though Jolts didn't necessarily say that. We still see
Making a living on YouTube.
just some jobs, trends, and thoughts for 2024, please.
Yeah, CEOs.
I don't know if I'd get into acting though. Probably not, because they're too far woke.
Products, legacy technology.
I couldn't stand the snootiness.
Are going to be seeing the exit door. So,
But I'd become a
the labor
fisherman.
market is still tight, but that's because AI hasn't reached that level of perfection that it's expected to reach. Not
Become
in
a-
years and decades, but in
I don't know,
months.
anything.
So you are going to see that impact, because in my opinion, by the end of this year.
Definitely would be trading stocks if I was a lot younger.
Ramakrishnan of Kingsley.
I mean,
Gabe,
I was thinking about stocks when I was 20.
good to see you. Appreciate
I
it.
had Walmart.
My pleasure.
Still ahead, our panel is ready to discuss all things Boeing, ahead of the earnings report.
But I don't know. Back then, I was kind of a party animal.
Some people say, look, there's
But I
only
think
two
I would have
playmakers.
changed.
We've had a lot
Can't
of
party and do
discussions on
this.
one. Coming up next.
You got to get sleep and rest. And today's been kind of stressful. Listen to all them dings, ding, 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 all day long. I don't know what's up. They're definitely triggery. I mean, I should have called the double bottom down here. I didn't have to listen to the ding, 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 and the ding, ding, ding on the way down. I'm going, come on, man. That's my alerts telling me it's a new high, or because I miss having trade ideas, because I could listen to a name, a ticker, and I'd be looking to see if it was a new high or new low. So I got it. Now I got my alert system where I got to sit there constantly look at the alerts.
On the latest market trends.
See, right now we got bearish trend
Anywhere, on any device
on this.
for free.
All this time we've had ding, ding, ding to the upside. Now I've got bearish trend. I'll hear ding, 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 ding to the downside.
Trading names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market.
It just tells me when a
Weekdays at
reversal
noon
might be
on
in
the Schwab
play, or
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street.
you've been hearing that all day long. Ding, 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 ding.
Anytime, anywhere, on any device for free. Only on the Schwab Network.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Miss out on today's
Can't wait to
market
get out of
trends?
here.
Get caught up and catch the wrap at schwabnetwork.com. Available anytime, anywhere, on any device for free.
That's why I should be paid doing this. So I put up with the ding, 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 ding.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Trading at Schwab is now powered by Ameritrade, unlocking the
So
power
YouTube
of
is what I'm
Thinkorswim,
talking about.
the award-winning trading platforms. Bring your trades into focus
This is my platform
on Thinkorswim
here.
Desktop with robust charting and analysis tools,
my charts,
including over
market
400
watch,
technical studies.
see what's
Tailor
going
the
down.
platforms to your unique needs with nearly endless
I got a
customization.
message center.
And track market trends.
This thing
with
just
up-to-the-minute
been on fire
news and
today.
insights.
I got these alerts set up
Trade brilliantly with Schwab.
on Ready, Set, Go, and on the trend scan. I got a trend scanner too. So if I put a certain stock in here, it's like all the way up. Ding, 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 ding. See, now the SPX is dinging up. It hasn't hardly moved.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the base.
This was a
add
nice
guitar,
double bottom
some
call.
drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
Went to $1,000
front
bucks.
man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
I've traded a lot of stocks in my lifespan, and it's just so much easier just to trade the SPY and the SPX.
Thank you both for being here. Nicholas, you have
They're not as manipulated as the other ones are.
about 24% in 1 month after hitting a high in December. The FAA
Just so much easier.
for the Boeing 737 MAX 9 to resume flying.
There's
but there's
perfect
still a lot
patterns.
of, scrutiny, and there are a lot
I mean, the way this thing fell back today is just amazing.
some trust issues that need to be tackled.
Just
Nicholas,
holding
your
that
thoughts on
trend all
Boeing
day
and where
long.
it's headed?
It's just been a great trade.
I'd say the number one thing I'm looking forward to learning more about tomorrow is what's
Then you got
incrementally-
resistance up here. I mean,
What are they going to do
boom,
differently?
boom,
to
boom,
run this
boom,
assembly
boom,
line,
boom.
so that these planes can leave the door.
Just
the
held
way
very
they were
well.
supposed to be.
And there's patterns. I mean, the
That is
patterns are
likely
so
gonna slow down
evident.
their ramping up process, which is already
Like right in here, you know, we had a
comments from the FAA that they want to.
when I called this trade out, we had that wedge.
And that's all for the good, as investors and as the
Boom.
public.
Back
like
to
you
a double
said,
top.
We want to get past the trust issues, and see this.
Then you had a
see this
double
project,
bottom.
work, so to speak.
Yeah. You know, Southwest said no
New
Airbus
lows, double
planes,
bottom.
despite Boeing's
Then you had that
delays.
one with the two engulfing candles.
Interesting, because that was, sort of how I
Right here.
started this. There's really only two
Two engulfing candles.
It's Airbus and Boeing.
I mean, that was a no-brainer right there. It's too easy.
Benefit of Boeing, no doubt.
Too
Jim,
simple.
Your thoughts on Boeing? Where you think it's headed?
I think Nicholas hit on it. I don't think it's about the numbers right now. I'll certainly be looking at, free cash flow generation in the future, what they're talking about that.
The RSI was down here. The RSI was down here. Boom. RSI was down here. Boom. RSI. Boom. RSI. Boom.
I think the biggest concern for investors is that the FAA
RSI.
and Congress are going to play pivotal roles here. And there's a real tendency with all the mistakes that have been made for an overshoot on the other side of this. So they can slow
Boom.
them down meaningfully. And we're going to hear
RSI.
some commentary
Boom.
about it tomorrow to alleviate
I
some of
picked
those
up something
fears, because they said
today.
it. Right now,
Listen to
they're
that guy
not
say
only regain the public's trust, they
50%.
gotta
So I'm
regain
going
the
to
trust
start
of the
putting a
FAA
50
and
thing in here and seeing
There was
how many times that becomes a resistance or a support level. 50% from the bottom to the top. You got 30 here.
So, I mean,
Then
on the
50.
one hand, that may
That's
be a
about
good thing
halfway to
there's
that.
human error that Boeing can then
So that's
fix
going to be
this
something I'm going to be
assembly line,
watching.
as you noted,
I like listening to Schwab. They give you a lot of good
versus
advice
a bigger
on.
problem that they couldn't figure out. I mean,
These
for
guys are,
example,
that
MAX
not
system, I know you brought
slobs.
that up, David. You're a commercial pilot, so we're going to appreciate your unique perspective on this. I mean, why don't I'll field that to you.
You get so many mixed
If
messages,
somebody forgot
so
to
many
put a
mixed
bolt in,
messages on CNBC
think of anything
because they have
worse,
so many
but
people that ask the same
maybe at least
question.
you can understand how to fix that quickly,
I'm
right?
sick and tired of
Tell me
hearing
about
about interest
Boeing's
rates
moves and how
every
they
single
fix all of
day
this
for 3 years.
David.
2 solid years.
It actually comes down to the culture.
They're gonna
of the
cut
company.
it. They're gonna
We have to
raise. They're gonna
rethink
raise.
this.
and-
I've said long ago this was likely the aircraft that should not have
What's
been
your
built.
opinion? What's your opinion? What's
Unfortunately,
your
the regulatory
opinion?
structure in the United States is so draconian. To start a plane from the ground up, it could add a decade. So you end up taking a plane like the 737, you stretch it, you slap
Now,
on a couple of
Mark-
engines, and all of that changes the aerodynamics, and then you slap on
Mark, I
more
called
systems
out
like the ACS system, such as
102.69.
in part responsible for the crashes in
We were at
2018,
75.
2019.
We're now at
With all of that
97.
baggage
So
that
if you
we've
took
got
this
right
trade,
now, you find
this
a plane
has
hits the-
news.
hits the airlines without bolts in
Real
it has
good
to shake your
news. Now,
confidence. So
this
they gotta-
this
they
is
gotta
something
somehow
I'll talk
change
about
the
news.
culture here and change our perception of them.
What kind of news will make a stock run?
National Transportation Safety Board
Sometimes it's
probe of
just
this
a
incident.
word.
We'll get some
It's just
more
one word,
news
or
on this. But what are the final
or-
takeaways, Nicholas, in your
So here
opinion?
today,
Because we'll have the conference call. You'll be
Mark,
listening there.
Remark Holdings
You know, one of the reasons
on
people left
X
Boeing
Post
is that
looking
they did
forward
sort
to
of create a new,
partnering
bigger
with
plane.
Microsoft.
Airbus had smaller planes. There were a lot of great things.
Microsoft.
Also, it's national security.
So that's a catalyst to make a stock run. If it said partnering with Google or partnering with Amazon or partnering with Meta or partnering with Nvidia
basically at a 20%
or
discount
partnering
right
with
now.
AMD,
When
that
you
would all
had
be
other
great news,
debacles for
because
Boeing, it comes back.
these companies are established.
Well, I'd say long term.
I mean, that's the kind of news you want to hear. Phase one, that's no big deal. Phase two, no big deal. Phase three, no big deal.
Really will be in details. How do you credibly fix an assembly line while you're running it?
What is a big deal is FDA approval.
And if they slow down, that's for the best.
And
They
what
have to
kind
get
of
it right.
approval is it? Is it for cancer, or is it for
there might
breast
be more downsides,
implants,
there's
or
more
is it,
uncertainty, but
you know, is it
long-term, I
something,
believe there is secular
Alzheimer's?
demand
Is
for these
it
planes.
something that
They just have to build them to the design.
that's important? You know, if it was FDA approval for an ingrown toenail, that'd be no big deal.
Will it see 267 again anytime?
The stock gets news on an offering.
It could get
You're only
there.
going to have
My
one
fair value
person,
estimate is
one
$232.
team looking at off.
And
It's
I
the
published a
pumpers.
note the other day saying that
The pumpers,
say a
because it
2-year
lowers the
extension
float.
of this slow kind of quagmire
Splits,
version
I
of the
mean.
737 assembly line.
Same as offering.
will take
Offering,
about
you're
$28,
broke. If they're
$30 off
offering
the
an
price. That's about
offering,
where it's trading now.
they're broke. But if they're offering an
Don't
offering for
underestimate if they can
a
get
clinical
these planes off the
trial
lot and start,
that
you know,
has something to do with
booking
Alzheimer's
revenues when they actually make them,
or cancer
there's
or
upside
lung
there,
disease,
assuming, as I
or
do, that they will
diabetes. You
get
see
to
what
the
happened with
bottom of it
diabetes
and get a quote-unquote
with
normal
LLY. I mean,
process
they're-
back in operation.
once they,
It'll just take time.
Right.
it was for a fat pill.
I was just looking at the
Then all of a
Boeing
sudden they threw in the blood
orders,
pressure. They threw in
and it
the
seems that some are
diabetes, and
being
they
canceled,
those
some are
this could
staying
be
on
good for
board
this.
with
This could be good for that.
You know, Ryanair was one. U.S. I think
News is
United
important.
Airlines is
News,
another.
you got
So
to
I have to
define
double
what
check
the
on
news
who's in
is,
who's out.
and
But David,
remember it. Put it in
look at
your mind.
Boeing,
Okay, it's just
this, a name
that ain't
that
gonna
you
make this stock
trade,
run.
Or do you buy it and say it's a buy for the long term, or steer clear?
I'm looking for a reason to
A
get
change
back
of
into the
board
stock. I actually sold
could
the
have
stock
a small
at the
effect
open
on a
the
company.
first trading day following the Alaska
You know, they're
Airlines
struggling,
incident,
so they
which I thought it was pretty serious.
decide to change
It
the
was
board
very
around.
fortunate for them that there wasn't loss of life. So I'm looking for
Elon
ways
Musk
in, so I'm going to have to hear something on the call
wanting to
Nicholas's
get
point.
27% of the board so he could have some say in his own
ramp
company.
back up, because that you know, the push out of the profitability for Max is what's on every investor's mind. I've got to see some
So
answers
news,
on that, then
and that's
I
what
might
I
start
trade
to
off.
buy
I trade off
myself.
of news. I don't take a trade.
As someone who follows
I don't take
some of
any
these
trade.
industrial type
I don't care
names,
what it
other
is.
names that you
Amazon,
like or recommend these
Nvidia.
days
I'm
that
going
are
to go right straight
trip
to
our
the
viewers,
news,
is something that
and
you
I ain't
love
going to
today
take it
or have a buy rating on
until I
today?
read the news. The
Well, I
most
guess,
recent
one of the names
headline,
that
and that's all. I
found,
don't need to
also
read a
got
whole
cheap
book.
on a
I just need to read a
different
headline.
Version of an assembly issue, but RTX with their Pratt & Whitney engine recall really took a
$80 million
beating, and I thought it
initial
was
partnership.
sort of
I mean,
overdone,
that's a big
you know,
thing
starting
for a
to come
small
back
company.
too. So,
And we just hit my
these businesses,
resistance.
especially in commercial aerospace, where you have really long product cycles.
Damn,
they are
perfect.
cyclical, they are exposed to economics, but in some ways they're also a little bit
See,
protected just because
how
of
did I
those
get
long
102.69?
All right, so RTX will keep an eye
I
on
mean,
that
this-
one as
that-
well. Thank you both so very
Perfect.
much. David Nelson, Bell
I'll
Point
show you how I
Asset
got it here in a
Management.
second.
Nicholas Owens of Morningstar. Great to see you both. A nice preview there for Boeing as well. Thank you for being with me, friends, here on the watch list. here on Schwab Network. Every single day, I'm Nicole Petalides, live from the New York Stock Exchange, 11 a.m. and 2 p.m. In the meantime, keep it right here. Market on Close is next.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
I'm Nicole Petalides, live at the New York Stock Exchange. Catch me on Schwab Network. Available anytime, anywhere, on any
So this is how I did it.
Schwab Network.
Pull up the yearly time frame. The yearly daily.
Every day.
It might have been a weekly.
I'm Tom White, host of Fast Market. Ready for you, ready to
Yeah.
go at 12 p.m. Eastern on the Schwab
So it
Network.
was the weekly time frame. And there's a pattern
Each
here.
and every
It's a
angle.
descending pattern.
Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading
It's all about patterns.
360,
If I don't see a pattern,
only on Schwab Network.
so this is descending.
Welcome to Schwab Network.
Daily live exclusive content.
And this is a solid support. Each one of these candles represent a week.
24/7 from our
So we were a
studios
week,
in
week,
Chicago.
week,
And from
week,
the heart of Wall
week,
Street,
week,
the New York
week,
Stock
week,
Exchange.
week,
Up
week,
to the minute
week,
market
week,
insights,
week,
Example
week,
trades,
week,
and stock
week,
specific
week, week,
analysis
week, week,
featuring
week,
the
week,
smartest
week,
minds in the
week,
business.
week. That's a solid
No
support.
politics,
No noise.
analysis ahead of the biggest
So when you're
events
coming up
for
from the
economy.
bottom,
From bell to bell and
that
beyond.
2 year, how many weeks this
Watch
is?
live
1,
and
2,
on
3,
demand.
4, 5, 6, 7,
7
8,
days a week
almost
on
9 months
schwabnetwork.com.
of
And
holding
on all your
a
favorite
buck
streaming services.
becomes a very
Available
hard
anytime,
resistance.
anywhere.
On any device for free.
Schwab Network.
Which comes right up to
Every
it. Then you got the
investor and
50
trader
SMA
Today.
on the weekly time frame here as a resistance level also. So that's a double confirmation. You got the descending support
with the Schwab Network.
at
Tune in
102.69.
24 hours a day.
Then you got the
7 days
50
a week on
SMA.
SchwabNetwork.com and on all your favorite streaming services.
I mean, it don't get no
Schwab
better than
Network,
that.
Available anytime, anywhere, on any device for free. Schwab Network.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
We got 1 minute to power hour.
I'm Oliver Rennick. Get ready to cut the cord. Market on Close is coming up.
So yeah, the news on this one was a no-brainer. You got to watch the tape. People are going to start selling out of this thing, but it's still great news. I mean, this can continue. Sometimes I'll go to FinViz. I used to be able to have it on the scanner. I could look at the float. Now I got to look it up, take some time out. Go to
Good
FinViz.
afternoon and welcome to Market on Close. I'm Oliver.
Type
Rennick.
in Mark.
Good afternoon ahead of us here, so buckle in. We got earnings kicking off with some of the giants this afternoon. Microsoft,
Float
Alphabet,
is
and
20 million.
really important names, of
So
course.
20 million float is a respectable float. It's not 2.5 million where you'll get a lot of volatility. You got 25 million and anything above that, you know,
kind of on hold.
you're not going to get you're going to get a certain brand of trader to come in here and trade it between 20 and 25 million float. Because you won't have that volatility that you'll have with a 1.2 million. That's when the pumpers come in. I don't care what the stock is. If it's got 1.5 million, 2 million float, you're going to have a lot of pumpers coming into the trade. A lot of uneducated pumpers that just go off somebody else's opinion.
Obviously, there's some good reason behind it. A lot of new developments happening. We've seen major turning points in semiconductor outlooks, but rubber's going to meet the road. We got to see some real product and utility being offered by Microsoft and Alphabet, and we need to see that AMD can justify
I'll be right back. I got to
extraordinary
go
rise in
do something
valuation,
real fast.
which sets it apart from NVIDIA's move, which has been supported by valuations given all the earnings they're generating. So with the S&Ps roughly flat going into these
Yeah, I know.
reports,
I've got stuck in a
makes
couple of
sense.
these here this week, last week,
Item of the
but
week, even on a Fed week, even on a
yesterday.
jobs week. Let's go through some of the movers here from the session that do stand out. The biggest moves
But today's
from
been a blissful
macro
day on this one.
standpoint are in crude oil and in Bitcoin. WTI bouncing back above 77, took a little bit of a hit yesterday, but we're seeing dip buying happening in crude again, which is seemingly a new development really compared to the last couple of quarters in which most rallies were sold in crude. Now we're kind of buying dips, and WTI is creeping higher on its relative strength and its momentum, but not quite to that $80 just yet. Maybe we have a deeper inflation-centric discussion if that happens. Bitcoin did bounce back after touching 40K and underperforming stocks in the wake of its ETF debut, but it looks like it really wants to try and pop here the last couple of days and across the weekend. A few spurts of life into Bitcoin have brought it back to just below 44, but with stocks still making highs compared to other risk assets, got some catching up to do. We'll see if it does
Right
that,
back.
if it needs some help from the Fed this week with some prospect of new fresh liquidity through cuts or an into QT certainly would be welcomed by Bitcoin and other risk assets. The dollar was down. The dollar bears are looking for something dovish tomorrow, but dollar bulls have been hanging in there. The greenback has not gone down without a fight. Even though yields have remained very subdued, the dollar has been relatively firm compared to yields in the last couple weeks. Maybe it's because we just keep getting information on how soft China's economy is. Look at the intraday swing in bonds, which have been driven by some other forces lately too, notably yesterday's Treasury refunding announcement that was below expectations. It caught a pretty big bid into bonds, and so the yield dropped. You're looking at the 10-year futures chart right now. Today, we did get a pop in yields after consumer sentiment came in above expectations. Confidence remains high. We also saw JOLTS number of job openings out there go back above 9 million. So even though the inflation figures have been softening, and that's what the doves are looking for, the other data has been quite impressive still. So it really is tough to figure out how the Fed's going to navigate this, with markets still giving about a 40% chance of that March cut. There is some macro tension going into tomorrow for sure. But we'll talk about that later on. Talk about it also with our macro guests today. We've got some real smart people joining us this afternoon. The semiconductors down today. That's basically why the NASDAQ is stuck. A little nervousness perhaps ahead of the reports this afternoon. The chip making sector overall, though, still looks pretty darn good. Technically, obviously, we got to the new high in the SMH or the SOX. A little bit of chop here in the last 3-4 trading days, basically since last Friday, after Intel and Western Digital slipped on their earnings. But those have always kind of been the secondary stories. AMD, possibly even more important than NVIDIA, because AMD represents not just the AI developments, but the broader frothiness outside of NVIDIA throughout the sector. Because NVIDIA's earnings grew so much, its valuation is still well off the highs. Not the case for AMD, trading at 50 times forward. A massive move in valuations for AMD that have been reflected by the broader semiconductor group, which are at record valuations, with the whole basket trading above 35 on its forward valuation. Get ready this afternoon. Microsoft and Alphabet. The AI battle. Microsoft is at all-time highs. It took Alphabet a while to get there, but it did join in. The white line Alphabet, you can see just the last week, punched through an all-time record. Microsoft has been there for a long time, so hopefully they can prove their staying power as the world's biggest company. Heavy lies the crown. Kevin Hanks and Jenny Hornick here with me this afternoon. What's interesting about all this is that it's actually the old banks that are leading us higher today. So it's this market where even if tech takes a break, we got something there to plug the gap. Today it's financials, Jenny.
I know, and actually, I think that I've been watching too much of like Microsoft, Alphabet, Meta, and Apple price action this week. But hey, the banks are looking pretty nice on a year-to-date basis. I know it's really early, but hey, Citi's up, 11% since the start of this year, and pacing for its highest close today.
I was going to get a knife. I knew I should have.
Really solid performance today from some of these major banks, and this follows a
Resistance.
Goldman Sachs, Bank of America, as well as BNY Mellon, but particularly, I think it was compelling on Citi because they did say when looking specifically at Citi, they called this the biggest beneficiary from incremental buybacks, as they do think that buybacks at roughly half of their book value are very accretive to overall financial transactions, and also do see this being actually a broader trend for the space. They highlighted the fact that this so-called Basel Endgame is the set of rules that was proposed last summer that would require higher capital levels for banks with more than $100 billion in assets. They think that the vast majority of these big banks' management teams have suggested the rules will actually be lighter than feared. So for that reason, they see a sunnier prospect for overall buybacks in the space. So I think that's really interesting, and it's a take we haven't necessarily heard, that perhaps some of the pessimism that's been priced into these stocks, I know it doesn't look that way right now, but some of the recent pessimism could perhaps be a little bit overdone. And buybacks, I think we'd all welcome those at this point.
Yeah, a little surprise catalyst here on the regulatory side. I guess when the upgrade on the banks comes from another bank, maybe carries a little weight. So the financials generally have been pretty good. The other thing too, I think, Kevin, that's important here is the regional banks have been all right. They're in the smaller cap group, so still generally below the rest of the peers. But it does seem to reflect some confidence in the economy too. At the end of the day, banks are cyclical.
Also a special story. Remember, Citi is going through some harsh restructuring
That's true
right
too.
now.
Yeah.
Eliminating some businesses that were stale, really getting themselves lean and agile. So not surprising that, and Jenny mentioned, it's trading at a fraction of its book value.
Your efficiencies, not limited to tech. I mean, that really is a big takeaway from this earnings season, is that if you are making structural changes to profitability.
And the other message so far, don't miss earnings.
Yeah.
Like UPS and Whirlpool. Don't miss, and don't guide weaker. They don't like that.
Whether or not it's macro,
I don't think it's going to matter.
I feel like there's a little bit of argument there that UPS is getting its lunch eaten somewhat by Amazon.
We don't know for sure, but certainly Amazon is playing a role in UPS's numbers going down. And you think about this. You negotiate this massive contract that the street hates. How much you paid out? What do you do the next quarter? You only have 12,000 employees. So it's interesting how it's playing out over time. But they're going to automate, they're going to do all these other things. So, yeah, really rough ride. However, UPS is cyclical. So you would expect them to make themselves more efficient during this period, come out stronger.
I'm not surprised by UPS getting punished. I'm a little bit surprised that Whirlpool's numbers continue to disappoint when housing seems to be so strong. But then again, you look at some of the that Pulte Group response to it, it's a little bit choppy there because there are a lot of negatives on that report as well. But just kind of seeing the stuff at the bottom of the performance list today, Jenny. UPS, Whirlpool, a little bit ancient, a little bit kind of industrial and cyclical, not really where our focus is this week with tech.
I know, and I feel like all of this is like the hearty appetizer to what is to come today, really, after the closing bell. I mean, Whirlpool, I think that it's about time we start to see, I mean, like, I know that they haven't exactly had, like, most stellar earnings history as of late, but given some of the negativity, like the fact that average prices are coming down, mortgage rates have impacted some of these home builders, like, you'd have to think that some of the economic data points will start to catch up with these names. It hasn't really been that case, but I guess Whirlpool hasn't exactly gotten the love either.
Yeah, a couple guidance cuts to get punished. It is kind of reassuring that the market is really distinguishing quality. I mean, that's a big takeaway. Dispersion's present. This is not, I was watching the GameStop movie last night. This is not like COVID mania by any means, Kevin, even though we're at all-time highs. A lot of it is coming from a handful of companies. This is not frothy, wild, indiscriminate buying of everything.
Depending on the sector, they're creating some winners and losers. Now, once you get into the Magnificent Seven, and by the way, Google, the cheapest PE of the Magnificent Seven going into earnings.
Yeah, good stat there.
So if you're looking at one, that one might be the outlier. The others, ridiculous.
Right. Nice. Like that's done. Very helpful. Thanks for joining, Kevin Hayes. Nice work, team. All right, let's discuss the economic picture and the global outlook. Real smart guest joining us, Jens Nordvig, founder and CEO Miguel Exante Data and co-founder and CEO at Market.
That was a good point right there.
Happy New Year. Good to see you again.
If that was a headline alone,
Absolutely.
Google has the lowest number of PE
your guys' Twitter feed on China, what's happening there, but
of all the other ones, which means that could really bounce good.
This week we've got the Fed, we've got big cap earnings in a market that's the most concentrated since .com. So how should we rate these events in order of
Tempting to take a risk.
I think right now we're at a crucial point for the interest rate cycle, right? So everybody is looking for the
Link
Fed
could come after hours.
when they're ready to cut. And we've looked at the inflation data now for a bit more than 6 months, and it's been looking okay for, I would say, 7 or 8 months now. I don't think the Fed needs 12 months of good inflation data. They probably need a little bit more than 6. So I think this week they're going to sound pretty constructive on inflation. I think that could open up the door even more than it is now for a March cut. And something will have to go wrong for them to not deliver. So obviously the marketability of a March cut was priced close to 100% at the end of last year. Now we're down slightly less than 50, as you mentioned yourself earlier. So I think we're going to continue to fluctuate there, and that's going to be a really, really important driver of the market overall.
So do you think that odds of March, which we've got it up right now, actually, we just pulled from the CME at least, has about 40%. You think that will conclusively move one direction or another, either back to like a 70-ish or down to like a not going to happen, or do you think this is going to be a coin flip until we literally go up to the date?
I don't see any reason for the Fed to push in a hawkish direction here. They've gotten the inflation data that they wanted. It's true that GDP has been pretty strong, right? But they don't mind strong GDP if inflation is okay. So I think they're going to continue to say that inflation is going in the right direction and that all options are open for the next few meetings. So I wouldn't be surprised if the probability goes above 50 after the Fed meeting tomorrow. I think, as I said, something has to go wrong, i.e. inflation has to come back up again in order for them to not start a cutting cycle relatively soon.
The question I wonder is, if I'm Powell, I'm thinking about how much has already been kind of baked in to these expectations. We've got the economy. The idea is that I should cut because I'm straining the economy, and we're beating most of our economic expectations. Stock market's at highs, crude's pushing back to 80. I mean, are these things getting factored in? Do I have to do this to make sure we hold those levels, or is doing this going to be then a stimulant to the economy at this point?
I think you're going to have a debate within the FOMC, right, where you have a part of the FOMC that's going to be, you know, the Taylor rule guys that are going to use some kind of formula to say, okay, with inflation having come down this much, we don't need to have official rates at 5.5 or close to it anymore, right? So there's going to be some kind of, you know, formulaic adjustment in the appropriate Fed rates, and there's going to be another group within the FOMC that's going to sit more and look at, okay, what's actually the signals we're getting from the economy, a more kind of hands-on approach, right? And the economy surprised massively in the third quarter, and it surprised again in the opposite direction for the fourth quarter, right? So when you look at GDP, we haven't really seen any meaningful slowdown at all, right? So those people who perhaps are less, you know, formulaic in their approach, less Taylor rule driven, they're going to perhaps push back and say, okay, do we really need to go? And I think perhaps the real debate will be about the pace. The market has this idea that once the Fed starts, they'll have to go at every single meeting. That's also something that could be up for debate. Like maybe they want to get going very slowly. Waller kind of like highlighted that in his last speech. So it's not just about what meeting they start, it's also about the pace at which they go. And it doesn't have to be every single meeting. The market has a tendency to price it like that. But I think the reason the market has a tendency to price it like that is that in past cycles, we often start the tightening cycle with a real economic problem like a crisis or some real growth problem, inflation fear, and therefore they needed to go very aggressively once they went. That's not exactly the situation we have here. Here it's more like a recalibration because inflation is coming down to a much better level and we don't need the policies so tight, but it's not really a panic cutting cycle and therefore it could potentially be more gradual.
I like that. Okay, and as it pertains to its impact on markets and bonds, kind of starting there, how does it compare to Treasury issuance? Yesterday we did see markets move on that. I've kind of been cynical on the overall subject that matters a lot, like 750 versus 800 billion. Not sure why that really matters. But I guess there are things such as expectations and reality, right? And you guys do track kind of how much the market expects the Treasury issue, et cetera.
Yeah, I think you make a very good point there, right? The reactions we've had to these quarterly refunding announcements have been about more than just the news we've had. They have a lot to do with where very specific expectations are, and they also have a lot to do with how the market are positioned, right? So if we go back to August last year when yields really started to break out, like move through 4 and quickly went to 5.
Mark just broke resistance. This is good news, I'm telling you. $150 might be next. What's going on here?
I don't think we're going to sit around here. I don't think that we can have a solid opinion about what the answer is in terms of when, because there's no way they know.
See, here they go again. The same freaking subject 24 hours a day.
They're hoping they have maybe
Fed rate decision out tomorrow, all day long, all year long.
Really has downside momentum, but I don't think I'm not that
CBC.
sensitive. As you said, we were 90% for a cut in March. In December.
Tightening through the balance sheet.
I think the Fed has tried to sort of divorce those two things a little bit, and I think they feel they still have too much reserves in the system, right? They want to normalize that, and that's going to keep going for a while. I think Laura Logan has been pretty clear about that process, still has some further to run. So I think sequencing of those two things will be on different timetables. And the first stop, the first big decision the Fed has to make is when do they start the cutting cycle. Is it going to be March, or are they going to delay it a little bit? That's what we're going to figure out potentially tomorrow.
All right. Hey, can you give me like a 60-second take on China? Because I know you guys spent time watching this, and the basic question being, is there hope that their stimulus will be able to put a floor into their markets?
Yeah, so we've had a lot of client discussions about that over the last 2 weeks, right? So that
SPX knife.
China is trying to come up with some kind of plan to stabilize the equity market. But it's a very, very interesting situation, right? Because we've had so many fits and starts of China's stimulus that everybody in the market is now extremely skeptical. It used to be the case a couple of years ago, as soon as China was saying something about stimulus, like all the different assets were moving, people want to see the actual plan in motion now and are waiting for the concrete measures as opposed to rumors. So we've not seen flows yet. If we have a concrete announcement, the market will move.
All right. Thanks, Jens, for your time. Great analysis. Good stuff. Make sure to go check out Jens on Twitter and Educator as well. A lot of good live updates on their analysis. When we come back, let's trade and let's focus in on the Giants. We're going to take a look at options and Apple later this week.
My dad was a hard worker. He used to do side jobs installing windows.
God, I hate looking at you. I just can't stand looking at you. Won't you shave? Won't you get rid of that mustache? I don't want to look at you. I just don't want to do it. What the fudge? God, Mark's at 130. I'm going to 150. Man, 148. Hey June, where are you now? Can you give me 148? I love. Brings back the flashbacks from the old days. Where are you now? There it is, 148. $148. Bingo. You don't mess around with Big Bad Jim.
Uptown got his hustlers, the Bowery got his bumps. 46th Street got a big Jim Boy, but he pulls shooting son of a gun. Yeah, he's big and dumb as a man can come, but he's strong and hungry hot. And when the bad folks all get together at night, you the outlaw big Jim Boy just become. And they say you don't tug on Superman's cape, you don't
Speed in the wind.
you don't go a man's on the old Lone Ranger, and you
Don't mess around with Jim.
Well, I South Alabama from a country boy, said looking for a man named Jim. I am a bull shooting boy, my name is Willie McCoy, but I'm on a coffin slam. Here I'm looking for the king of 42nd Street, got on drop top Cadillac. After he took all my money and it makes out fun, and when I come to get my money back, it ain't about saying that.
Man's cave. Don't spit in the wind. Oh, and you don't mess around with Jim. Boom, 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 boom. Man's cave. Spit in the wind. And you don't mess around with Jim. Yeah.
sciences: oncology, cardiovascular metabolics, and neurology.
The neurology one seems to be kind of a highlight right now, as I kind of think about some of the post-COVID themes. There's kind of return to the companies that are on the forefront of cancer, which were big, obviously, before COVID too. And there's the obesity-centric stuff, which is kind of limited to a few main leaders. And then it seems like the neuroscience, Alzheimer's and other diseases that really fall under a pretty broad basket for neuroscience that seems to be another big area of opportunity.
Yeah, I mean, I think we live in a world where obviously there's an aging population. In the US, in 2024, there will be more people aged over 65 than under 15 for the first time ever. And what that ultimately means is that there will be a greater prevalence and a need for neurological disorder treatments. We've also seen significant changes, significant improvements in how we treat disease like Alzheimer's. But the reality is that we're still in a relatively early stage of the disease innovation cycle in life sciences, specifically neurology. And what we're excited by is the new kinds of treatments that are coming out. There was a game-changing breakthrough in Alzheimer's last year that is expected to come to market this year. But also, for example, gene editing to non-opioid pain treatments for depression. And then what COVID also revealed is beyond neurology specifically, there's also a big unmet need in the mental health space. What the MNTL ETF focuses on is the neuroscience and mental health space. The two are closely interlinked, and the two are both seeing rapid innovation, unmet, different corners of the market.
Yeah, it seems like somebody.
Have a little bit of issues there, Schwabi.
Bottom-up investment process overseen by a CIO to help us navigate these risks and ultimately identify the right opportunities in what is a very interesting and fast-growing space.
What are your goals in terms of flows, in terms of assets? So where are you seeing the most interest so far?
So I think our HRTS ticker is seeing the most interest so far, which is focused on the obesity and diabetes space, followed by our CANC ticker for oncology. MNTL launched last week, but already seen very strong flows in the first week. We've raised already over $10 million in the first 5 days of trading, which is encouraging.
Okay. All right. Very exciting stuff. Very interesting sectors, key groups as well that we need to keep an eye on. So appreciate the details. Thanks for taking us through it. Good stuff, Lawrence.
Thanks a lot.
Joining us from talent, ETFs. All right, coming up, let's talk some commodities. Take a look at crude oil and its connection to the dollar too. A lot of things that are coming to a head tomorrow. We're also looking at gold as well. How do these assets respond to the Fed? How do they stand on the charts right now? Bob Ichino's up next. Be right back.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investing.
Snake, breakout, pullback, high or low, boom. One, two, three. Wedgie, boom. It's an interesting one. Interesting.
Even though the market might have participated a little bit on the short-term side of it, you had the Saudi Aramco decree that they were dropping plans to expand production capacity. Now that obviously doesn't matter for today, but certainly matters for the future. A similar situation with U.S. production, week ending January 19, dropped by 1 million barrels a day. Then you go back 2 weeks on rig counts, we saw -2+2, so no movement there either. A couple of extra rigs in the Permian, which I guess is good news, but we've talked about this more and more that not over the short term, but over the medium term, these production excesses will heal themselves, given the direction of the overall sort of view of fossil fuels by this particular administration, this particular point in time. So if you don't get a change in that, that's kind of a problem. You could throw that on with the LNG leases, where they've suspended those leases. That causes a little bit of a problem for Europe, and you could see some hoarding in that area as well.
The notion that supply has been, keeping this price down seems to be very reasonable as we start to move a little higher without any big changes to supply. Does that kind of suggest that things might be improving on the demand side?
Well, I think the demand side is stable with the idea that they will improve. We're not in the summer driving season. That is still to come. There's a lot of people that say that the Chinese recovery will eventually happen, and they're going to start refilling their crude oil supplies. They kind of depleted them in the beginning points of the conflict with Russia and Ukraine, and now they're starting to stockpile them up again. Even though no one is talking about it, the Strategic Petroleum Reserve is also starting to refill slowly. We're seeing an uptick in those numbers as well, although they say they have physical limitations as to why they can't do it faster. I don't really know what that means. I don't know what the physical limitations would be. It could be something that's actually happening. I'm not being sarcastic. I just don't know what those are. So you might see a little bit of stabilization in demand. And I think a lot of people believe the U.S. economy specifically might be reflating a little bit. You know, we had PMI numbers that were still in negative territory over the Europe, Germany, UK, but they were better. They had looked better. Same thing with the S&P Global PMI here, although we went into manufacturing, into expansion territory. That is a big consumer of energy. So if we start to get a rebound, sort of a reflationary tone here in the U.S., that'll bolster support for crude oil as well.
Okay, like that. All right, so things start to look a little bit up here for WTI. Ag gas going to need something a little bit more, I guess, in the narrative right now, which has been pretty bearish for this thing. What about the dollar's role in all of it, Bob? The dollar has been trying firm for the most part, but with big pivot expectations for the Fed ahead. Does that limit how high the dollar can go, or do you think Fed will surprise, dollar rallies? Walk me through the way you're thinking about the currency.
Well, I don't. Jerome Powell had a really dovish turn, right? And then some of the other Fed voting members, Michelle Bowman, for example, they came out and they kind of tried to fly in the face of that a little bit, but not really convincingly. So tomorrow's another one of those opportunities where we don't care what the action is because there's going to be no action. But we went from 7 rate cuts being priced in to 5 rate cuts being priced in. These are, of course, the highest probabilities as per the CME Fed Watch rule, not high probability, just the highest. We went from 7 to 5, we're back at 6. This is Chair Powell's opportunity to push back on that, and I'm not sure he's going to. When you look at the overall situation going into what's going on with the U.S. and what may be a little bit of a resurgence of goods inflation, especially if we get an energy upturn. So we're not seeing a sign that goods inflation is taking off. We're seeing it stabilizing, not necessarily deflating as aggressively as it was. And services inflation still running at very high levels. But you've got the core PCE at 2.9. A lot of people saw that as a victory. But imagine prior to that spike that we saw up to 6 to 9%, depending on which indicator you're looking at. What would 2.9% inflation have been? It would have been unacceptable. So it's going to be really interesting tomorrow. I think when you're looking at the dollar, I wish we could have this conversation tomorrow afternoon or Thursday morning.
Think there's going to be some surprise here? If so, what's possible for the dollar? I mean, if the dollar does rise, I assume rates didn't go with it. Is that the way we should still be thinking about it?
I would think that. I mean, I think the market is going to discount any large move in the dollar because all that Powell can do is turn the market from 6 expected cuts to maybe 4. He's not going to get them all that way down to 3. He's certainly not going to get them down. So there's definitely a cap on the dollar. It's certainly not 105 on the dollar index, but I'd more be looking at the euro-US dollar and watching that and seeing how far that can go because, again, we've got a larger slowdown in the EU, but we also have a higher baseline inflation.
Got it. All right, nice. Good discussion ahead of tomorrow. Last one for you real quick, Bob. Gold kind of looks like it doesn't want to back down, and so been hanging out pretty consistently.
It's one of my favorite subjects because it is hanging in despite us starting to ebb and flow from these rate cuts, no rate cuts, yes rate cuts. The gold's obviously going to be very strong with rate cuts, and if Powell starts to walk those back, which an aggressive walk back I think is the least likely scenario, gold to me is still a play for the long term.
All right, there it is, Bob Jim. Thanks for the macro take here. Head to the Fed tomorrow. Appreciate it, Path Trading Partners. Let's go to Nita Young for a developing story back into the world of tech with no doubt on AMD for us to think about ahead of its report this afternoon. And kind of negative one, Nita.
Absolutely. So AMD has earnings coming after the bell, and we see now Raymond James, which downgraded this stock to outperform from a strong buy, but decided to add about $5 to its price target for the stock, now at $195 a share. And he's citing AMD's valuation for the downgrade, saying that the stock, of course, first, it is still trading pretty close to its all-time high, but this analyst says that shares are discounting around $7 a share in earnings and trading at around 33 times estimates for 2025 earnings with that recent run-up to the stock. And he says as a result, the stock is already discounting around
Well, that's
20%
something to put a downgrade in front of earnings.
for AMD's M1300.
I mean, that takes a lot of guts.
And this valuation is closer to his bull case scenario. And also at that level, AMD's AI business would need to generate more than $3 for earnings per share in 2025. That would mean around $12 billion in revenue or more than 800,000 units sold. Now, for perspective, the analyst estimates AI.
I always think AMD always has,
2 million units
good earnings.
And it remains on track to increase its AI shipments for chips to $3.2 million in 2024. That's NVIDIA. Now, Raymond James says that rapid expansion and share gain for this company, for AMD, is less common in data center revenue, and that it could attract more aggressive competitive reactions from NVIDIA.
Okay, all right, tough living in the shadow of NVIDIA, but expectations now move along with it. So should be following this afternoon. A little bit of doubt being cast on it here. Thanks, Sharpie Young, for the look at AMD. Still, though, prices are high. We even went the kind of negative tone from Raymond James there. When we come back, Lizanne Saunders is going to take us to the bell with a big picture discussion about the week ahead. Don't miss it.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all the financial tools and support to secure your financial future. That means a lot for my community and for every community.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights,
example trades, and stock-specific analysis featuring the smartest minds in the business.
no politics,
no noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere,
on any device for free.
Schwab Network, empowering every investor and trader
every market day. Power your portfolio with the Schwab Network. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Market on Close. The stock's a little softer here in the last 10 minutes or so, but we still got some time. Lizanne Saunders joins us, Chief Investment Strategist at Schwab's Center for Financial Research. Ahead of the big tech earnings, Lizanne, kind of give us the framework that you're using as we get to the real important part of the earnings season here.
Well, I do think not just because of the attention on a group like the Magnificent Seven, but the earnings rate is important too, because if you look at calendar year 2023, of course, we're reporting.
None of them are looking good right now. Microsoft,
You've got an expected
new low on Google.
Growth rate for the Magnificent Seven, 5.5% for the overall S&P, negative 2% for the S&P X the Magnificent Seven. So, you know, once we have that group of earnings in, I think it probably
SMCI just hit the 200.
Not just tech landscape, but that mega cap tech related kind of names. You have a similar story developing for the full calendar year, not just the quarter, with that huge bias in earnings. And we're starting to see, and then we talked about it the other day, Oliver, just much more dispersion. Correlations are low within an index like the S&P. At the same time, even dispersion has widened per the Magnificent Seven. So I think there are opportunities outside of that small group of names, and earnings season helps define where those opportunities are.
Yeah, well said. It's been a really important part of this is figuring out what has been left behind, maybe what deserves it and what doesn't. It seems like you think that maybe there's some stuff that's been left behind that maybe doesn't quite deserve that punishment. How do we know in the numbers when those companies are reporting? How do we know what they look like?
Well, you know, it is more than just things like the beat rate. And I don't say that just about individual reports as they come in, some of the high flyers, but even for the overall index, I think metrics like the beat rate and the percent by which companies are beating doesn't seem to hold as much importance. I think it's outlooks that are important, giving analysts a sense of whether their forward numbers are realistic. That's what's embedded in forward valuation metrics, obviously. Profit margins, because in the aggregate, there was an expectation that the lift we saw in third quarter profit margins would continue in the fourth quarter. That's not the case. We've rolled over from 12.2% net profit margin for the S&P down to 10.7. That's still a moving target of 10.7 because we're in the middle of earnings season. But I think it's the sort of under the surface stories that are more important to pay attention to in an earnings season like this than just those simple metrics of beat rate.
Like that. So right now, when you look at kind of what's driving this market, earnings versus valuations, where the latter might be a little bit more dependent on what happens with the Fed, what kind of drives your thinking here over the next couple of days on what's going to be most important and what will, I guess, shake up any of the macro underlying situation that's driven by the Fed?
The Fed meeting, not because there's an expectation that they're going to actually do anything, and there may not be much in the way of significant changes to the statement, but we're certainly at the point in the cycle where the press conferences have the potential to be market moving, depending on either what Powell says out front or, well, of course, what he's peppered with in terms of questions and how he responds. And I think
too bad they have to come out right before the pow-pow.
About the simplicity of, you know, will they start in March, and if so, what are the conditions that would suggest that's appropriate? But when are they going to give us more concrete information on
which could give us a buy opportunity tomorrow.
In terms of the balance sheet, our expectation is that they'll likely more formally announce details around the balance sheet at the March meeting, which is part of the reason why we think the May meeting is more likely for an initial cut. But then, of course, this week we also have jobs. And much like I mentioned with earnings, where I think it's some of the under-the-surface details that matter a little bit more, what I'd say focus on Friday's jobs report is not just payrolls and the unemployment rate, but the details around revisions to payrolls, any significant differential between payrolls and the household survey, part-time versus full-time jobs, hours worked, wages. I think, you know, fine-tooth combing is the right thing to do in terms of approaching these very important reports that feed right into the Fed reaction function.
It sounds like you think the data after this week, and including Friday's employment, are still going to be able to move the needle on that March decision. So in other words, this is not going to be an open and shut case tomorrow afternoon.
Well, even today with incoming reports, early this morning, I think the CME FedWatch tool was showing about a 36% probability of cuts starting in March, and that's jumped up to 41% right before you and I went on. So I think any incoming report, be it on the economy or inflation, anything tied to what the Fed keeps a close eye on, specific to both of their mandates, I think could move the needle in terms of expectations. It's just our view that we think announcing details around the balance sheet, they may want to do that in advance of shifting to cutting rates. And on balance, whether it's consumer confidence or retail sales or headline labor market numbers, there really isn't a support yet for the Fed to be pivoting more than what they've just done with their words, but actually pivoting to near-term rate cuts. And I would guess we'll hear a bit more in that direction from Powell.
Okay. All right, great stuff for us to think about. Good baseline for us to work off. Appreciate your time, Lizanne.
Good to see you.
Yeah, likewise, Lizanne Saunders. Chief Investment Strategist at Schwab's Center for Financial Research. Some thoughts on big tech trade, valuations, and Fed. When we get back, Microsoft and Alphabet are first. AMD also coming up. Our closers panel will be looking for these numbers live. Join us. See you in a few.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in.
We have 1 minute left. Countdown shall begin. Earnings. We're all waiting in anticipation. My ding-a-ling went off. Where'd they go? 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 There's Microsoft. Microsoft is off to the races. Volume spike on AMD. Google. Breakout. Microsoft is one they always talked about the most. And it's boinged. Must be cloud. Fuck, I can't find it. Get too much shit on here. Ooh. Ouch. I'll be back. Google boing. Oh God. This is the big bubble.
And Nicole Pelli is with me to go through these numbers and get ready for the reports. Looks like we might actually have a little timing shift here. Let's go to Microsoft, which is giving the numbers right now. Revenue of $62 billion is a narrow beat, but a beat of 61.1. I will say, last couple of years, we've seen Microsoft.
Still a lot of money.
We've gotten accustomed to Microsoft beating by like multiple billions, so it's not exactly a monster beat there, Nicole, but at least it is ahead of the expectations.
Yeah, we'll take it, right? Yeah, a beat is a beat, and I'm looking at first some of the other things that we've been talking about. For example, the cloud segment, which includes Azure. I see some of that coming out. Intelligent Cloud operating income, $12.4 billion. Azure and other cloud services revenue up 30%. They were expecting for that to be obviously a big number. Office, AI, these are the things that we're looking for here overall. Devices revenue, that was down 9% for Microsoft. But the big Xbox content services revenue up 61%. I don't know, anything up 61%, well, me. That's got to be fantastic. I don't know what the expectations were for that, but that sounds generally pretty great. The big picture, as you mentioned, is $62 billion, and I know the revenue was expected to come in around $61.1 billion. Don't forget that Microsoft has outmuscled Apple now this year. It's now the across that $3 trillion market cap. Microsoft has really propelled itself with ChatGPT and OpenAI, and while the others are trying to play catch up, like Google with Bard and Amazon even with its new investment in the AI company Anthropic, they have a minority partnership there. Still, Microsoft has been the one that made that huge foray in the early go of it. So you see some obviously back and forth action here in the after hours.
Yeah, a little bit of a chop, but overall pretty solid numbers. Hard to kind of know if it's going to be enough though, given all the leadership in this stock. I do kind of wonder about that. Kevin, when you look at the overall trend, I mean, I think the Activision pickup is working pretty well for the gaming side of the business. The overall cloud seems to be in line with expectations. That would have been the area where a real healthy beat would have been nice, but it's just kind of on par.
Yeah, definitely. I think the productivity side of the business, I think, is going to be the bright spot here. And we also have to kind of just remind our viewers, too, we're not going to get the guidance until they have the conference call, and it's usually a verbal guide of a range here. So I think the market also might be waiting for that, too. But I think I'm right there with Nicole. You know, when you're talking about some of these numbers, the bar's fairly high when you're looking at Microsoft or even on Google. So even when you come in line when it comes to the market expectations, it could also continue to provide a little bit of pressure to the downside here, at least for the near term. And I think their ability to talk about on the call the ability to integrate AI into Copilot as well as some of the other offerings, especially when you're talking about Bing, I think that might be a little bit of a bright spot here on top of some of the fundamental data that we just received.
Okay. Yeah, we're slipping a little bit. Look, they've got a reputation of really crushing sales last couple of years. I mean, think about during COVID when they were beaten by multiple billions, the market kept underestimating Microsoft. I kind of feel like this is just more of a scenario where the market is caught up to Microsoft's prowess and dominance. There's nothing bad, there's nothing disappointing here. Earnings also beat, so margin and all the profitability stuff seems to be better than expected. It's just, I think, when you've got big price action behind it, you know, it's just gets hard to beat. Biggest company in the world now.
And look, I've been hearing all week long about people just taking profits on Microsoft.
What? Why didn't you say that earlier?
Just because it has done so incredibly well, right? Over 1 year, it's up 65%. And I've been hearing about people taking profits off the table and saying that.
I agree with her. This freaking run is something that I've never witnessed in 20 years. And these things are a bubble. I'll keep saying it because I've been here 20 years watching the market. I've never seen anything take off on speculation as much as these have. The market in general. And I usually don't talk like this. I mean, I can accept it, but when you get huge breakouts, 200 to 300 to 400% in a year, you got to just sit back and think. I did the same thing during COVID, and I watched it. I watched every one of them run up 200 or 300%, and then they all dropped. And I went, damn, why didn't I catch this? And I'm catching it now. I mean, this is up $160 in a year. Revenue $62 billion. Same as this thing right here. This SMCI. This is a great short. This was at $70 and it's at $554 in a year. 800% increase. Are you got to be kidding me? I mean, it's just uncalled for. I mean, you don't see it. I haven't seen anything like this. Told a close friend the other day, I just feel like shorting the market and just getting out of here for a month or two and come back and see what happens. Google's the one that I'm surprised with. I mean, it's had one heck of a run too, $88 to $153. Almost 100% in a year. Then it also dropped that much too. But this one's the one that I'm surprised it ain't up more. Well, I'm gonna get out of here. Starbucks, that was the other one. They were pumping the heck out of Starbucks today. It's a little undervalued.